I can hear
Good
that.
morning to you too. I can hear you guys.
You are live, my friend.
All right. I was getting a little bit of feedback. I figured out where it was coming from. All right. Good morning, everybody. Sorry for the 2-minute late start. I hope you're doing well. Happy holidays, if that's your thing. I want to say welcome and thanks for coming to the December edition of the Online Trader Summit. My name is Jeff Gibby. I'm going to be running things today. So welcome. I'm glad you made it. I'm glad you can hear me. And let's go ahead and get underway. So first things first, today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So we got the legal disclaimer out of the way. I do want to say thank you for Stocks and Commodities for sponsoring today's event. They've been sponsoring us and helping us advertise the event for like 7 years. It's been a huge success, and we really appreciate them. If you're not familiar with Stocks and Commodities, you can get a free article or a free issue of their magazine, and I'll have this link and I'll put it in the chat box when I have just a second to do that. In any case, they've been doing the magazine forever. It's a great. I love getting it in the mail every month and taking a look at it. We do really appreciate the guys over at Stocks and Commodities, Ed and the team over there do just a great job. So again, if you didn't request a free issue when you're registering for the summit, I'll put the free link in here, and let's go ahead and kind of talk and get started. So of course we are sponsoring today's event. It's not all about us today, but we're going to have some great speakers. One of the things I'll talk about all day long is the fact that Metastock's been rated #1 in its price category for 25 years in a row. And we've got a special 3-for-1 trial that you can sign up for.
Jeff, I'm sorry to interrupt you. You're in such a great role, and you sound awesome, but the fine folks that go to webinar apparently cannot see you.
Oh, well, that's a good
The fine
point.
folks on YouTube.
I know how to
can
fix
see
that.
you, but not the fine
'Kay.
folks.
All right, now you can see it.
Just a second. Sorry, folks. Give us just a moment to work through this.
All right, all right. Thank you for the interruption. That's important. Okay, so the screen should be
Okay,
coming through.
You're good. You're all good now.
All
Thank
right,
you.
very good. We do have a special 3-for-1 offer where you can try the #1 rated software for the last 25 years straight at metastock.com/trader summit 3-for-1. So you should be able to see the screen now. Apologies for that. My mistake, actually, which hopefully is our only technical issue of the day. So I do want to introduce our first guest, Jake Bernstein. Jake is somebody that I used to live very close to when I was up in California. A very nice guy, has a background in psychology, one of the smartest traders that I know. He's written tons and tons of books on kind of the topics of trading. He's a big fan of seasonal trading and some very, very specific setup, trigger, follow-through method, and somebody that I very, very much respect. So, Jake, how are you doing this morning?
I'm doing great, Jeff. Can you hear me okay?
I can hear you. You sound great.
Good, and thanks for showing my high school picture. That was really kind of you.
Yeah. All right. So I did just share the screen with you. How are you doing? I know it's California, so it's a little bit early, but you always start at like 4 a.m. anyway, right?
I'm always up at 4.
Yeah, me too, for some weird reason. All right. So
Can you see my screen?
yeah, I can, and I can see the non-expanded version of your PowerPoint.
Right, and we're going to expand the version right now.
Okay. And I'm gonna
Ready to go.
get out of your way. It's your turn.
My turn, great. Hang on one moment, please. Here we go. Almost there. Can you see it?
Yeah, we can
Oh,
see
we can
it.
see
It
it.
sounds good. Yeah.
Okay, good. Okay, so thank you very much for having me. I really appreciate it. And thanks to everyone for attending and listening to an old man talk about the markets. I made my first trade in the summer of 1967, and I've been trading ever since. As Jeff mentioned, my original occupation was clinical psychology. My first job out of college was working at a mental institution with psychotic patients. And some people say I still do the same kind of work today, but I get paid a lot better. My goal here today is to teach you something, to make your time worthwhile, because time is the most precious commodity we have. The bottom line is this: if I say anything that offends you or the methodology that you're using, it's not personal. I can only talk about what works for me, because that's what I spend my life doing. For the first 15 years that I traded, I was a loser. I tried everything in the book. I read books. I read articles. I read magazines. I talked to traders. Nothing worked for me. I discovered the reason it didn't work for me is it was not objective. It was not specific. It was not clear. So over the course of time, and by the way, I had no one to teach me anything because people didn't want to teach you anything. They just wanted you to be successful on your own or fail on your own so they could get your money. Because in futures trading, which is what I started with, there's a winner for every loser and a loser for every winner. So it took me time to realize that I needed fact-backed, rules-based trading. So my biggest thing that I can tell you today is this: my success has come only from being a numbers guy. I need numbers. I need facts. I don't need opinions. I don't want opinions. I need facts. I need to be able to use computer power for the purpose that it was intended. Give me numbers, give me rules, give me back testing, give me specifics. I will make money. Now, maybe it's different for you. Maybe you're really good at intuition. Maybe you're a psychic. Maybe you're an artist. I'm none of those, but I do know what I'm doing, and I do hope to teach you a number of things today. So let's get out of the way with the usual disclaimer. And one more thing: thanks for Stocks and Commodities for sponsoring this meeting today. Maybe one day they will publish one of the articles that I submit to them, because so far, except for many years ago, they haven't been interested for one reason or another. But again, very good thing, very great magazine, a lot of fantastic research every month. And I still get the magazine, even though they don't publish my stuff. Okay, here we go. So you can come back and get, excuse me, you can check this out later on. I've got a lot of credentials. Some people say I'm infamous. I don't know. All I know is what I do. I've been around the world many times, done a lot of meetings, taught a lot of people how to trade, and my goal is to do this. I want to be specific. I want you to consider the plight of the new trader these days. They go to the internet and they enter something like this: teach me day trading. Okay. Can anyone see my pointer right here? Good. So you put in teach me day trading, you will get 80 million hits. So everyone's going to want to sell you something. It's either going to be the day trading guide, day trading videos, day trading courses, all kinds of stuff. And if you're a new trader, can you imagine trying to figure out what works, what doesn't work, how to get started? So many people will tell you so many things, but I'm going to tell you the thing that's most important, and that is this: if you don't know the facts, if you don't know the numbers for everything that you're going to do, don't do it. You will lose money. My goal today: if you're making money, I want you to make more money. If you're making a lot of money, I want you to make a lot more money. If you're losing money, I want you to turn it around, and I want you to understand why. You can believe me now, or you can believe me later. So I do fact-backed rules-based trading. Why? Because it works so darn well. It cuts down on the amount of work I need to do, makes everything very clear for me. So let's go through a couple of things. Fact-backed rules-based trading means this: every trade and every time frame must always be, without exception, purely objective. For me, there's going to be no looks like, no interpretation, no could be, no this, no that. I will not talk about anything that I don't know. So if you say to me, how do you think the Chinese tariffs are going to affect the prices in the futures markets? I'll say, I don't know. I don't know enough about it. I have to admit that when it comes to trading, I only know certain things, but I will never trade on things that I don't know. I don't interpret anything. I don't know the difference between a bottoming formation and a topping formation. A breakout, a pivot means nothing to me unless I can put it on the computer and test it. Not too long ago, Jeff Gibby and the crew were out in Sunnyvale where I spoke at their meeting. Sunnyvale, the home of computer technology, Silicon Valley. The first time I spoke in Sunnyvale about 7 years ago at one of the traders' meetings, I showed a couple of things and I said, look, this is a pattern. There are many patterns in the markets. We need to find patterns that work. I've got a great idea, guys. Let's take this pattern and put it on the computer and back test it, put it on Metastock and ask the question, does it work? Now remember, I was talking to a room full of engineers, and one of them puts up his hand and he said, that is a fantastic idea. How did you ever think of that? And I'm thinking to myself, these guys are all about computers. They should know how to do this. This shouldn't be a great big revelation to them. So every trade has to fit into a structure, which I'm going to teach you today. It's called setup, trigger, and follow through. That's my second point here. Third, outcome must always be documented. You always need to know where you stand. You need to know what the trade did. You need to know your track record. At every time you trade, every single time without exception, I never listen to opinions unless I'm using contrary opinion, which is another method entirely. All decisions made with attention to historical verifiable details, and all trading methodologies are based on patterns, and there are many patterns, but we can't use patterns that have not proven themselves. For example, people look at Fibonacci, Elliott wave, Gann, reversals, key reversals, head and shoulders. They're wonderful words, and sometimes these words even have sex appeal, but the question is, what the heck do they mean? What are the numbers? How often has a quote-unquote key reversal been successful? Do trend lines work? One of the most popular methods is the so-called death cross and golden cross. The 50-day moving average moving above the 200-day moving average and vice versa. You can talk about it. You can listen to it on TV. If you listen to CNBC, the newscasters, which were giving news a few years ago, have now become market experts. They talk about the market went above its 200-day. The 50-day went above the 200-day. They say it's bullish. Do they know? Earlier in the week, before the big rally, one of the commentators got on there and said, well, we're officially in correction mode now because the 50-day moving average went below the 200-day moving average. What happened? Big rally. Don't talk about anything you don't know. If you don't know about it, don't talk about it. And if you want to talk about it, you must know the numbers. So I go by a couple of lists, and here's one of my lists that I call the 7 F words of trading. Let me talk about them briefly. You need to find the right trades. How are you going to find the right trades? I will show you how to do that. Very simple. You have to fact check. Did you get the details correct? Believe it or not, most people don't get the details correct. They make mistakes and lose money on stupid things that can be avoided. We'll talk about that momentarily. Filter for risk, super important. In other words, I can show you trades that have been right 85% of the time for the last 100 years. But the question is, would the risk on those trades have been too big for your account? No matter how good a trade looks, no matter how good the numbers are, if it's too risky for you and you can't find a way to mitigate that risk, then that trade's not for you. You have to filter, you have to follow through with profit maximizing. In other words, it's one thing to make a small amount of money. Most people are very happy making a small amount of money. You need to know how to turn that small amount of money on the trade into a big amount of money, and I will show you how. You need to finalize your trades and implement the trades specifically. In other words, believe it or not, there are rules. People in trading do so many stupid things that they wouldn't do in their business. You say to them, why are you doing this in your trading when you're running a very beautiful business? They say, well, trading is different. How's trading different? It's the same thing. It's a business. You've got to run it like a business. You have to realize what your mistakes are and fix them. I make a differentiation between the smart loss and the stupid loss. The smart loss. You did everything you were supposed to do. You followed the rules. You had the trades. You knew the stop. You knew the target. You knew everything, but you still lost money. Hey, what we do isn't perfect. That's fine. You lost money, but it was a smart loss. You did everything you're supposed to do. The stupid loss, you broke the rules and you lost money. You were stupid. You deserve it. Formulate your next plans. In other words, once you're done with all this stuff, the trade is over, go on to the next trade. It's time to move on. So practice the 7 Fs. And how are we going to do that? Well, today I'm going to give you all of these things. And as I said before, believe me now, believe me later, you will see what I'm talking about. So I have a couple of choices today. In 60 minutes, I can teach you many things very generally and say, oh, in order to get more information on this, you're going to need to buy something from me. I can leave you confused. I can say, hey, I'll impress you, but then I'm not going to give you the whole story so that you have to come and get more from me. Or I can teach you one thing extremely well so that you'll see the value and significance of what I have to show you. So I'm going to opt for choice number 2. I'm going to show you something really well from start to finish, and I'm going to show you how you can do it on your own. You don't need me to do this, but you do need my expertise to do it right. So let's go to the next slide. Look, there is so much out there. Discipline, facts, theories. I just got an email. I'm on some sucker list somewhere. I just got an email from someone saying they have made 3 trades with 100% accuracy, and they've been able to turn $700 into $7,000 in just 2 months. You get this kind of garbage all the time. If it's too good to believe, if it's too good to be true, if it's good to believe, then it's too good to be true, and it's not going to happen. Be very careful. People in this business are just dying to separate you from your money and engage in all sorts of scams. What I'm showing you here is no scam. It's the truth. And let me say one more thing. Don't believe anything I'm telling you until you see it for yourself. Don't believe anything anyone tells you until you see it for yourself. It's very easy to create great track records if you know how to do it, especially with software. So software can be used for good and for bad. Don't use it for bad. So let's talk about this. All of these things are very important. People say, hey, Joe, you can't make money because you have no discipline. Joe says, yeah, he's right. I don't have any discipline. I'm going to go to a psychiatrist and lay on the couch and get some discipline so the psychiatrist can tell me, you're not disciplined, Joe, because you had improper potty training. That's ridiculous. Discipline comes from confidence. Confidence comes from knowing what you're doing. Knowing what you're doing comes from having good methods for doing what you're doing. If you're not using a good method with high accuracy, you will lose money. That will undermine your confidence, which will undermine your discipline. If you have discipline with something that doesn't work, you need to have your head examined, because discipline can't come from things that don't work. It has to work. Then you will get confidence because you have discipline, which will give you more money, which will give you more confidence, which will give you more discipline. And so it goes. We can talk about that another time. Let's go back to this. This is the kind of nonsense, and you can read this on your own. You don't need me to read this to you. This is the kind of nonsense that we are subjected to on television, business TV all the time. I've highlighted in red every statement that's interpretive or not understandable, not objective. And you can see that a good 2/3 of everything this so-called analysts talked about is subject to interpretation. And giving you all this information about could go higher short-term within the context of an intermediate-term downturn and secular bull market, what the hell is that, and so forth. The analyst finishes by saying, of course, geopolitical events could change this forecast dramatically at any time. So after spending all this time telling you something could happen, they tell you, well, something else might happen as well. I don't need that kind of stuff. You don't need that kind of stuff. You don't need this either. And so just avoid it. It's nonsense. It's worthless unless it's about the numbers. So let's go on to the next slide. So This is here the most valuable thing that I can give you today. And believe me, if I had this within the first 15 years of my trading, I would be much wealthier than I am today. I can't complain of where I am today. I've done well, extremely well, but I would be much better off. So here's the thing. As I said before, believe me now or believe me later. Anytime anyone teaches you anything or attempts to teach you anything and you want to trade it, remember, if it doesn't have within it these 19 things that you must know about every trade before you make it, your probability of success decreases. And for everything on this list that you don't know, your probability of success decreases even further. So I've got here these 15 items, 19 items, and let's go through them really quickly. Some of them are obvious, but remember, I'm going to ask you to do one thing. Listen, I'm 73 years old now. I don't have an axe to grind. I just want you to be happy. And I want to get that email from you saying to me, Jake, you changed my life for the better. I came to this meeting not expecting anything because it was free, and I got the most precious gift in the world when it comes to trading. So here's the thing. The more of these things you know, the higher your confidence will be because you're going to see results. I'm going to go through them quickly. I want to know which stock or commodity to trade, the exact name, gold, silver, 3M, Alcoa, whatever. I want to know whether to buy or sell. Those two are obvious. I want to know the exact time or price to buy or sell within 1 minute or less. How can you know that? It's knowable and it's teachable, and I'll show you. I want to know my odds of success. How often has this strategy been right and for how long? I'm not talking about right 3 out of 3 times or 10 out of 10 times. I'm talking about over the course of many years. Most traders don't like to look at results going back many years. They like to look at what's happened in the last 3 years or last 3 repetitions. Why? Because they don't want to see the past. There's an old saying which I'm not going to repeat, so let's forget about that. I was going to say something about a monkey. No monkey likes to look at his own butt, but we don't need to talk about that. So you want to know your average profit, your average loss over many years, your stop loss and risk, your profit to loss ratio. Are you making more money when you're winning than you're losing when you're losing? The complete track record, every trade that's been made based on this strategy. Your average profit in points and percent, your largest profit, your largest loss, the drawdown, the upswing, the downswing. You want to know the number of consecutive losses, the number of consecutive profits, and so on and so forth. Example, why do you want to know the number of consecutive losses? I'll tell you why. Most traders cannot handle losing money more than 2 times in a row. The first 2 times they lose money, they say, well, I wasn't expecting the game to be perfect, but now 3 times in a row, it's not fun anymore. The fact of the matter is that even the best trading strategies in the world will lose 6 times in a row. If you don't have the internal discipline, the money, the fortitude, the discipline to stay with the trades and the strategy, it's never going to work for you because most traders give up after 3 losses, or they say, I'm going to go back and look at what I did. If I had only changed this one thing and done it a different way, it would have worked. All of a sudden, the strategy that they had is changed. Then they lose twice, they change it again. Is that you? I hope not. And if it is you, don't let it be you anymore. Accuracy, minimizing the loss, maximizing the profit, when to move to a zero risk stop, when to exit your position. I respectfully submit to you that if you know all these 19 things, or most of them, your probability of success would be significantly higher. And if you also knew all of this stuff over here, it would be great. There are ways to know that stuff. I'm going to show you one of those ways today. So you want to avoid this. People send me charts like this, and they say, isn't this a great chart, Jake? And I look at it and I say, what the hell is that? That means nothing to me. Most indicators are derived from price, which is why they look the same. So if you're saying, I've got 18 indicators on Metastock, they all look the same to me, they're all heading in the upward direction, what does it mean? Nothing, because they're based on price and they will move with price. So this kind of stuff, you don't need it, you don't want it, get rid of it. So what's the alternative? So if you're going to get the copy of this presentation, which I'm glad to provide, take your time and go through this. I talk a little bit about what works and what doesn't work. There are things to avoid and things to not work that do not work and never will work. So let's Be very careful about what you believe. If you tell yourself something's going to work and you do it enough, you're going to fool yourself into believing it. What I said before, be a numbers person. There is nothing that will replace the numbers, provided those numbers have come from a source that's honest and a source that is getting those numbers correctly. So we're going to look at one thing today, and that's seasonality, which is, in my view, the best thing that you can do. So let me show you something else. If there's one thing that I want to teach you today, it's this right here. Setup, trigger, follow through. Number one, every trade must have a setup. A setup is a pattern. The good news, there are hundreds of patterns in the markets. The bad news is 98% of them don't work and never will work. So we have to find those patterns. What is a pattern? It could be a head and shoulders. If it could be identified algorithmically with rules, it could be a moving average. It could be divergence. It could be stochastic. And I say could be because we don't know unless we test it. So we need setups that have a proven record of reliability, predictive validity. Once you have a setup, you move into the trigger phase. I've got a setup that says stocks should go higher in December, X% of the time, beginning on a certain date. But when that date comes, I need something else to get me in. I go to my Metastock and I say, what is the trigger? Is the trigger there? Yes, it's there. Therefore, this trade probability increases. Last step, follow through, step number 3. And by the way, something as an aside, I've had a very, very enjoyable relationship with everyone in Metastock for a long time. They've been very supportive of me. I appreciate that. I've been remiss because I have not used Metastock enough, but I'm changing all that. Starting Monday, I will start to become a Metastock expert for all of my trading, for all of my charts and my indicators. Very cooperative with me, and I appreciate everything you guys have done. And finally, I'm going to come through and start using your work. So, one moment, please. Let's make sure that no one from Metastock is calling me. No. Okay, so let's go forward. Use the setup, trigger, follow through procedure. I'll expand on that. It looks like this. Setup, trigger, and follow through. Always use the strategy. And remember one thing. Follow through, exceptionally important. 20% of your trades will make you 80% of your profits. That's the most important thing. So most people are happy to make a few $100s on a trade. I'm not. I want to take that trade and maximize a few $100s into a few $1,000s or more. And there are ways to do that. And by the way, let me say one more thing. If there's anything I say here today that's unclear to you, send me an email. I will clarify it for you. I want to be specific and clear with you, which I guarantee you I can be and will be. So, most important rule, if you can't test it, don't trade it. This rule alone will save you a whole bunch of money. 95%, possibly more, of the nonsense that you will see in emails cannot be tested intentionally because they don't want you to know it doesn't work. Not until after you've bought the course. And if the course doesn't work, they say you need another one. You need more clarity. Be very careful. They're intentionally vague and subject to interpretation in order to make them difficult or impossible to understand. Don't become a victim of that trap. If you can't test it, don't trade it. Let's look at an example. Let's talk about copper. I'm going to talk about copper futures for a minute. But remember, for every stock, for every futures contract, there's an ETF or more. So this would apply to BHP, Rio Tinto, FCX, Southern Peru Copper, COPX, and others. So let's ask a question. This chart, by the way, and I apologize to you, Jeff, you sent me the chart, but I can't get it to be clear. This is a copper futures market, and this is what happened yesterday. Copper futures were up 880 points. One of the biggest up moves I've seen in a long time. 880 points in copper is worth roughly $1,000 or more on a margin of about $1,500. It happened in one day. So the question is, why? Let me show you something. And by the way, I'm going to show you something that nobody else in this business has. We're looking now at the last 118 years of copper prices. Who does that? Who's got the data? Who wants to go back that far? I do, because I want all the numbers that I can get. So look at the chart. This cluster, March, April, May, June, July, has percentages in it. They're green. This cluster has red percentages in it. If I'm going to find the most bearish month in copper, it's right here. 80% of the time, copper prices have gone down between September and October in the last 118 years. But now we're in the most bullish time frame of the year, right over here. So first of all, why is copper up? Copper is up right now. Why did it go up so much on Friday? Because it's the right time of the year. So within the context of what I talked about, this is a setup. It's a pattern. It's a historical pattern, and it gives me numbers. I love numbers. Numbers help me make money. So let's do this. Let's take March copper from the start of futures trading in 1972 to 2017 and make one chart that looks like the March copper contracts every year. So this is an average chart, and it shows this right over here. Beginning in mid-December and bottoming out in November is when copper prices begin to move up. These numbers in the boxes show the percentage of time that prices go up or down during each week. So the first thing I know is sometime late November, mid-December, the price of copper begins to go up. There's a reason for it. Won't get into the reason right now. There is a fundamental reason for it. The real question is, how can I make money with this? Easy. I'm going to go to this website, seasonaltrader.com, one of my websites, and I'm going to ask a question. Search. Go to copper, go to a stock, and ask the question, can I make money? I'm going to divert from copper for a moment and talk about a trade. A couple of months ago, I went to Seasonal Trader, which I do every week, and I get my trades for the next month or the next week. One of the stocks that I picked, and there's a process for doing it, and there's a training video there, is Ingersoll Rand. And I asked the question, for Ingersoll Rand, during the month of October, going back many years, has there been anything that's been right 75% of the time or more that's has a duration of X number of days? So what I'm doing is I'm going to this huge database in the cloud and asking a question, of all the statistics that you have on file, has there been a pattern in Ingersoll Rand, and we're going to come back to copper soon, that has given me 75% odds of success? I have the option here to enter into this pattern how many days I want in the trade, my risk, my profit to loss ratio, and all of these different search elements, which if they're there, the computer will find. The computer comes back and says this. It said, buying Ingersoll Rand, end of day, October the 9th, getting out end of day, February 24th, with a 15% risk, has been right 76.5% of the time in the last 34 years. So the first thing I want to point out to you is this. Who does that? Who goes back all of these years? Most people don't. We do. We ask the question, entry date, exit date. I want you to think back to the list of 19 things that I told you about earlier. Does this answer every one of those questions? Think about it. Buy or sell, date to get in, end of day, date to get out, end of day, risk, profit to loss ratio, number of trades, number of winning trades, losing trades, percentage correct, average profit in points, average profit in percent, entire track record, everything I need to know, including this. This is a chart of Ingersoll Rand showing the typical pattern every year. So it's not any one year, but it's all the years added together. And then highlighted in yellow is the trade we just looked at, the most profitable time. At the bottom of the screen, I've got things like this. Arrows up, arrows down. It just so happens these 4 weeks, April into May, show historically a very bullish pattern. If I go back and I search and ask the question, give me the exact date to get in, the exact date to get out, with all the statistics, the computer will do that for me. And it will give me all the details. Now here's the Metastock chart showing the trade this year. So going back, this was the chart and the data that I generated back when I searched for the trade at the end of September. You'll notice the statistics were only up to date to 2018 because the 2019 trade hadn't happened yet. And we were looking for a move of approximately, average profit right over here, 3%. So this is the date, which we knew ahead of time, to buy Ingersoll Rand. Now, I don't think you could ask for much better timing knowing this trade ahead of time. And here's what happened. So the question is, how did we know that? Was it psychic? No, it was factual. It was based on history. And it told us everything we needed to know except for one thing. Would it work this year? But that's always an intangible. We know what the risk is, and if the risk is too high, we don't take the trade. So let's go back to copper. I go to my seasonal trader website. And by the way, this is not a commercial for you to get you to buy seasonal trader. You can do this on your own if you want to do the legwork. You can get a trial subscription there and see if you like it. So there's no tricks or gimmicks. Very easy to do. So I asked the question, and remember, because it's a computer, garbage in, garbage out. If I'm asking the wrong questions, I'm going to get stupid answers. I want to ask the right questions and get the right answers. So I'm asking a very simple question. For copper, and we do this for stocks and futures, for the months of November and December, is there anything that would have been profitable 75% of the time or more? We'll have the number 75 entered right in here. Hold on a moment, please, right in here. And I asked the question, I don't want to risk more than 6%. 6% of what? 6% of any trade that you find. Don't show it to me if it's more than 6%. Computer crunches the numbers and comes up with some findings for me. And here's what it says. One moment, please. Here's what it says. And this trade, by the way, is coming up, so you're going to have a chance to see if I'm any good. Buy March copper, close the trading December 18th, get out, close the trading December 24th, risk 2%, close only, stop. Your profit to loss ratio was 4.5 to 1, with almost 80% wins, and these are the rest of the relevant statistics. Now, again, go back to my list of 19 things. Everything is there. The computer has found all the iterations and said, okay, I'm going to put the best one at the top of the list. Why? Because it's got a 4.5 ratio, which is higher than any of the others, and it's got a 78% accuracy. So this is a trade that I'm going to take. What else do I know about this? I know everything else I need to know about it because here's the chart. These are the 2 weeks involved in this particular trade. I can see that it will go higher after that, but not directly higher. What else can I see? I can see other trades. Example, S&P. How did this one turn out? I did a search and asked the question. For the month of November, show me all the S&P trades that have been right 80% of the time or more since the start of trading in S&P futures. And by the way, let me digress for a moment. I want you to compare what you're learning here from me today with the kind of stuff you learn from many other people. What I'm teaching you today is numbers, objectivity, clarity, no interpretation, no talk about trade tariffs, no talk about premiums or discounts, simply the numbers. So at that time, the numbers were very simple. Buy March futures end of day November 20th, and you notice end of day, very specific. Market on close order. Get out December the 4th, risk 3%. The profit to loss ratio, 17.4 to 1, meaning what? Meaning in sum total, the winning trades have been 17 times higher than the losing trades. Also, my average profit and average loss. You'll notice the average profit is 19.83 points. In S&P futures, that happens in a heartbeat. Why am I telling you that? Because I'm saying this. Many of these trades will reach their first target, which is the average profit per trade, literally overnight. Not always. It's not perfect. Hey, what we do here is good. It's great. It's excellent. It's objective. but it's not perfect. Don't confuse excellent with perfect. There is no perfect. So the bottom line is this. Buy it, risk 3%. If the risk is not good for you, too much risk, mitigate the risk with an option or an option strategy. So let me come back to the previous one. One moment, please. Okay, so here's the trade. Well, what about all this other stuff? What does it mean? As I said before, the computer is taking the best trade, and because I programmed it that way, it has put the best trade in the first position. So here's the history of this trade. Why does it say 2019? Because remember, we're trading the March contract. So this is what happened last year. Last year, it made 61 S&P points. It's a hell of a lot of money. But let me show you something else. I want to mitigate my risk. So as soon as the trade has made its average profit, which is 19 points, I'm removing my risk entirely, raising my stop to break even, and taking some money off the table so they've got something to show for my trades. Very simple. So let's take a look at the graphics. And again, it's all about numbers. These are the graphics. Complete performance every year, every trade, and the cumulative profit. Let's talk about psychology for a minute. The average trader is going to look at this and say, it's been working too well. It can't work this year. I say, well, why can't it work this year? Well, because Trump's an idiot. We've got problems everywhere, problems with China, problems in the Ukraine. There's an impeachment hearing. None of that means anything to me. Well, they say, well, it was at its highest cumulative profit last year. It's due for a drawdown. How do I know that? I don't know that. I'm talking about things I don't know if I say that. There's only one thing that's important, and that is this. I'll show you. Can you afford the risk? A 3% stop close only. If not, you can mitigate that risk. So let's take a look at what happened. Let's go forward. And here's the trade this year. This was the entry date. This is where the profit target was hit. And this is what happened afterwards. Now you might say, but Jake, what about all of this? Well, guess what, ladies and gentlemen? We got this too with another method, because seasonality is not the only method I use. It's the only one I'm teaching here today. So you might say, well, this was too scary. Ladies and gentlemen, there is no scary. There only is risk and there is no risk. If the risk is too big, mitigate the risk. If the numbers are good, the trade is good, win, lose, or draw, it's not going to make money every year. A few slides ago, let me go back. Let me show you something. I ran these trades in October for the month of November. Take a picture of this graphic and see what happened. Were they all winners? No. But guess what? They performed extremely well, because we can't win all the time, but at least we know all the history. And by the way, as you will see from the training video at Seasonal Trader, this trade we did not take because it failed on 2 of our filter criteria. In other words, it did not continue to grow, so we reject this trade. So let me go forward. Then we're going to do a live search. One moment, please. Okay, so here's another one. S&P 500. There's another trade coming up, and that will be right here. One moment, please. Right over here. So guess what? End of January, you're going to have 3 weeks of a big up move. I can't give you a guarantee, but I can give you numbers, and I can give you entry and exit and all the things that count. Let's go forward before I run out of time. How did I find that trade? Simply by doing a search. Show me all the S&P trades for January and February that require a stop at risk of less than 8%. So here's the trades exactly. And I can choose what I want, but the computer has taken the best one and put it in the first position. And remember, most important thing, I've got the entire history. So let's do this. Here's another one. 3M. I want you to look at this trade, and I want you to look at this trade. Very specific. And the question is, what did it do? Again, here's a search. It said, buy 3M, end of day February 9th, get out February 20th, or take some money off the table when you've reached a profit target of 2.34% with 81.6% accuracy. Here's what and by the way, this is not a Metastock chart. Apologies for that. But here's the trade last year, and here's the trade this year, right over here. So let's do something different, okay? Let's go to the computer and ask the question. In fact, let's do it live, so just bear with me for a moment. I'm going to get out of this mode and go to Seasonal Trader, like so. One moment, please. I'm going to ask a question. I want to show you some trades that are coming up. I'm going to highlight a few. There are many trades over here, many different stocks over here. We're just going to highlight a few of them. I'm going to ask the question. For these stocks, 3M, Abbott, Adobe, Aetna's been merged, Aflac, Air Products, and so forth, for the month of December. Is there anything in the month of December that's been right 75% of the time, risking less than 10%? That's been a short-term trade, 15 days or less. Very simple. I'm asking a direct question. And remember this, the answers I get will be based on the questions that I ask. And by the way, I want you to remember, no hocus pocus, completely objective, strictly according to the rules. Very important. So I'm going to do the search. It might knock me out and I might have to get back in again, but let's see. Yes, it wants me to come back in again, so we'll do the search again. I'm going to log in. I'm going to go to seasonal charts, seasonal trades for stocks, like so. It's very simple. The database, by the way, is huge. 3M, Abbott, like so. And by the way, this has no sex appeal. The only sex appeal is money, and money can buy a lot of sex appeal. Adobe, Aflac, and by the way, the stocks we've put over here are the ones that work extremely well in terms of history. Air Products and Aflac, just bear with me for a moment. And Alcoa, like so, and Altria. Going to go to the month of December, like so, and pick December. One moment, please. And ask the question. Anything that I can do historically with 75% odds of success, with a profit to loss ratio of at least 3 to 1, like so. Let's do 4 to 1. I'm sorry, stop less than 6%. Profit to loss ratio 3 or higher, like so. And days in trade, 25 or less. So again, these criteria are selectable by me. If there's something there that's historically valid, the computer will find it. If not, it'll say, I got nothing for you. Here's the search mode. And we got a lot of stuff. And this computer has taken the best trade and put it in the first position. So here's the trade on Aflac from the 24th to the 29th. Let's take a look at this Air Products one at 80% accuracy. I've got everything that I need. And here's the best part. I can go to the history, look at the history every trade every year and say, what does the performance graph look like? Here we go. Here's the history. We're talking 36 years. And these are the results. So, very simple, very straightforward. And remember, I'm going to make my decision based on risk. And the risk is 6% stop, close only. Very, very simple. And by the way, if you have any questions about this, get in touch with me. So let's do one more thing. I'm going to show you something truly amazing. Let's return to the search. And let's go to the Dow Jones and go to the search, like so. I'm going to ask the question. Clear selection. And I'm going to go to the Dow Jones. One moment, please. Dow Jones back to 1920. So, ladies and gentlemen, we're talking about 100 years of history. Who does that? Who cares? I do, because that's how I make my money. I'm going to select all months and ask the question. For this entire period of time, for the Dow Jones, has there been anything historically that's been right 75% of the time or more? You would imagine that since then, with multiple world wars, OPEC, the petroleum crisis, everything short of a nuclear war, we've had inflation, disinflation, you name it, we've had it. Is there any consistency? Is there anything that's been right 75% of the time or more? Well, let's find out. We're going to ask the question like so. Search. And to end the suspense, just bear with me. Well, goodness gracious me. What did the computer find? The computer found a trade with a 15% stop entering October 26th, exiting January 10th, so we're halfway there. That's been right 82% of the time. Imagine that, in spite of all the things that have happened historically in the world. And here, ladies and gentlemen, is the entire history at the push of a button. Who does that? There it is. It's not perfect, but it is very accurate. So, let me go back to my presentation. One moment, please. And I've shown you the basics of what I had to show you. I'm sure you've got some questions. So let me scroll through this very quickly and give you some information. And by the way, some of my other methods, in fact, most of my methods have been programmed on Metastock to show you the entries and the exit with the expert analysis. Jeff can talk more to that, but we're very specific in our work. One more thing. There's been a tendency for stocks to go higher before major US holidays. This was a Thanksgiving Day trade. There's another trade coming up, and it's the Christmas trade. It's got very good statistics as well. You might want to look at it. These are all contained in a book by Art Merrill, one of the best books ever written on stocks. It's called The Behavior of Prices on Wall Street. So if you want to reach me, jake@trade-futures.com is the email address. You can look at my year-end sale. There's the link. You can go to jakebernstein.com or jakestradingstrategies.com and find out more about my methods. And Jeff, you asked me to end a few minutes early, so if there's any questions, I'll be glad to take them if you want to relay them to me.
Absolutely. Can you hear me okay?
Beautiful.
We don't have a lot of questions. We've had somebody asking about how to get to seasonaltrader.com. So to do the free trial, it's netpressinc.com/store.
No,
Go
free
ahead.
trial for just go to www.seasonaltrader.com.
Okay, well, that's easier.
It's a lot easier.
Seasonal-
What I have here is listed my year-end sale if people are interested in what I do.
Perfect. We had a question from Ann a little bit earlier saying is gold seasonally down right now?
Gold is seasonally down right now, but the big move right now is in copper. As I said before, copper is the most bullish of the year in December, and that's happening right now. Gold is in a downtrend. The big seasonal up move in gold happens between September and October. So the gold trend is lower and there are no specifics. In fact, all we need to do is go to seasonaltrader.com and ask the question. In fact, can you still see my screen?
Of course.
So let me do this. I'll answer the question the following way. So I'm going to go back to Seasonal Trader like so. And I'm going to go to gold and ask the question and get an objective answer because otherwise I'll just be talking about something I don't know. So we're going to go to return to search like so and ask the question. One moment, please. And we'll do this the right way because we still have a few minutes, right, Jeff?
Yeah. Yes, we do.
All right, hang on one second, please.
Okay.
Okay, here you go. We're going to ask the question objectively. So let's go to futures like so. Seasonal trades, futures. And we're going to go to gold. One moment, please. And that's easy to do. And we're going to ask the question. for gold right here and ask the question, are there any gold trades in November and December? Let's do October, November, and December like so. Moment, please. And just ask the open-ended questions. Anything? One moment, please. I'll get this right. I've only done it a few million times. And we're going to search. Computer says there is a long trade coming up December the 15th. Very nice trade. Let's look at the history. So that's a good little prediction and see what it looks like. And this goes all the way back to the start of trading in gold futures, like so. Here's the history. We love, you've got 44 years of history here. And here's the results. So if this scares you, be aware of the fact that it does require a bigger stop. Not the most beautiful curve in the world, but the bottom line is it's specific. And you'll notice it had 2 losing years in a row here, but the last 5 years it's made good money, made $2,000 last year. And we can do something else with this. Just bear with me and I'll show you something really interesting. You can ask for the seasonal chart, like so. This takes a moment to post because there's a lot of data that's looking at. So let me do this. Click on seasonal, like so. It'll take a moment to post. And then you guys will get rid of me and be able to talk to somebody else. Or listen to somebody else. And I hope they're objective and completely clear. Should come up any minute now. So here we go. So here's the chart. It says that from where we are now in December, we've got a 2-week up move coming. And by the end of the year, we should be higher, but the probabilities are not that great. So that's your seasonal chart. So Jeff, I am done.
All right. Very good. Thank you, Jake. Appreciate it.
Thank you, Jeff.
Yeah, anytime. Let me go ahead and take control back here. Jake, great job. I really appreciate your presentations. You do such a good job of making everything clear. One last question for you, Jake. I've already taken the screen control back, but Herman asked, what is the name of the very good stock book?
The Behavior of Prices on Wall Street by Art Merrill, M-E-R-R-I-L-L. Definitely worth reading. I like the book. It's been great. It's made me a lot of money, and I would recommend it very strongly, above and beyond any of my books.
Okay, awesome. I just noticed we have a minute. So, Jake, thank you for your time, and we will see you again really soon. Thanks for coming in.
Thanks, Jeff.
All
Thanks
right.
again. Happy holidays to you.
You too.
And
Oh.
thanks for the chocolate candies from Metastock.
Oh, those are good, right?
Fabulous.
All right. Well, Bill says, excellent presentation, Jake. Suzette says, I'm very happy I took a day off work for this. Very, very instructive. So I'm glad you enjoyed it as much as I did. Herman says, thank you. You're welcome. You're welcome. I really appreciate Jake coming in and spending just a little bit of time with us. I do want to talk a little bit about a project we've worked on with Jake just recently to get his STF models put together with Metastock. And I'm going to do it within less than 2 minutes just because we don't have a lot of time. But if you're familiar about, holy crap, it was 11, 12 years ago we put together all of Jake's technical systems into a product that was available for Metastock called Setup and Timing Triggers. And we just spent a lot of time just recently getting it updated, refreshed. We went through all the systems, we updated it, we made it so all the commitment to trader stuff would work, and it's now available as an add-on that you can buy for Metastock. And I want to talk just a little bit about it. I only want to talk a little bit about it because I'm on borrowed time from Price Headley right now. So it is called the Setup and Timing Triggers 2. There are 2 parts of it, really. There's, if you're interested in futures trading or looking at the S&P, Jake has a very, very interesting way of looking at commitment of traders data. And we'll do another class on that in the future, but it's a very unique way of looking at the inside of the markets to see what commercials particularly are doing with COT data. And then he has about 6 technical systems that he talks about in the flurry of books that he has as well. And so we've coded all of these to work inside of Metastock with the commitment of trader systems. It basically works with this big old list of commodities that you see on the screen. You pull them up, you look at it on either a weekly or a monthly, and it'll tell you based on the commitment of trader data that gets reported by the CFTC whether something is bullish or bearish right now for a long-term basis. And it actually looks really good. I wish I had a few minutes to show it to you, but we are out of time. So it works with all of these. If you have futures data from Reuters Data Link, or if you have Zenith, any version, it'll allow you to power this, and they're just really, really good templates that'll allow you to look at them. In addition, we also have his technical systems. So there's about 6 of them that we've put together that include an expert advisor, which you can open up, you can apply it to a chart, and it will actually show you when to buy, when to sell, why you're getting a buy signal. It's got explorations, which is our fancy way of saying scanning. So you can run through scans of the entire market and actually find stuff that makes, you can even test it. So like Jake was saying, you want to be able to test it to see how well it works. You want to find and identify the best stocks or futures to trade with it. These technical systems work on any instrument, and you can identify which ones they work well with just by doing some testing. And they all follow a setup trigger follow-through method. When it was back in the day when we released it 11 years ago, it was hugely popular with our user base, and I wanted to really provide a powerful update to it, so we added a couple of systems. We went through and reworked everything. We got the commitment of trader. If you have that old version, you can upgrade to the version 2 of it. It's only like a one-time cost of $100. But if you want to get it for Metastock, it's normally $499. We're going to be running it today as a summit special for $399, and we'll be including it with our money-back guarantee. So I said I'd take 2 minutes to kind of talk about it. That's about as well as I can do in 2 minutes. We do offer it with a 30-day money-back guarantee. It is powered by the software that's been rated #1 in its price category for like 25 years in a row. You should try it. So we're going to be talking about quite a few of the different add-ons today. You'll have Metastock Real Time. You'll have the Zenith data. We have a package that includes all of the add-ons. It includes Metastock Real Time, Zenith data on a buy one, get 2 free. So you get 3 months of data, real time from Reuters. Refinitiv, sorry. You get the Knoxville Divergence, which we'll talk about a little bit later. The Big Trend Toolkit, which Price is about to kind of come in and talk about it. You get our Fulgent AI add-on. You'll get the setup and timing triggers, some of the best add-ons we offer. You'll get Unleash the Power of Metastock, 2 years of stocks and commodities. All this separately would be $17.44. And it's only $896, which is a savings of about $848. So we'll have, if you have questions about that, if you want to chat with one of our reps, you can give us a call, 800-882-3040, or you can chat live with us at metastock.com/saleschat. Again, as we kind of get through the day, we'll be able to show you more of kind of the Metastock program and how it does scanning and how the expert works. And it's a very, very cool tool. There's a reason it's been rated #1 25 years in a row. And this is a very, very good package to allow you to kind of get all that. And we'll talk more about it. We have lots of time today. We just don't have a lot of time right now. So I do want to shout out to Stocks and Commodities Magazine for sponsoring the event. Hopefully you've signed up for the free issue. I'll post again the link for that in just a few minutes when I get price going. But we do really appreciate the support. And man, that Stocks and Commodities Magazine is such a good way to make sure that you're kind of learning and growing and improving as a trader every month. So let's go ahead and talk a little bit about Price. Headley. Price is another great technician. I remember when we've also been working with Price for probably multiple decades now, and he's somebody that I absolutely love to listen to. When we started, he was rated one of the top market timers in Timers Digest. He's a member of the Traders Hall of Fame. And he wrote a book. He's probably written a couple of books, but the one that kind of stands out is actually called Big Trends in Stocks and maybe Options. I don't remember the exact title, but super nice guy, super down to earth, super straightforward, and really knows what he's talking about. So let's go ahead and get him live real quick. Price I just turned on your microphone. Hopefully you can.
Hi, Jeff. How are you today?
Good. I'm even better now that your audio is working and we didn't even have to worry about it.
Absolutely.
All right. We do have a question that I'm going to address really quickly. A lot of people are asking for recordings today. Just so you know, we will be sending the recording automatically 1 hour after we get done this afternoon. So that'll come to you. And Price, how'd I do in terms of introducing you?
Always great, Jeff. Great to be with you.
All right. I just turned the screen over to you, so I'll let you know. I'll stay here with you. How's everything? What's the weather like where you're at?
It's cold in Kentucky. I'm in Lexington, Kentucky, horse country here. So, we get our share of winters here in the kind of middle of the U.S., but it's beautiful country, so we love it.
What temperature does cold mean in Kentucky?
Cold is about 30 to 35 degrees right now.
Okay.
But it can get down to, we get a foot of snow once in a while. So, it's not often, but, every once in a while we'll get 2 or 3 inches times a year usually.
I'm going to get out of the way. I don't think people want to hear about the weather. But all right, thank you.
I'll leave you a few minutes here at the end of mine so you can talk about the toolkit. But good morning, everybody. I'm thrilled to be with you on these Metastock summits. It's always a lot of fun. You get a lot of great education and a nice compact focus a few hours. And bottom line is we want to talk today about, I want to share with you how we trade options on the weeklies for the FANG stocks. The big theme here is that I think a lot of traders are missing out on trading some of the true leaders in the market. And I would just ask, maybe it's a quick, get you responsive here in the chat. How many of you feel like you've been taking advantage of the big opportunities in the FANG stocks and with the real market movers? We're talking about Google, Apple, Amazon, Facebook, Netflix. How many of you trade those or wish you did? Because that's what, I talk to a lot of traders who say, you know what, I wish I could, but the bottom line is that Amazon's trading up there at $1,800 a share, or Google's up there at $1,200 or $1,300 a share, or even now Apple is in the $270 a share range. So yeah, I think a lot of people, just the general sentiment is that I'm not taking advantage of them as well. I wish, as Frank says, not trading them as well as I could, and so. Martin has, glad to hear it. Martin, bottom line is that with options, you can now control these stocks for literally oftentimes 1% or less of the cost of the stock. We're talking, great to see William L., fellow big trender, definitely take advantage of that. Herman, yes, and BX would like to. So basic premise here, Mark says, wish I did in the past. Exactly. So, you look back and say, gee, I've missed out on these big moves like Apple doubling here over the past couple of years. It's just phenomenal, the kind of moves that they've had. And the theme is, okay, how are we going to take advantage of it going forward? So let's let go of the past regret and focus on the future opportunity. And with that in mind, just a reminder that everything that I share with you today is for your information and education only. Basically what we're focused on here is showing you how you can do this, and I'll show you how you can actually put it into work with our real-time signals and our FANG options trader portfolio a little bit later. But nothing here is a specific recommendation. I've captured updated Metastock charts across all the big 5 FANG names, so we're going to walk through those. But of course, you were 100% responsible for your own investment decisions. Big Trends and its staff are not responsible for any trades you do choose to make. And so at Big Trends, what we do is we take our research. It's never personalized to any individual. What we do is we call out specific real-time entry and exit instructions on every FANG options trade through email and through your smartphone when you become a subscriber. So more on that later. It is near the end of the year, and that means it's a good tax time to talk to your tax advisor and figure out what's going to impact your tax situation. Also, Big Trends alert services can be up to 100% tax deductible for certain types of traders. So do consult your tax advisor on that before the end of the year. So we're going to talk about what FANG stocks are all about and why I love them on weekly options, particularly on these higher volatility stocks. We're going to show you an interesting graphic on how that high volatility can help you. And the number one indicator to define a trending stock, I'm going to leave a few minutes for Jeff to talk about my Big Trends toolkit that he and I worked on many years ago, and over multiple iterations. Why it's a phenomenal vehicle. It's got more than a dozen indicators and strategies in there that you can take advantage of. But I'm going to focus you today on just one thing. Okay, one thing that you should take away in this hour together that you should look for, and we're going to show you how you can model that success across a lot of different examples. Now, if you've been under a rock and don't know what I'm talking about when I say FANG, we're talking about Facebook, Amazon, Netflix, and Google. And several years ago, when we launched our FANG Options Trader program, we said Apple's got to be in the mix. You're starting to see more people talk about FANG with 2 A's now, because yes, Apple is a critical component of the FANG names. The reason the FANG names matter is because they're leading tech names that are really driving market performance and index performance. At one point, somebody said that like the FANG names were driving 80% of the market's gains back in early 2018 to the middle of 2018. Still a big part of this market. Now, past performance is never a guarantee of future results, and so I'm always not wanting to share, just our vertical experience that we've had in our FANG options trader portfolio. This is just going back to the beginning of 2018, and even didn't get a chance to update it. The past few months would be up even more. But bottom line is that if you just put in no more than $1,500 a trade, then saying, okay, you'd be up 11,611 before commissions. One of the greatest things that's ever happened in my 30 years in the trading business and options trading, one of the greatest things that's just happened, as you know, in the last month, Schwab threw a big shot over the bow and said, we're going to basically go down to free stock and ETF commissions and no more ticket charges on options. So you're only paying like a per contract rate, which is a lot lower than what you were paying before in your option commissions. This is a massive breakthrough for you and I as individual traders and investors, and says, okay, now we don't have to worry so much about commissions. We can focus on, does our system have an edge? Which, of course, I've tested this stuff through Metastock backwards and forwards across so many different securities, but the FANG names are really my favorite to trade because they're so liquid. So what I always tell people is, don't expect a straight up line. Expect there's going to be, these are month by month type of results, including all trades, winners and losers. And you're going to have gains, you're going to have losses. One of the encouraging things to me was that in 2018, our full year result up over $5,300, adding up all gains and losses before commissions. Like I said, never more than $1,500 in a trade. And we usually don't hold more than 2 trades open at once, never more than 3 at once for sure. And bottom line is that, okay, now through August, $6,100 in 2019. The bottom line being that I think we're just always looking at how we can be green and growing, getting better and better all the time. So I never assume that I'm at perfect maximum knowledge or perfect optimum system. I'm always tweaking to find that extra edge. Okay, so basic premise here is, I want to ask you, what type of trader are you? Because it depends what type of trader you are in the time frame that I think you should be focused on. Hit one of these numbers, 1 through 5. 1 if you're more of a day or quick trader, 1 to 2 days. The swing trader, 3 to 5 days. Number 2, hit 3 in the chat box if you're more of a position trader, 1 to 4 weeks. Or active investors can hit the number 4, 1 to 12 months. Certainly probably not a whole lot of just buying holders out there in the number 5 spot. Most of what we see is that, people say they're swing traders these days, some position traders, some day traders, not so many active investors and hardly any passive investors, which is what I'm glad to see. I don't want you to be passive in regards to your wealth, because the reality is, like you can be an active investor like Mark and CW. Great to see you, Frenchie, position trader. Bottom line is that you can be a little bit of each of these even, but the key is everything that I teach is about using the same methodology and just changing your time frame. So what happens here is that when I'm looking, and most of what I'm sharing with you, I'm about a 1.5 when I'm sharing with you today here. Probably an average of about 2 to 3 days here in this category here of data swing trading. I'm not really trying to be a day trader with this methodology. I'm using a 30-minute chart when what I'm showing you across these FANG options trades. For swing traders, 3 to 5 days, I'm probably going out to about a 60-minute chart. Just change your time frame in Metastock. Position traders, go out to your daily chart, 1 to 4 weeks away. Active investors, 1 to 12 months away, go out to your weekly chart. And of course, passive investors go to a monthly chart. And if day traders might even want to go down to like a 15-minute chart. I don't really like to go below that. You could, but I think the noise level starts to increase too much for any kind of trend trading approach. So just keep that in mind as we talk about these elements. Now, as I mentioned, so many have missed on the big move in names like Apple and all these FANG names. Really, this is a weekly chart. I'm not going to focus on the weekly. We're going back to 2010. We're going back to when Apple was hanging around $30 a share. Now it's at $270 a share at the close yesterday. You know, and you can see that it's been an overall general uptrend, although there's been some rough points. But what I think is interesting, what I'm going to share with you here, you're going to see it across all these time frames, is this green line on this bottom panel is the 14-bar ADX. Okay, I can't give away all the different settings across my FANG options trader system, but I can tell you that if you go into Metastock and plot this directional movement ADX, which is something that you don't have to have a toolkit for, the green line, use a 14-bar setting, which I think it may even default to that. What you'll notice is if you look at it across the window that I'm going to talk to you about today that you should be after, when the ADX is rising from a very specific pattern here, it's looking to catch that type of a steady, persistent run to the upside. So you look at another one of these here, there's one back there in 2014, you see where it peaks out here. It's not going to catch the entire move, but it's going to try to catch what I call the sweet spot of the move. Okay, so, and you see, it's got to be a very specific pattern here that we're looking for. When you see these things kicking in, you're going to notice that they don't happen all the time, which is why we use a 30-minute chart so you can be in and out that much more quickly, manage your risk that much more intelligently. You're going to see when you catch these little windows here of opportunity, these windows catch pretty vertical price action. You can see more recently, this wasn't really quite the perfect pattern on this rally that Apple's had. It didn't come from a low enough level, which we're going to get into, but it is a rising green ADX line. So if that green line's rising right there, that means that you're in a trending environment. And then the two other lines, the blue line's a positive directional movement. Of course, that's your net new highs. We're going to get into that in words of what that DMI plus means, and also the red negative DMI means how much new lows you're making. Not much with Apple, right? That's why that red line's so low. So we're going to share with you more about what this ADX indicator is all about. I didn't develop it, Wells Wilder did. But the idea is that we use a lot of platforms. Obviously, we're focused here on Metastock and all the things you can do in Metastock. Bottom line is that, that when we add in the DMI lines, we add in the ADX, which is based off of this average true range, which we're going to talk about what we're measuring with that. Along with the moving average filter, again, I'm not going to get into all that today. It's about narrowing your focus down to the opportunities that are going to kick out of this funnel and give you positive cash flow dollars. If you're not getting a net positive out of all of your results, then you need to go back to the drawing board, and it needs to be significant enough to make it worth your time and investment, right? So the idea is this funnel is about narrowing that to your best. Here's the daily chart on Apple, by the way. We're going to get into an even shorter term one, but the reason I want to point out the daily is, in addition to the bullish patterns that you see happening here, you see that one here where ADX is rising until about this window right here. So just in that little sweet spot there, it's rising through this little phase here, catching that first little kickoff through that phase there. But the other thing is that look at when it goes negative, when the negative DMI is above the positive and the ADX starts rising from a low level right in here. This was October last year. You know what happened October, November, and December last year, right? We had the into the Christmas Eve massacre, where basically the stocks got just pummeled on the downside. You saw what happened to Apple, right? Apple got pummeled too. So that's the point I want to make to you, is that it can be negative as well as positive, and you just need to know what you're looking for. Really, the first leg down of that until the ADX rolled over would have been our sweet spot of catching this first really fast decline. But you saw the ADX stayed high, the DMI line stayed net negative, and you could make some good downside money. Of course, it's been mostly positive, including the latest this October. Everybody talking about another repeat of last year, not so fast. You get a bullish setup, the positive DMI above the negative, and you get a situation in which you've had a steady, persistent charge to the upside, especially through that first phase. This latest phase, look at what ADX is doing on the daily chart. It's going down. Does that mean you should be bearish? No, it just means you shouldn't be betting on a trend move here, even though we got a nice snapback this past week after the gap down on early in the week. It shot right back up to a new high yesterday. But I'm not buying into that on a daily chart. I'm not buying the new high there because the ADX is actually not trending up. So, but the point is, I can still trade around that. There's all kinds of different time frames, and there's all kinds of different sort of edges you need to know about how you create this opportunity. So let's talk a little bit about the directional movement lines. and we'll get into some of the shorter term work that we do for the quick trade, 2 to 3 days usually on this big trends approach. So DMI stands for Directional Movement Index. Some people might call it Directional Movement Indicator. Wells Wilder's the same guy who invented the RSI indicator, the Relative Strength Index indicator. If you haven't heard of Wells Wilder, you should look him up. He's one of the guys I studied early on in my trading career. He's been around and had work out there for decades on a very cutting edge kind of systems that have an advantage. Wilder's contribution in this particular case, he's had many, would be that the true range. He said, most people think of the word range as just the high-low range for the day or for whatever bar candle you're looking at, right? The idea that Wilder said is, if you're looking at a true range, it should include the amount of the gap from the previous bar. Now, this is more relevant for your daily and weekly charts than it is for an intraday chart, unless you're talking about coming into the open for a new day. But the gap kind of kicking off the next new day of action has to be included. So if you get a positive gap, you're talking about a situation in which, okay, you're not just looking like just a quick little example here, your classic open, high, low, close chart. Then the next day looks like, say, your classic doji, right? Your open and your close are about the same. And most people would say that the range of that second day, let's call it R, would be here. And Wilder would say, oh, not so fast, you're missing out. The prior day's close was back down here. So our true range needs to go from the high down to the prior day's close on an upwards gap. So the true range in this example, you can see, is more than double what I've drawn for the traditional second day's high-low range, right? So the true range is going to encompass more total movements than a typical just high to low day-to-day calculation. And that's important because you start to really pick up what the overall bias is in terms of upward gaps or downward gaps. In an uptrend, you would expect you're going to get more upward gaps than downward gaps, right? So it's going to allow you to see that more clearly with the total true range. And then Wilder said, create the average true range of a day-to-day true range, say, taken over 20 days, gets you a 20-day ATR. Looking at the last 20 days, average true range kind of averaged out bar by bar, just like a moving average, but now on an ATR basis. So now you're seeing that total movement you're getting across the last 10 days, 20 days, 50 days, 100 days. So you can start to gauge that and say, okay, how much net new movement are we getting in the face of a recent look back period? So are we making higher highs? That's going to show that positive DMI going up. Are we making higher lows? Then the negative directional movement, which shows you how much new lows you're getting, is actually going to be going down because you're not getting any new lows in traditional uptrending definition, right? Your DMI minus is going to be going down. Your DMI plus is going to be going up. When that happens, that's what's going to help pull the ADX higher. Now, here's the 30-minute chart from Metastock from an intraday time frame, and this one's looking back to the prior month or two, looking back into early October and early November. And you can see the same thing I'm sharing with you. What we're looking for is where this ADX green line has been too low, and now it's starting to cross up above one of those, in this case, declining directional movement is the negative directional movement in red, the positive directional movement in blue. You know what's happening there. We're getting an upwards gap on Apple right here. Our system is saying as long as that ADX keeps rising, this is a bullish trend. You can see that lasts for 2 days. Starts on October 4th, gets you out. That's a Friday, gets you out the next trading day, which is Monday the 7th, in that afternoon, right after the middle of the session on that Monday the 7th. Now, we're not trying to trade every ADX upturn here. We're not trying to trade it if it doesn't fit our profile, which says that ADX has to get low enough to then be below both of the DMI lines and then start coming up. Another great example of that happens back here October the 18th. Right near the end of the day, we're getting a bullish signal right before it gaps up the next morning because we're getting that cross and that green ADX coming up. So you want to find a period where it's been sleepy, it's been slow. People are giving up on trading that name because basically we're looking at a situation in which people have given up and now they're coming back into it. And Donnie asks, I've heard ADX above 20 equals trending. We don't look at it so much in levels as we do in which direction that green ADX line is headed. If that green ADX line is headed up, then it is the definition of trending. Obviously, we want it to be headed up from a relatively low level. So we think there's a lot of meat on the bone, if you will, of people kind of lost interest, and now they're going to come rushing back in this case, to the upside on a positive type of a situation here. So, so from that perspective, you say, okay, we're definitely looking at a situation here in which, you know, that's an uptrending situation. Where's it over? Based on the trend work, if it flattens out, I'm not that worried. But if it rolls over, that's where I'm definitely going to say I'm not interested anymore. And you'll see sometimes that'll get me out maybe a little too early in retrospect, right? Because then it kind of cools for a little bit, then it rallies some more. So I missed part of that next leg of that move. I don't care if I miss part of a move. What I care about is the consistent sweet spot, high probability opportunity that gives me. Where's the last signal here on this particular chart? Look at where it's happening. I'll put a box on the bottom right. It's where that ADX is crossing up here early on the day on November the 4th. You look at this chart and you say, you've already missed the shot up there, Price. You go through a couple hours of a flat line here, and you say, you know what, I'm okay with that because it's still in the uptrending phase, and that green ADX line keeps on rising throughout that day and into that next Monday, and we go from the 252 range up to about 257. You know, so 253 to 257. You know, and you only need, I mean, 1% on Apple can be good for a 30%, 50%, or even more kind of a gain in the underlying options that we'll trade. So we're usually going to be about 30 to 51 on Apple because we like to buy them more in the money on the options. We'll get into that too. But ADX, just real quickly in words here, average directional movement says, you know what, this is going to show you that, you know, ADX is going to be measuring essentially, are we in that trending kind of a market that I just mentioned to you, where if the DMI plus is going up and the DMI minus is going down, then you know what, as those two widen out, you're going to see that ADX is going to start going up. Because it's going to say, hey, something's really happening here. If you're in a situation where there's not much new highs and not much new lows, and you're just chop city, the ADX is going to be going down. There's not going to be any clear trend there. If you're in a downtrending situation, you can get ADX going up as well, and just the directional movement negative will be going up a lot more than, and the directional movement positive will be going down. So it just flips it around. So the idea here is that, say, divide that directional movement into the true range, and you get a percentile basis. So ADX can't go above 100%. You know, that'd be like perfect positive trend type of efficiency with no retracements at all. But the idea is that, you know, we're looking for those, you know, good trending phases. This is actually now bringing Apple up to current. You know, this is, when you look back at Apple, even over the past week here in December, you say, well, it looks like it was downtrending here right as we kicked off December, right? And you would say, you know what? Technically, that's correct. ADX going up, it's downtrending, and you see it downtrends, then it kind of pauses, and then the gap down happens there on Tuesday morning when the talk of, you know, the China deal not happening, you know, et cetera, Apple affected by those tariffs. Yeah, sure, that's the case. But the bottom line is that it's not at a low enough level for us. I want to see that green line down in this area here. It doesn't have to be necessarily below a certain number, but I want to see it below it, then head up. That tells me that we've got kind of more of the ideal profile. You saw one of those happen back here on the left. You saw this little hook down and back up here. That was November the 11th, and you see what's happening from there. You know, an okay move, not a huge one, but, you know, catch a piece of a move there. And that's the thing, you know, I'm not claiming to be perfect. I think actually when I got started trading, probably the biggest mistake I made was perfectionism. You know, I came from a great, blessed with a great educational background, graduated from Duke University in '89. You know, so I've been in this game now 30 years. And the bottom line is that I thought I knew it all early on. I thought, you know, and that would be the temptation now, even after 30 years, to think you know it all. I never want to think that way. If you lose your humility in this game of trading, fly too close to the sun, you're going to get burned. You know, the fall of Icarus, right? It's like, we don't want that. We want to stay humble. We want to stay focused on what's our edge. So another one here you can see where we get a little cross happening right there on the 15th, and that's a decent little move because we're just trying to catch it through the phase until ADX rolls down, which happens the morning of the 19th. At that point, you're out of the trade. But in the meantime, look what you've gotten. You've got a nice little block uptrend there. And you know what I tend to say is, I know a lot of people hear that, oh, why should you use an indicator? Why not just trade price action? Price action is pure. Indicators have lag. All these things get thrown out about why indicators are bad and why price action is good. And I kind of go the other way with it, which is that there's a lot of noise in the looking at a bar by bar or candle by candle mentality. If you look at a candle by candle mentality, what are you going to do when you get the bearish engulfing bar right here on Apple in the midst of, it's right back to or just below where you got in? You're going to get out because you're going, there's the bearish engulfing pattern. I better get out. And then you're going to miss the next run up, right? So, I've always said one bar or candle doesn't make a trend. And I think it's important that you kind of keep that kind of focus of letting the indicator tell you, hey, the wind's at your back. If you're sailing, you want the wind at your back, right? When the wind's at not your back anymore, you've got to make some adjustments. And that's how you have to think as a trader. So catch your sweet spot in this. Don't get sort of faked out by one little bar price action against you, okay? So you can see what just happened here on Apple. We just had another cross on the ADX right on this move out on Thursday morning. And notice when you get into this one here about 264.5, you're wrong on this trade by about $1.50 down to about 263 the next bar, the next 30 minutes. Now, a lot of people, again, would panic on that first bar against. And I'm saying, you know what? ADX has not rolled against me. It's just kind of flattened out, but I'm still staying with that trade. It essentially fell back to that prior day's little bit of resistance and tested it before it kept going. You don't know when you put on a trade what's going to happen next. If you think you know what's going to happen next when you put on a trade, you are destining yourself for failure in trading. I can't say that strongly enough. That if you think you know what's going to happen with perfect certainty, you're going to get stuck in trades. You're going to think it's supposed to go up. It's not. What's going on here? You're going to say, okay, then therefore I should get out. Then therefore I should hold and hope. It's like saying, no, we still know we have an edge. We want to take advantage of that edge. It's interesting that only into the end of the session yesterday did we start to get a flattening. It has actually not rolled over on this one yet. So technically you'd still be holding the Apple bullish position from the Thursday morning signal there. So again, we've gone from we were wrong initially, 264.5 to 263, but now we're sitting on something that's up about $6. And if you buy an in the money, like 260 strike call to basically say, okay, we can take advantage of a situation that can go up, 50 to 100% quickly. If we get a double in a trade, we take it. Sometimes we get lucky and it gaps more than a double the next morning. So if Apple gaps up big, Monday morning, we're going to be in a position where you say, okay, that's a double plus, take it and run. So the idea here, though, is what kind of options you should trade. It's like, do I want to buy this house in Florida? I'm in Kentucky where it's cold right now, like the snowbirds from the Northeast, saying, okay, you want to go to Florida or California or somewhere warm. Florida is where most of them flock on the East Coast because you say, okay, that's a warm spot to be. But I don't want to own that house in Florida for the whole year. I don't want to own it when it's sweltering in August and September and have to deal with all the carrying costs of that. I'm willing to pay a little bit of a premium to rent it out in January or February and not have to worry about it the other 10 or 11 months of the year, right? So the idea here is that why would I buy and tie up all that capital when it's cheaper to rent? I can have the asset for when I want it and be done with it for when I don't. It's the same thing with options, and so what we do is we like to, where we can, buy an in the money option. We can do this on Apple and Facebook still, to go pretty in the money and not have to pay a lot of time premium. What's happened with Google and Amazon and even Netflix to a smaller degree, Google and Amazon are over $1,000 a share. So that means you're paying more than $100,000 to control 100 shares of Google or Amazon. Well, we don't want to pay more than $1,500 on any option contract. So we end up going a little bit out of the money with Google and Amazon now. Our leverage potential on Google and Amazon is thus usually a little bit higher, but we've also got to manage the trade a little bit closer. But where we can, here's Amazon, by the way. You can see it's finishing in about the 1,800 level. They've got it cut down here by a factor of 10, but you buy 100 shares of Amazon, it's going to cost you over 180 grand. So the idea here is that, if you're looking at a situation in which, what did Amazon just recently do here on the 31st? This is back in October, November. We'll look at the current chart in a minute. This one's giving a signal right off of the open right here. And you can see this one was a little slow at first. It just stayed flat that whole day after we got into the trade, even a little bit against us. But you see what happens, the ADX flattens out, but it doesn't roll down, and then it shoots up the next day. Now you're into a profit territory. Now, it does roll down later that afternoon, that second afternoon, You're not going to make that much money on that trade because you got to pay some time premium on Amazon. So that's going to be a roughly a scratch. If it's not a slight positive or negative, it's about a scratch. But here's one looking back, October 15th. See Amazon launching here, and then it just goes vertical. That's where you make a lot of money real fast on Amazon because it's just going straight up. So the point is, I don't know which of those it's going to be. I just know that I want to trade all those signals. It's a probability game that we're after. We will not take a bearish setup like back here because Amazon will not have broken our moving average filter. We got a moving average underneath this thing where basically we're going to be staying with that upside if that is staying above its moving average. I didn't bother to plot that here because I'm not going to give away all the settings. When you become a subscriber, you get all the settings to plug in on your Metastock and follow along. Now, why do I love weekly options, especially on these higher volatility stocks? This has been an evolution for me. When I started Big Trends back in '99, we just celebrated our full 20th year anniversary this past month. Started mid-November of '99. I used to tell people, look, just buy a deep in the money option where you can substitute for the stock and not have to worry about time loss. So in the old days, I would say, well, Humana is my preferred play because, if I've got the stock at 300, I'd say a 292.5 call, that's 7.5 points in the money. I'm only paying $9.40 for it. So I'm only paying like $2 out of that 9 as time risk, and thus I'm getting about an 80% delta. Those who are new to options, delta means when Humana goes from 300 to 301, my option should go up about 80 cents on the dollar from 9.40 to about 10.20, and I'm getting a nice leverage, obviously, by paying a lot less for the option than I am for the stock. And you see, though, that if on the Netflix example, it's trading a little above 300, 332, but if say a 5 point in the money call is actually costing me almost $10, $9.50. So about half of my option is time risk. That's a riskier trade, right? Because I'm only getting a delta of about 60%, not 80. And yet it's the preferred trade now. Why? Because the ATR, what I just mentioned earlier, the average true range on Netflix is almost double what it is on Humana, 4.25% versus about 2.25% on Humana. So you break it down as a percentage of the stock price, and you see that's like a 14-point move for one ATR move on Netflix, $6.80, about $7 move on Humana, about half as much on Humana. Now you see, if I get a one ATR move in my favor, Netflix moves 14 points in my favor, I make 89 2/3%. If Humana makes a one ATR move, I make 57.8%. So I'm getting about 1.5 times more profit per ATR on Netflix than I am on Humana. The risk is it works both ways. If I'm wrong, if I don't have a directional bias and it goes against me, then yeah, it could go more against me on Netflix than Humana. That's why the trend component, in my view, is so important. So now we look at Amazon to current, and you can see Amazon was just setting up for a nice breakout here right around right before Thanksgiving. You see it was setting up, starting to cross right into the morning of this gap up here. So you see it gives you that signal right at 10 a.m. We get a lot of these signals around 10 a.m. because of early day gaps. We went for the first half hour's close on a 30-minute chart. Stock's about 1770, and you can see that it flattens out, but it doesn't actually roll over on ADX until late in the day on the second day here at about 1790. It's about a 20-point move in your favor. We missed that last little leg up, but we also missed that shot back down. You see this latest move here, it looks like a bearish setup right here, but again, it was above the moving average. We're not going to take that if it's still holding the moving average, which it barely was. So, bottom line is that it allows us to focus on where the opportunities are. I've got more to share with you, so I'm going to have to keep it moving fast. I want to give Jeff a few minutes to talk about our Big Trends toolkit as well. But weekly options now, every single Friday has got a weekly expiration. So why would we buy more time than we need? We usually will not buy the same week, though. Like coming up this week, I won't buy this coming Friday's expiration options this week. I'll go out to the next Friday. So when we're sitting there with an expiration this December the 13th, this coming Friday, and we're starting off on Monday, I usually go on out to December the 20th. This gives us a little more time to work with. And the only time I'll not do that is if they've got earnings coming out 2 weeks from now where I might stay in the current week. I'll never hold anything with just a couple days to go till expiration. I usually want to have at least 4 or 5 days before expiration. So you can take advantage of the reaction after earnings. We don't buy these right in front of earnings. We take advantage of these afterwards. And we just talked about Amazon. So basically, we've already talked about that one. So let's keep it moving here. Basically, risk management is important. So in addition to the ADX rollovers, one of our exits, we do use a trailing stop. once we get to a gain of usually at least 30%. So 30% or more, I'm usually moving my stop up to break even versus starting out with about a 25 to 30% stop on the against me. So basically, I want to make sure we're managing. So let's talk. Here's Facebook. Hasn't been as much action on Facebook here lately as we would like. You can see that, there's even a couple of whipsaws. So let's talk about what trade that didn't work. Late October, it looks like a really nice and early gap on Facebook in your favor right here. You see the cross happening right there. You see it's basically finishing up here in the neighborhood of about 197 on that first breakout. You say, that trade's clearly not working in retrospect, right? And you can see the next day it's going to stop us out here down in this level about 192. We're going to get stopped out before it hits that ADX rollover by our trailing stop. We're going to end up taking 25, no worse than 30% drop against us in that first hard flip down. Usually, because of Facebook and Apple, we can buy more in the money. We usually have about a 2-point cushion or so on the stock before we start worrying about getting to about a 20% to 25% loss, about a 2.5-point cushion. The way that we set up those in the money options. So usually when the stock's trading, say at 197, we're going to be buying something like a 192, 191, even 190 type of a strike price deep in the money. So we're starting to substitute more for the stocks. We don't have a lot of time risk. But, at 2 or 3 points, about the third point against us, it's our trailing stop's usually going to get triggered on that kind of a trade. So you can see, unfortunately, that one didn't work. But, bottom line is that what's interesting is it just gave a signal here late on Thursday. You can see it's just crossing up here at about 199. And then we got a nice rally finish about 201. So it's up a couple bucks so far on that signal. Flattened out a little bit into the close, but didn't roll down yet. So we'll see what happens on Facebook come Monday. I don't love this one as much because you know what? It's got the old high sitting out here at about 204. And so I would rather be buying breakouts to new highs than stuff that's got to battle an old resistance level like that. Because the breakout to new highs, you're going to have, like Apple, you're going to have a situation where you don't have any natural resistance overhead. Nobody's bought it any higher. So you got no natural sellers and just institutions going, gee, I wish I was a part of this. You and I as individuals going, I wish I was a part of that. A lot of inherent buyers. What our typical trade alert looks like, this is an older one from the summer, but we'll say BTO means buy to open, not Bachman Turner overdrive for you rock and roll fans. Buy to open the Amazon whatever option at whatever price. In this case, $14.90 or less means $1,490 to control 100 shares of Amazon when it was trading up near $2,000. So a couple $100,000 worth of stock you can control for $1,500. So that's like that 100 to 1 plus leverage. And then when it's time to get out, we say STC, sell to close. Let's get out, move on. Alphabet, of course, Google's parent company, but we all know it as Google. You can see gave a nice launch there right here in October. A couple of them actually. You can see there's one where it's really launching out. This one only lasted for a day, and then by the time it rolls over the next day, you end up giving back your profit. Okay, that can happen that next morning. By the time it shoots down, we're going to end up losing on that trade if we weren't able to get a first target profit. I hate it when that happens. It can happen sometimes. I just try to show you things that can happen so you know not to ever get too greedy and not overcommit your capital. We'd rather see you taking very small dose positions, 5%, no more than 10% of the money you'd allocate to trade the service. You see this one looks like a start of a nice steady little run in early November. What about the more well, we'll look at some other charts here in a minute, but some of the key elements of this, we'd like to buy them in the money where we can. We want to have that catalyst of that big price gap typically. And that's the thing you have to get used to is that catalyst of a gap in your to the upside, let's say. A lot of you that say, oh, I'll wait till it comes back down to buy it, mistake. You don't want to be on it when the momentum is gone. You want to be on it when it's just picking up that momentum and the institutions are saying, I'd like a piece, thank you. Everybody is looking for how to get some outperformance against the index, especially if you're an institutional manager. So they're going to pile in there, then they're going to pile out, right? So you don't want to get in when they're piling out of it. You want to get in when they're just starting to pile into it. Like I said, our profit protection kicks in once we've got a 30% gain. We'll ride till ADX rolls over until that trailing stop gets hit. And we send out real-time emails and text alerts to your smartphone to know exactly how to manage that. At a double, we'll say thank you very much. We'll take the money and run. We won't keep staying with an ADX signal because we don't want to give up that double plus. If you've got 10% of your portfolio and in a trade and you make a double, that means you just made a quick overall 10 percentage points on your full portfolio. So you take a $100,000 portfolio, you take 10,000 into a trade, you say, okay, well, I made a quick 10,000. Basically, you just made 10,000 on your 100. That's a 10% gain for the year on one trade. So and you can break it down to a smaller level as well. So bottom line is that, it's really nice to be able to do that. We're not a black box system at Big Trends. We give you weekly video training. So you get to see and I do that every week because I like sharing what is happening with all of our FANG Options Trader subscribers, updating all 5 of those positions, and what our view is on those going forward. And this actually is not Apple, this is Alphabet here from the Metastock platform. It was pulled last night. You can see more recently that, we've had an uptrending profile, but it was coming from too high of a level. So there's not going to be a signal here, even though it is indeed showing an uptrend in ADX. We're not going to take this bearish signal either because when it's been relatively strong above the support and the moving average, this potential setup gets X'd out here because we don't see an opportunity when it's got a longer term uptrend. So we try to line up the short term trend with the longer term trend to make sure that we're on the right side of both. I forgot to update these titles here. This is Netflix actually up here. But basically you see Netflix, everybody's been down on Netflix for the competition that Disney's bringing, but you can see Netflix has been kind of gradually grinding back higher. You see the one really steady move here on ADX, it was coming from too high of a level, so we didn't participate in that. And this other one here was above the moving average, so we didn't participate in that downside move. You say, well, gee, you missed out on a couple of trades. True, but you see by the time it flips and ADX rolls over, you're not really giving up that much. So we're picky about making sure that the profile is just right in what we're looking for. It's interesting though to me that when everybody was panning it, remember Disney launched right there in the middle of November, right about where this stock Netflix starts to rally. So don't get caught up in the conventional talk on the TV or in the media about, oh, well, Netflix is going to get their clock cleaned by Disney. Yeah, it's been beat up already earlier in the year, but by the time that rumor of Disney launching is now a fact, come mid-November, Netflix has actually rallied. It tells you that there's probably space in this whole streaming universe for both of them to potentially prosper. But there's going to be ups, there's going to be downs, and our job is to tell you where we see the next really nice chart opportunity on this. So as I mentioned, if you came in late, our full year 2018 result was up $5,393, assuming you put in no more than $1,500 into a trade, and you followed the instructions of when we told you to get in and get out. And this can actually be auto traded across a couple of options focused brokers. So we actually use the auto trader entry and exits for our entry and exit prices. So they're real world prices and not just something that we're taking some optimum price in or out. But this includes all winners and losers. See our 2019 result through the end of August. Sorry, I didn't get a chance to update it. It was up 6,100. Still looking good. So bottom line is that you can really take advantage of this. And you see what the equity curve looks like. It's not a straight line month to month. You can get give backs, but when you catch the run up, the whole goal of this system, like any trend following system, is win big, lose small. So when we can make a double, and then typically our stop might be 25 or 30%, you can see that you can win a lot bigger than you can lose. And then that's where you're going to really get paid in any kind of a trend following methodology. Past performance won't guarantee future results, but I really have a lot of confidence in this methodology, to the point that I'm going to offer you something that I usually wouldn't offer to an outside group, not only because Metastock's been good to me, but because I think you're going to love it so much you're going to want to stick around. Usually people pay a couple grand on this a year, and usually the best I would do would be a $99 monthly rebill. But what I'm going to do is, when you go to bigtrends.com/FANG options trader here, I'll type it in real quick, bigtrends.com/FANG options trader. This would usually be our monthly auto bill for $99. I'm going to give you a coupon code today. It's going to allow you the ability to get it, try it for 30 days for just $39. So basically what you do is you go to FANG options, bigtrends.com/FANG options trader. It'll show $99 at first for a 1 month try for the first 30 days. But what you're going to notice is when you click on the add to cart button, and what I'm going to do here is, I was trying to make sure that this was working. Let me go back and click on add to cart again. Basically when you click on that add to cart button, it'll pop in that $99 price for the next 30 days of all of our FANG option signals. You should see about probably 7 or 8 trades in the next 30 days, give or take. But what I want you to do is type in here this FANG 39 code. So you got to do all caps, FANG, and then the number 39 right there for that coupon code, and then hit apply. And you should note, there it goes, $60 off for the first 30 days. It's just 39 bucks. Now, if you like it after the first 30th day that you're in the trade, in the service, then it will auto bill 30 days after you sign up for 99 bucks, which is still a discounted rate from the normal 199 on our website. But bottom line is that that's what it turns into. So if you don't like it, tell us in the first 29 days that you don't want to continue, and you won't get billed again. You can also get lifetime access to my weekly options boot camp, which is actually 3+ hours of training for just a one-time $100 add-on. You would still get billed the $99 for the trade alerts after 30 days, but you'd be able to lock in that training as well. So consider that. But basically, all you have to do is, if you just want to try it for $39, let that hit that green checkout button or the PayPal button, and go on in and get your information in. By the way, at the bottom there where it says note, customer note, you can just say you saw with me here, or put the webinar thing in there. But customer note, if you want to get the alerts texted to your smartphone, not just get emails sent, but also alerts to your text, you can say text alerts to whatever your number is, and then tell us what provider you use, if it's ATT, if it's Sprint, if it's Verizon, and we'll set you up for our text alerts as well at no additional charge. So you just review the terms and conditions. They're spelled out in full here. It is an automated renewal program, so that's pulled out from that to help you see how that works and how you can cancel it if it's not for you. But I think you're going to like it so much, you're going to want to continue at the 99 bucks after the first 30 days per month going forward. But bottom line is, review that, hit the submit order button. You get it for 39 bucks for just the first 30 days to try it out. We don't do free trials of big trends, because what I find is that people that try stuff for free don't put anything into it. By investing just a tiny $39 one-time the first 30 days review period, you'll make a little commitment to yourself to check this out, follow it through, and see how well you can be taking advantage of these FANG names on Facebook, Apple, Amazon, Google, and of course Netflix. So bottom line is, I'm going to hand it back over to Jeff, but just a reminder, go to bigtrends.com/FANG options trader, and that's where you can take advantage of this unique holiday special I'm giving you. Instead of paying 99 bucks, just pay 39. Try it for the next 30 days. And you'll also, by the way, when you sign up for that, you'll not just get the trade alerts, you'll also get, if you add on the boot camp, you can do that. But if not, that's okay. You'll get unlimited email access if you ever have questions. And we also, even for $39 trials, will honor you getting the rule sheets to know all the settings that you need. And you can even set up the auto trade with our auto trade brokers. If you want to have them automatically implement the trades for you, you never have to lift a finger. So you can call us at our 800 Big Trends number on the top right there, 800-244-8736 if you have questions, or you can email us over there through that client care at bigtrends.com email address as well. But just remember 1-800-BIG TRENDS if you want to reach us at any point down the road. Jeff, I want to hand it back over to you so you can also share with people all the work that you and I did together to create the Big Trends Toolkit. And I want to thank you for including me in these awesome Metastock summits.
All right, thanks, Price. Appreciate it. Appreciate all the context and stuff like that. Let me go ahead and switch the presenter view back, and let's just talk a little bit about Price Headley. So as I said before, we've been working with Price. How long we've been working with you?
Gosh, at least 15 years. I want to say maybe 20, but at least 15. Wouldn't you say?
Yeah, it's been great too. I feel like we're friends at this point, and maybe even family. So, in any case, to kind of give you a little bit of history on the Big Trend Toolkit for Metastock, we're in the third version of this. And I remember this was kind of like one of the first really big projects I took. I'd come over from inside sales into business development for Metastock, and now I'm kind of like the director of sales, but this is the first kind of big project that we took on. And I remember I talked to Price, and it's like, hey, we have this really cool software program. It can help you scan for the setups that we're doing. swing. It can tell people exactly how to trade them. It can test and go in and kind of help you identify which stocks work best with any particular algorithm. And at that particular time, it was a bit of an unproven model. I took the business over, or took the idea over to my bosses over at Thomson Reuters at the time, and they said, we're not going to do it. So I said, I didn't take no for an answer, though. I actually coded the very first version of Big Trend Toolkit, and it has been one of our most successful add-ons that we've ever kind of released, so much so that we, about 6 or 7 years later, actually developed and designed out Big Trend Toolkit version 2, and then Big Trend Toolkit version 3. And it has been very, very popular. It's been well rated. It won awards in Stocks and Commodities magazines. I don't remember exactly the ones, but it was a project I was very, very personally proud of because of all the actual effort and work that I put into it personally, and then just how well it did. And one of the things I love about Price and kind of is the fact that he likes to go in and he loves to say, there's 3,000, 4,000 optional stocks that exist in the market right now that are optionable. And as an option trader, there's opportunities everywhere. I've always focused my research, talking in the name of Price right now, on finding the best opportunity at the best time. And his work is a collection of that. If you haven't read his book, Big Trends in Stocks and Options, I believe is the correct title name. It's a great one. You should go ahead and pick it up. So over the years, we've included a lot of methodologies. We've tried to encompass all of Price's work. You can kind of see a list of the methodologies and how they work down. With version 3, one of the big things is we brought together a score matrix. And I'll show you kind of how that works on a chart, actually. But all in all, it's about a collection of 17 experts, 17 explorations, 17 systems tests, 15 templates, and 18 custom indicators. And what I want to actually do is, let's go ahead and jump into Metastock. Hopefully I still have an online connection. And what I'm going to do is I'm just going to show you a little bit real quick on how these kind of interface on a chart. So let's go ahead and open up Apple, aapl.o, and I'm going to go ahead and just go in, and I'm going to attach what we call a template, which just defines what indicators are in there. And what I'm going to do is I'm going to go in and find the BTT3 system. So all of these that are labeled BTT3, that means Big Trend Toolkit 3.0, are going to be right here on the chart. And what I'm going to start with is we'll just do the Big Trend score system. Okay, so I'll go ahead and open up the chart. I'm going to zoom in a little bit on it. Wow.
Oh, then go to webinar center.
Hey, Ed, I'm going to mute you real quick. Okay. All right. Okay, and we'll just go ahead. I do believe the data is already loaded. Yeah, it is. It's just a little bit back here. So this is Apple. This is kind of what you would get if you were just following the Big Trend Toolkit score system. And what the score is, what we did with it is we took a collection, and I don't remember the exact number, but it'll tell me here in just a second when I open up this commentary window, a collection of Price's favorite indicators. So the Williams percent R, the CCI, the efficiency ratio, the acceleration bands. You see this because I'm reading it out of the list right here. And what we decided to do was figure out if they're bullish or bearish or neutral. And so for any particular time, we give it a score. Right now, if we're looking at Apple right now, the score based on the combination of these indicators is 40. Okay, and if it gets high enough, what we do is we issue a buy or a sell signal. And you'll see that on the chart because right here, it's a buy signal. When it comes back into these bands that we've drawn on the chart, it's going to give you an automated exit signal. Okay, and what I'm going to do here is I'm actually going to move this commentary and what this commentary is saying from this day over to where we actually initiated this buy. You'll notice there was a setup right here on the bar before. So let's actually start there real quick. So here is a setup. And what the commentary is going to say to me is the Big Trend score is a combination of 10 of Price's favorite indicators. Each of these BTS indicators can be found in the Big Trends guidebook. Traders should look for a score of at least 80 to confirm a long position or minus 80. For long positions, traders can look at a trade above the previous bar's high to confirm a long trade, alternatively for short positions. So in a nutshell, what it's saying is we have a score of 80 now. enough of the indicators are bullish, and you can see exactly how many of them are bullish right here, to give us a buy position. If this goes up above the high tomorrow, we're going to buy it as soon as it does, which is exactly what happens on the very next day. I'll move to the next day, and you'll see, right, everything still looks pretty bullish. A few things have moved back down to neutral, but here it's saying, okay, we're getting a confirmed entry signal, okay? And one of the things I like about Price is kind of the thoughts that he put into the expert commentary. So, for example, going to zoom in on this. If you're interested in taking advantage of this opportunity, you could look to buy the stock or buying an option 2 months before expiration. Aggressive traders will typically look at call options one strike out of the money or near the money that costs $200 or less, while conservative traders will typically consider the call option with more intrinsic value, usually one strike in the money. Traders should look to exit this position when this happens or when this happens. And yeah, I got tired of reading. But it's being very, very specific. Here's why you're getting the setup. Here's what we're going to look for to get in tomorrow. Here's what exact options you should look at. And if we had a little bit more time, I'd open up Option Scope. We could go in and look for the exact option. But here's the exact options you should be looking at buying. Here's the moneyness, how far in or out of the money you should look. And here's when you should look to get out. So that's available for all 16 of those systems. In addition, we'll show this in a little bit. Maybe Ed will cover it, but we'll definitely show scanning because I think it's one of the best parts of the program. In addition to all of those 16 systems that were kind of on there, you can scan for. It'll give you this big trend score as a combination of any of those, so you can rate them by how bullish or bearish they are based on our scoring methodology. And you can even go in and, using our system tester, go in and perform a system test to see exactly how well they work. So it's a very, very cool toolbox. There's definitely a reason that's been so well received by our database. And I just love it. I love the mentality and the methodology and just the Price's willingness to skip stocks that are going to make a little bit of money to find the ones that make the most amount of money. It's something that I picked up from him, and I would consider, I talked about how Price is a friend or a family member of mine. I'd consider him a bit of a mentor too, because a lot of the things that he looks for in the market are the same things you should look at professional. And by that I mean, like, why focus on the small opportunities when you can look at the big opportunities? Just so much well thought out ideas for it. So included in this, and then we were able to show you the system tester and the expert advisor. But in this, you're going to get 17 of his methodologies, the system tests, the ability to scan for them, the templates, 18 custom indicators are exactly the way Price wants you to look at them. And all of that's available for a subscription price of $49 per month. And what we're going to do as part of our summit special that we're running today is if you buy 1 month, we're going to give you a full 3 months to evaluate it. So that's with all of the offers today. If you do an evaluation of them, we're going to let you play for them for 3 months. And I was thinking about that this morning. That's pretty awesome because right now it's December 7th. A lot of people have some downtime. Maybe they take a little bit of a holiday. It gives them a chance to look at the market. You have plenty of time to do that. In addition to that, January is usually a really good time to trade. If you do the package offer, if you sign up for any of the add-ons today, you're literally going to, for the price of what you would normally pay every month, you'll be running it till February, March, April 7th. So I'd encourage you to do that. So it is part of our Summit package as well. You can get Metastock Real-Time, the software that's been rated #1 in its price category for 25 years in a row. You can get the Zenith News Data. It's a news service that Thomson Reuters, now Refinitiv, spent $1 billion on it. You'll get the Knoxville Divergence, the Big Trend Toolkit, the Fulgent AI, which Ed is going to talk about here in a second. You'll get setups and timing triggers. We'll help you. We actually have somebody that will give you a call and help you get this installed and make sure you understand how to use it. So you'll get that white glove installation is what we call it. You're going to get our training DVD that is called, actually it's not a DVD, let me correct myself. You get our online training that's called Unleash the Power of Metastock that walks you through some of our favorite systems and how to do everything. and you're going to get 2 years of Stocks and Commodities magazine. So normally all of that, if you bought it all separately, would be $17.44. We're going to save you almost 50%, $848, and give you a package price of $896 today. Okay, so to take advantage of that, 800-882-3040, or visit us online at metastock.com/saleschat. And we're not doing too bad on time. I do want to say thanks to Stocks and Commodities for sponsoring the event. They're awesome. You should take advantage of their free trial issue. We'll go ahead and make sure that this link gets put into the chat when I get a second. And let's go ahead and talk a little bit about Ed. Ed's another person I've used. This is the multiple decade event today. Ed's another person I've known for, forever. He gave me, but we haven't talked for a while. But he's been in the industry for a while. He gave me a call in January. He's like, hey, I've been working on all this artificial intelligence stuff, and I want to kind of take some of the technologies that we've designed and put them into Metastock. And I was like, that sounds awesome. Let's do it. And so he created the Fulgent AI. He's going to talk to us about trading options and stocks with the Fulgent today, and he does a pretty good job. He does a really good job as well. So let's go ahead, and we're going to bring you on right now, Ed. I do see you're unmuted. How are you doing today?
Hey, doing great.
Good.
Can you hear me?
I can hear you. You sound good. I'm going to go ahead and turn the screen share over to you.
All right. Well, let's see here. Let me. Can you see my?
Oh, yeah. You. It looks like you took a shower this morning.
I did. I washed the shirt too, so we're good.
All right. Very cool. Very cool. I don't see your screen just yet, but we can see it.
Okay. I'm not. Hang on. Let me get it going here.
Unless you're just going to talk about the charts behind you.
Well, actually, have a nice move back here. Last week it was awesome. Just the wrong way. So anyway,
It's like a weatherman.
okay. Let's see here. Yeah. I just wanted to say just like 30 seconds about our relationship, because it's really been just great to know your company. And way back so long ago, 1991, we were making automation utilities. That's my deal, is automation, and came from that background in industry. Met Steve Akalis, who was the founder of Metastock, went to Salt Lake City, met the staff there, wonderful people. It was great. And basically what we did is we created utilities that ran the DOS version of Metastock, automating various aspects of it. And he was kind enough to promote those to his customer base. And it's been great ever since. So we share products back and forth. And this new endeavor that I'm on now is the most exciting thing that I've ever done in my 30 years of history with software. It is so cool. And I am so glad to be back with Metastock. Jeffrey, you've been awesome, man. Just really appreciate all your help, and it's just been fun. Every day talking to you and working on this has just been a blast.
Yeah,
so,
we have some fun, don't we, Ed?
Me too. You didn't ask me to tell a joke this time, but that's okay. That's okay. I don't have it. So.
Okay.
All right. Well, let me go ahead and share my screen here, and we'll, I guess, jump into it, right?
Okay, sounds good.
All right. If it all works, let's see here. You can tell me if you see our wonderful logo, Fulgent Technologies.
We see that, and it's coming through well.
Good. Okay. So the company that I started is called Nirvana Systems. And like I say, the thing that we do is automate stuff, all kinds of automations on trading. And of course, AI is a form of that. The Fulgent project really came about as a result of us wanting to advance our AI even further than we ever had. We've been working on it for 20 years. But this past year, we decided just step on the gas and really advance it, and we did. My programmers did an awesome job. At the same time, we decided that it was really appropriate for us to package it so that it could run on Metastock and be able to be used by Metastock users as a separate application kind of attached to it. And that's why I called Jeffrey up, as he said, and we worked that out. So it's been really fun, and I'm really proud of this thing. You're going to see that as I talk about it. So sorry if that bleeds over, but anyway, today we're going to do several things that I hope will help you. It's not going to just be a sales pitch for Fulgent. I want you to take the benefit of things that I've been learning about Metastock as I've gone through the process of preparing for this summit. And so first off, we'll still talk about AI and why I believe you have to have AI to really find good opportunities Well, I would say I think it's the superior way. I know there's a lot of other methods that people use effectively, but I'll tell you why I kind of think that about AI, why it's really important in a minute. And then we'll talk about the implementation of Fulgent AI for Metastock and how that was done. Then the next thing is really, I think for anyone who is trading options, I haven't been able to watch all the presentations today. I heard that sounded great, the last one with Chris, but haven't watched them all. So I don't know if this is covered, but I'm going to talk about using the amazing new option scope in Metastock 17. I mean, that thing is just slick. I love it. So I'm really excited to show you about that. And then I'll also talk about a fully mechanical option trading system or strategy based on Fulgent. And we'll look at some, numbers and trades and stuff like that. So I hope it's edifying. Here we go. The first thing I want to talk about is why do we use AI in the first place? What is the reason that I'm so in love with the technology for trading? And it has to do with the way that we build trading systems. And all of us, probably anyone in the summit or people out there who make trading systems, we all do the same thing. We look at indicators, we try to find relationships between those indicators and price action. So this is just an example. Bollinger Band narrows. We know that's a really good place where charts are likely to move as the volatility heats up again. Then you also have a moving average, one over the other, 20 over the 30. Okay, that's a good signal that the trend is advancing. Momentum being positive is another one, somewhat related to moving averages, but not quite enough to not be used with them. So it's a good indicator as well. And of course, the old famous MACD, Gerald Appel, going way back, invented this thing. Everybody uses it. It's awesome. The difference between two moving averages and the moving average of that difference is also great. So if you look at these four things, the Bollinger Band narrowing and expanding, and the 20 period above the 30, positive momentum, and MACD above its moving average, we go, well, you know what? That looks like a really good place to trade. In fact, when I see that happening in charts all over the place, it looks like an awesome place to trade. And so we then go about testing it across lots and lots of data in history, of course, all we have, to see how well that holds up. How big are the drawdowns? What kind of profit does it make? What kind of stocks does it like to work on? There's all kinds of things you can test. So we spend our days grinding, testing these things. Okay, now let's think about this. This is just 4 indicators, right? Well, in reality, if you look at what's out there, here's the ones that are in Metastock, which I copied from the program. It's about 100 or so, and there's actually just an infinite number of variations of these things out there. This is really all of the main ones that people use for sure. It's a very complete set. But if we look at that list of about 100 indicators, and let's just pick one off, okay, relative strength. Now, what I want to do is make a trading system, right? So I want to bring up all these indicators and look at them and try to figure out if they're predictive. The problem is there's not just one relative strength. There's all these periods, 8, 9, 10, and so on. Then if you just pick one out, the RSI 14 is very popular. Well, you've got interpretations, okay? If it crosses through 0, if it's above or below a level, if it's accelerating, if it's diverging with price, if it's, you got a moving average crossover of RSI. I mean, man, it's just a lot of stuff, really an infinite number of possible combinations that you could experiment with, okay? So if you look at 100 things, let's just say I had RSI and MACD and 98 other things with one period, because you have to define them. So let's say one value, RSI 14, the classic MACD, whatever. If you look at that problem, there actually are 1 and 37 0 combinations of those things being true or false or neutral. So that's 3 values, true, false, neutral is RSI 14 above 0. That's, a Boolean. And so it either is or it isn't, or we say we don't care. We're not going to worry about RSI right now. Let's look at the other things. And so you look at all those combinations. That is 3 to the 100th power, which is 2 septillion possible combinations of indicators to go look at if you actually did look at all of them. And of course, you can't do that. It's not possible. So the question is, I would really like the computer just to figure this out. I mean, I don't really want to go pouring through charts again and look for a new thing. And it's kind of fun, but, I just want to trade and make money. So I want the machine to figure out how, where these rules are, to find them. And really, the only way that I've found to do that is with AI. So that's what I meant when I said I think AI is very important in the process. Now, here, we have been working with our AI for 20 years. And we've worked with neural networks, fuzzy logic, Another one that we invented called consistency, and of course, genetic algorithms. And what I have found is that the best way to solve the trading problem, to find really good rules, is with a genetic algorithm. And the reason for that is, if you look at a neural network and how they're doing amazing things in the cloud with the amount of computing power that's out there with neural networks and deep learning, where you have things like recognizing cancer in images, or of course the things that you see on your phone, like face recognition, that's AI, or self-driving cars, avoiding the rocks in the road. And the thing is, all those problems are very consistent. They're very physical. They are really involved with physics and things that are absolute, pretty much, especially missing a rock in the road. So when you look at the market, though, we all know it's not like that. I mean, things that work for a couple of years stop working, or you may only have maybe something happened 100 times in the last 10 years, but every time it happened, the market went up. Some things happened 5,000 times, and they're kind of maybe 60, 70% accurate. So it's really a varied problem. It's very hard to solve with a neural network for that reason. You can get kind of approximations with it if you take a small number of indicators and say, let's see how these things combine, turn the knobs on the neural network, the weights, and get an answer, a prediction, but not nearly as good as looking for rules across the data with a genetic algorithm. So just very quickly, not going to get into this very much today because we got a lot to cover on options. So the genetic algorithm is essentially, as the name implies, based on a genetic-like process where you have genes and chromosomes. So the genes are just these indicators. So I've got 8 across there. So that's 8 different indicator values. Usually they're Booleans. They don't have to be. They could be a range, but 8 things. That's 8 genes, and each one of those is, of course, a chromosome. Excuse me. So what happens is the operation of this goes around and swaps out these things back and forth with each other. It mutates them, and it's trying to find rules. Okay, there are thousands and thousands of these sitting in the computer. They are moved around, merged, and most of our work this year has been how to make that faster and more efficient. Make sure that it doesn't do a biasing, so what you find, a rule that you find actually is predictive. And of course, you can fool yourself on that in optimizations and backtests. So we did a lot of work on that. But essentially what's happening is over time, this thing evolves. Okay? It can take many hours. When you're running this on your Metastock, it doesn't do this. We've already done it here. So we have what is called a knowledge base that has all these rules. And there's probably 20,000 or so rules in there with all different kinds of things. So volume measurements, RSI, MACD, looking at the market itself. Is the market going up or down? How is it going up or down? And so it's looking at all these things, like 100, 200 of them, and picking off items and saying, that's a good rule right there. That little rule is like 80% accurate over 200 or 300 samples in this historical data. So let's go ahead and use it going forward. One second, I'm going to take care of this in a second here. Yeah, I think I got it. I think allergies, even in the winter. Can you imagine? Okay, so these knowledge bases have just thousands and thousands and thousands of rules in them. But like I say, all that stuff I just talked about, you don't worry about that because we've already done it. We've got the thing running, and I'll talk about the out of sample period in a minute. But essentially, this comprises the tool that we call Fulgent AI, and this version is Fulgent AI for Metastock. So how does it work? Well, it's really pretty straightforward. You have Metastock there. There's an engine that runs in the background. The engine is consulted by Metastock through our expert advisors. They call it and they say, "Hey, I've got a bar of data. What do you got?" And what it does is it passes over all the data for that chart. Every bar of data in that chart will pass, and then Fulgent goes into the knowledge base and is running all of these indicators, like several hundred indicators across all that data. And as much as it's doing, it's really pretty dang fast. I mean, a second or two to do all that. Then it sends back to Metastock all the signals and the exits from all of the rules that it found that matched that data. So it's looking at the rules, trying to find a match to, look at the data, trying to find a match to the rules that it has. And so they come back and then they appear in the chart like you see there. All right. we have implemented all four of the major, or three, I guess, of the major things in Metastock that people use. There are expert advisors. We actually have 4 experts running, but they're collapsed into one expert. It has an exploration and a system test. And I'm going to show it to you in a second. We're going to go to it and look at it. But if I look at what you see in the chart, these names down here are the names of 4 different experts that were trained in different ways. Some of them, my favorite is Quick Move, because it was trained on 3-bar exits. And if you look at very short term in the market, that's a very nice way to predict movement. It's very, very accurate. The other ones are longer term. We have a swing trading expert, and we have a volatility breakout expert that looks for strong moves where volatility is increasing to the upside. So those 4 will appear when you click in the chart. It'll tell you which one it is, which one it's looking at, which signal. And the second thing that we give are these statistics down here. So we tell you, which expert it is, what the historical accuracy of it. It's very useful because you're comparing these things against each other. And so it tells you in the historical data, this one, for example, was 78% accurate. It also tells you how many occurrences it found in the historical data and what the average profit per trade was, again, in the historical training data. It also will plot the current active stop because we do have those for each of these experts. All right, so that's essentially really all there is to the interface. Although, if you want to geek out, you certainly can, because thanks to the folks at Metastock helped us do this, we were able to actually tap into their menu and add this Fulgent AI option, and that goes to the app. This is that window you see is a picture kind of into this fairly large application. It's not huge, but it's pretty robust. Sitting behind there, it has lists the FT stocks strategy that you get with the Fulgent AI for Metastock, and then you can drill down further into each of the experts. And I'll talk about that in a little bit. So you can get down in there and you can turn things on in there. You can turn experts off. You can do all these things. It's easy, but it's kind of a weedy thing. So we're not going to go into that right now. But that is there. So it's pretty unusual to have that kind of an interface in an add-on, really for any software, but for Metastock. So, okay. Oh, I did show this. So this is the specific experts, and this is actually an older interface. I should have replaced this slide because we now have the ability to select longs and shorts out of each of these. So I need to replace that. We, of course, also have the Metastock system tester, and early on in the game, back in the summer, this was released in July. Ahead of that, I wanted to see, well, how are we doing here? And so I just ran against the basic systems in Metastock, which are actually very good. The ones that just come with Metastock are very good. And when I did that, Fulgent always came out on top. So, and again, those are really good experts. I particularly like the RSI expert is really good. The others are also good. But we wanted to make sure that, we're saying we have really accurate signals in this thing. And, that just needs to be true. So that's why we were testing that, just to be sure. Okay. So that concludes the first part of my presentation, which is all about the AI, how long we've been at this, what it's based on, and how it fits into Metastock. Now we're going to get into the meat of the presentation, which happens to be just add options. Okay, now we're going to have some fun with you here. I want you to think about something for a minute. Let's play the odds here with options. Let's say, but instead of options, let's talk about $10 coins. All right, I've got 10 coins sitting here. I was thinking about actually bringing 10 coins. I used to do magic shows for kids, so I thought, nah, I won't try to do that. But anyway, so 10 coins, you flip them. The thing about this game, though, is if you do a tails, you lose the dollar, but if you do a heads, you win too. Okay, it's kind of a nice game. So would you be willing to play? You'd probably say, well, sure. I mean, anybody can figure, a coin is 50-50 odds. And if you win double on one side, that's a pretty darn good deal. In fact, I did this in a spreadsheet. And if you just keep letting it, this is a number of tosses on the left. A -1 is, tails is a -1, that's a loss. +2 is a win. And you just look and see what happens to a balance. And if you run this a whole bunch of times, what you find out, this is one of the runs, is you find out you get about a 20 to 60% gain if those odds hold up. And to me, option trading really is a probability game. That's what it is. Anytime you're selling options to collect premium, it's all based, you look at the probability of moving the chart, on some platforms do that. It's all about probability. And I like that, because probability is not subject to emotion. It's subject to historical measurement. It's something you can believe in, stay with if you believe the probability is correct. So for me, as kind of a system trader, I really like that notion. Now, what does that have to do with options? Talking about flipping coins. Well, the fact is that options are the most darn awesome thing that you can trade, as far as I'm concerned. And I caught the tail end of the last presentation. I agree with the gentleman that they're so versatile. And I think Jeffrey, you were saying this as well. In any trade, you can do an option trade, and we're going to be looking at, of course, is directional trading today. So if you do have a strong directional trade, you absolutely should do an option trade. Why? Well, it's leverage and safety. You get both things at the same time. So here's a regional, I believe, is the name of the stock. Chart down here of the bar chart. Here's one of our signals on it, and I plotted the option chart above it that I chose. It didn't go back far enough. I was going to do it from here, so I just did the measurement from where it matched the chart. And so from this date to this date, this is current chart, the stock, high price stock, $343 stock, gained 8%, but the option gained 200%. That gets your attention. And all I was risking to control $34,000 worth of stock was $290. So, talk about flipping a coin, and on one side you make a lot, the other side you don't make anything. That's kind of what this is. And of course, you have to have the directional accuracy has to be there, and the moves have to be there. Okay, but that kind of gets your attention when you look at what happens with options. So, and this of course is a just out of the money 1 month expiration. And there was some discussion on that too, which I thought was very good. All right, so here's what we're doing. It's a directional approach to trading options. To achieve our minimum 2-to-1 payout ratio from the game, we use AI to find trades with strong directional bias. Very important. Those trades have to, on average, be 60-70% accurate with the exits we have. And if that holds up, you're doing pretty good. So you didn't like flip. You want a time horizon. I have found through much experimentation that 14 plus days out is just about right for an option. A month is a little long. You got a lot of premium in there if there's a month out. A week is a little short. So 14, 16, 18, 21, something like that is just a really good place to go when you're buying your option. And you do, in this, we're going to be looking at, we're holding to expiration. And the reason for that is, this gentleman who isn't around a lot right now, but Larry Williams, very famous futures trader. He wrote a book called How I Turned 10,000 to 1 million in 1 year trading futures. And he consistently said, wide stops, man. You've got to have wide stops. You put those stops tight, you're gonna lose because you're gonna get stopped out too quickly on the profitable trades, and that's where the money is. So loose stops are really important, and that's what an expiration exit does. Because it's really hard in a chart to get an exit that is just perfect, that exactly knows, you got the pullback, and well, have we pulled back enough yet, or is it going to go more, and should we stop there? And you, for sure enough, you get stopped out, and boom, the chart takes off. So expiration just works like gangbusters. Okay, so again, if you have 50% plus accuracy, so you only need that if the profitable trades are averaging over 200% gain, and the losing trades, of course, can be 100%, but you're hoping that they're a little more in the 60, 70% as opposed to 100 to give you a little bit of an advantage. Okay, now what we're going to do next is actually get into option scope. But before I do, I'd like to go to my machine, if I can. Okay, it just logged me out, that's all right. It should know me by now, but all right, no, wrong machine, where's my other one? Hold on. Okay, I'm gonna have to go to it. I closed my wrong remote desktop, give me a second here. This could be it. Aha, bingo, okay. Before I do that, I just want to go through some of these charts, just a few of them. You can see that these experts are really firing at nice reversion points, like 70% of them, and that's why it's powerful. You have to think about it, it's mechanical, so here's Apple, and of course, that little delay you see right there is it's passing the whole chart over there, all the data, and at the same time, Fulgent is calculating hundreds of indicators in those 2 seconds that you saw. Pretty awesome, huh? So anyway, just a few. There's Apple. We won't belabor this. My other presentations, if you look on YouTube, I went through more charts, and spent more time on this, but we're going to do options. So I just want you to kind of see where these are firing. And people have asked when they see this, well, where are the short trades? we actually have added the ability to turn on short trades in Fulgent. Here's the thing about shorts. Remember, this is artificial intelligence. It's looking at samples in the past. And there's just a gazillion more long samples than there are short samples. So the short trades are not as good as the long trades, but it will generate them if we turn it on. And I can show that to you in a little bit when I go to the interface. Actually, I can just show you right now because I'm talking about it. I'll forget. Let's get down to Fulgent and the Metastock interface. Here it is. Here's that expert. You notice there's a retrained version. I'm going to talk about that too in a little bit. Here's the one that you get with it. And if I double click it, it'll say, okay, there's the 4 experts. And you see I can turn on shorts right there if I want to. Very easy. And I can turn off individual experts if I want to. If I just love quick move, I don't really care so much for volatility breakout. It gets in the way. So I can turn those off. And these stats are for when you retrain it, which we're going to talk about in a little bit. But so that's the interface. That's as simple as it is. Okay. So let's get into the use of option scope. Awesome thing. Just love it. Okay, hold on. I can get to my window. I've got too many windows going. Gotta find it. There we go. All right. So this is basically the process. And really this part of my presentation is we have quite a few Fulgent subscribers out there right now. It's been great. And I appreciate you guys. I know you're on this call since you saw the topic. So this is really for you because I'm going to go step by step through how to use Option Finder to find what I consider to be the best options to trade. And then we're going to look at some performance stuff after that. So this is really for you. So first thing, you run your expiration. If you can get the optionable stocks only, that's what I would do. In a filter, couldn't quite figure out how to do that before this presentation. I have been running on the S&P 500, but actually Jeffrey may know a way to do that. I'm going to ping you at the end of this. I'll ask you questions actually. So, but I ran on the S&P 500, and one of the great things about the exploration that we made for this is that the DLL that we're calling the Fulgent AI technology application is passing back for every trade how many bars have elapsed since the trade began. And so we're actually showing that to you. If you look at the in long, in short, it'll tell you, which ones those are. Here's in long right here. Those are all 1. And here's how many bars that symbol, News Corp, has been in trade. 1 bar, 2 bars, 5 bars. These are 0. These 4 up here are brand new. So, but that's very useful because trades that are a few days old, even 5 days old, can be really good candidates. So you have that. You also have that historical accuracy of the rule that fired the trade. So you can see that as well. And there's a few more stats to the right of this. So you basically start there. You run your exploration. I'm not going to run it because it takes too much time for a quick webinar like this. So it doesn't take that long, but you know what I'm saying. And so we are going to go there now. I'm going to do that. And I'm going to pick a trade. Let me see. I'll make sure. Okay. Yeah. Here's the process. So down here, I've kind of put the Explorer on top of Metastock. And what I'm going to do is go to it and do this process. So I'm going to be going back and forth between my slides and doing it. Okay, so I know I tend to talk fast sometimes when I'm excited, which I actually am right now, about to show you this thing. So I'm going to slow down a little bit here and just say, okay, we're going to go back to the slide. But this is the summary. The reason I'm doing this is because anyone who wants this set of instructions can get it. All you have to do is email me. I'll have that at the end of the presentation. I'll just tell you it's ed@fulgent.ai. And there's some stuff I'll send you, including this PowerPoint. So you have this. So you don't need to take copious notes or anything. Just kind of enjoy, sit back, relax while I go through this. But these are the steps that we're about to do. So first, we're going to find something to look at, a chart. By clicking on it, double clicking on it, it's going to come up. And then we're going to make a new indicator window in that chart. And then we're going to bring up option scope. Okay, let's do it now. So I'll go back over here. I'm going to go ahead and close all these charts just so that, well, actually, I don't need to because I figured out a way to do this that doesn't matter how many charts you have up, it works great. So I'll just leave them. All right, so first thing, let me go to my Explorer here. I just love Metastock. Is so great to use. I just love this thing. It is awesome. Okay, let's see. Report and selected instrument. Okay, here it is. Now, it's kind of sorting by alphabetical. I don't know how many I have here. It looks like 134. Nice. So what I'm going to do is sort on this column I just told you about, which is the bars column, because I want my new trades at the top and my in trades lower than that. Let's go to the first new trade. This is run today. So what I'm going to do is double click that. And of course, as you know, it's going to bring up that chart. Rotate. I think I can close this and keep the, yeah, there you go. Okay, so there's my chart, and this already has a window. I'm going to say, let's just say I didn't have that. So as you know, what you do in Metastock is you right-click, inner window, new. Right-click, inner window, new. There it is. All right, let's go back to our instructions here because I forgot. Okay, next. So, okay, good. Here we go. So we did that. Oh, now we're going to bring up option scope. Okay. So right-click, option scope. There we go. And of course, that's really nice because it comes up already populated with MMM. That's good. Okay, moving right along. We have that. Okay. So now we want to do is set option scope to show us the options that we're really interested in trading. I love this. You got to patent this. This is so good because it's so easy. I'm sorry. I've had fun with this, Jeffrey. I can't help it. It's just been fun. Okay, so this is so easy to use that it's just like falling off a log. So what you do is you go over here and you open this stuff up. Okay, you got your expiration, strike price, type, and in or out of the money. All right. So what we want, like I said, 14 plus ish days out. So 14 days from now is the 20th. I really don't want to look at all these options like, next weekend, all this. I just want that one. So there you go. Now strike price. I want to trade near the money. I don't want to trade in the money. Why do I want to trade in the money? That is, I agree with the gentleman, that is a conservative way to trade options. I'm expecting these things to move. These charts are going to move. So if I go out of the money, not too far, just out of the money, that's where I want to be, because when that option moves through that thing, it's just going to generate multiples of gains. So I want near the money right there. I don't really care weekly, monthly, or I just want the option that's about, at this date range, and I could do another one. I could add some more on by doing this, but let's just say with that one, and I don't need to worry about the expiration type filter, so I'll take that off, but I do want out of the money. So we're just going to be talking about calls right now. We're not going to get into puts or shorts because that always complicates things, but you just invert everything for puts. You all know that, right? So it says calls here. Here are all the call contracts. And let me expand this a little bit here. And we can see that they go in the positive direction this way, like this, 172.5 strike price, 175 strike price, 77.5 and 180. And and I know they're all in that expiration there. All right. So what I want to do, let's go back to my slide again, is to pick, which one do I want to pick here? So 14 days out, near the money. And what I really want to do is get that first one, because that first one is the one that is closest to price. It's just out of the money. They go further from there. And the reason I want that first one is it's more likely to be profitable, even though it's more expensive than the other ones down here. Now, if the chart looks like, oh my God, this thing's going to take off, then yeah, you'd go down and pick one of these off. But let's look at the parameters that you want. First is volume at least 100. That's pretty low, 100 contracts, pretty low for a day. But you'll see most of the time you're in the 200s, 300s. Every now and then you see one that's like 5,000, some Apple calls or something. But this is kind of a nice, for MMM, that's this number right here, 260 is pretty good. Okay, so it passes that test right there, more than 100. The last price, which is actually the price that the last trade was at, is 50 cents to $3. I really like between 1 and 2, but I'll go to 50, I'll go to 3. It's okay. We saw what happened to the other chart that had a $3 option. It's okay. So that's your price range. And then you want the spread. This is very important. The spread comes from the liquidity of the option. So if volume is low, the spreads are going to be really wide. What do I mean by the spread? So everything in the market, everything has a bid and an ask. And the ask is what they're asking you to pay for the option. The bid is what they'll pay you to buy it back. So if that difference, whatever that difference is, that's your loss coming right off out of the gate. So let's look at this option. It's bid 220, ask 226. So I'm going to lose 6 cents right away. I mean, if I bought and sold this plus commission, of course, if I bought and sold this immediately, I would lose 6 cents. So you want that to be definitely less than 5% of the price. Typically, like in this one, it's quite a bit less than that. All of these, because there's decent volume, are less. Look at this. This is only 4 cents, 119 to 123. That's like nothing. So that's fine. You just want to watch out because you'll get hurt if you buy something that's too expensive relative to what you can sell it for. So that's also very, very important. Okay, moving right along here. So you got that. Now, what I want to do is plot the option. I have a reason for wanting to plot it. And the way we're going to do that is I'm going to select it in option scope. I'm going to say plot it, and it's just going to plot it as a chart out there. Okay. Then what I'm going to do, this is the trick I learned, Jeffrey, that is so cool. It works like a charm. If you hit window cascade, it's always going to put the most recent chart that you are working on right there, and it's going to put that option chart right here. It's awesome. So you can just click that, drag it over to that window, and you are good to go. Okay, let's do it. All right, check the box. Open selected option in a chart. Okay, let's see. Of course, this is in front of it. Let's let it finish spinning, and there's my little option. Isn't it pretty? Okay, so now I'm going to do window cascade. There they go. Okay, so here we are. And I look at this and I get my MMM. Let's see here. This chart, I believe. This must, okay, now. Well, every time I've done this, the chart was right behind us, probably because of the prior operations I did. But what I can do is minimize these guys till I see it. So let me just do that. Let's see here. This is the MMM option. What is this one? Nope, Netflix. We look some more charts. Okay, come on, MMM, where are you? I know you're in here. Jeffrey, you may know the magic way to bring that up on top. Is it just type in MMM?
You're trying to bring your MMM on chart?
Aha!
Okay.
So I figured it out. Okay, so there we go. I got it.
Glad I could help.
You didn't rescue me, though. You let me flounder for a little bit there.
I was taking a screenshot of the scan parameters you're using so we could add those as parameters to scan for. So in any case, I'll let you get back to it.
Okay, that's all right. So I selected the, I get you that PowerPoint, by the way, no problem. I selected the option here, and I'm going to grab it. We get the little chart symbol and pull it into the MMM chart. And there it is. Okay, let's maximize that. And now I want to zoom in on it. Oh, look at that. We get that nice little volatility breakout signal right there. Doesn't that look pretty? Okay, so here's the chart. Now that option is kind of messing around a lot. I mean, you got a fairly high price stock. Implied volatility is probably a little high, but that's okay. I mean, here's the close of the option. I basically got to the point now where I can work with this. All right, let's go back to, but usually they're smoother. Usually they'll be like a chart. And those are a little better because you can actually do things like put moving averages on the option chart, which is why this is so important that Metastock did this. I know it's very new, 17 just got out, but I'm telling you folks, the ability to see that chart and trade off of it is golden. Okay, we're not going to really get into that today about analyzing the option chart because you don't have to with what we're doing, but it's pretty cool. I'm telling you, these guys over there are on the ball. That's all I got to say. Okay, so let's go on to our next step here, which is entering and tracking the trade. So we're going to monitor it up here as we go forward in the trade. And what I always do trading options is put a limit on the ask price. You're going to put the order in the night before, probably, or at least even if you're looking at it, it's in real time. Put a limit on the ask because the market makers, bless their little hearts, they're trying to make money down there, and they will jazz the ask on you. They'll look at all these orders and they'll say, okay, let's raise that, a quarter. Sorry, I'm not playing. You leave it where it is. Now, this may mean that you missed the trade. You could miss the trade. So, but that's just a way to protect yourself, especially if you're looking at the market. Now, this is a way to reduce risk. Limiting the number of positions to 10% of the account means that your option trades are 10%. That's all you can ever lose out of your account, no matter what happens. That's all you can lose. And we're going to get back to how much you can make in a minute, but that's all you can lose. So it can be 3 trades at 3%, 5 trades at 2%, 10 trades at 1%. Meaning if you have a $10,000 account, a 1% trade would be one contract at $100. Right. $1 per option, $100 for 100 of them. That's one contract. So you want to limit your risk. Then you just want to go for it day by day. You say this chart, you bring it up, while your position, and you either want to take profits for one of two things. We like to use a 2 times the average true range exit below the signal. Now, the Fulgent stops are set at that level. So the stop over here that you see, this one isn't in yet, it's pending, but once it's in trade, that level is where you want to get out of the option on the downside. On the upside, you have a couple of choices. All of the simulated trading I'm going to show you was done going to expiration, but you can do some fancy things because you've got the chart. You could put a moving average behind that chart, get out when it crosses it. There's various things like that you could do to improve your overall performance in terms of wins versus losses as far as accuracy goes. So, but that's a manual thing, and you don't have to do that. You can just go like right to expiration, and that's what we're going to show you here in a second. So, pretty easy. Okay, so that actually brings me to my next and I think pretty much final topic before we do Q&A, and that is historical testing this. So, and this is good. Actually, I ran these tests and I was like, oh my God, because I need to talk about them. And the first thing I need to say is the importance of out of sample, because all of our testing, anything you see me do or I'm showing numbers, is out of sample data. What do I mean by out of sample? Well, we essentially break up the chart into different backtest regions and create forward test zones so that those are the trading periods. So that when we're generating rules, we're always doing it in this historical data, but what you see, and starting in these experts we have right now, starting January 1st, 2018, all of that is out of sample, which means the AI had no idea it was there, didn't look at it, didn't see it, didn't optimize to it. It knew nothing, as Sergeant Schultz would say, about that. It's just strictly looking at that backtest data. And this is so important, because anytime if you optimize a trading system over some data, let's say over the last 2 years, and you get these amazing numbers because it's finding the exact parameters that work for that. And you say, look, I've got this 80% accurate system. Well, not really. You start trading that, it's probably going to be like 55 or something. It depends. I mean, so optimization does have a place, because if you're trading the right edge, it's better to optimize than just to take a default. But don't fool yourself that those numbers are right, because they're not. And so we really know this, having done this for 34 years. So, we just really avoid that like the plague. We do not ever use our historical data for tests or things that we show. That would be wrong, and it's just not right. So now let's take a look at the performance. Okay, this is running one of the experts, the quick move expert, on the Dow 30, just the Dow 30 symbols, so it doesn't trade that much, and it uses the rules that I talked about. So a max of 3 trades at 3% allocation each trade. You can see my historical, this is some simulation software we have, by the way, so it doesn't matter, but I had to use it to get this graph. So the first date it trades is January 1st, 2018, which is the out of sample period, right after all the training of the AI. And so risking just 10% of the account at any given time, this showed the potential, of course, in the historical period, of making 134% per year or 500% in 2 years. It started here at $10,000 and it's at $50,000 on the right edge. Okay, so, and people are going, Ed, how could that be the conservative? I mean, oh my God, I'd love to get that. Well, again, it's historical testing, and I've got down here, past performance is no guarantee of future, but it is a true, honest to God test of the capabilities of the AI at the point that we stop training it. And I hope I've made that really clear. Now let's look at the aggressive one. Okay, so that's 30 stocks. So what I did is I went out there and I found the 100 most liquid. And the way I measured that was price times volume. So you just get that number and sort highest to lowest and trade those. Covers a lot more trades. Here's what that looks like. Okay, I risked, because this is my aggressive, I'm risking 30% of the account. Now, why would I do that? Well, it's a $10,000 account. It's my little slush fund over here. So I go, I'm just going to let that run. Let's do 30%. You could do 50% of it. I didn't want to do that. So 30% of the account at risk, and letting it go. And so the average annual gain is 400%. It did 1,700% in 2 years. So it went from 10,000 to 176,000. Again, it's just the forward test from the train. I mean, I know it's pretty unbelievable, but it's anyway, there it is. I wanted to show that to you. So those of you who have the product, of course, have the Quick Move Expert. And one of the things I want to mention is that if you do email me, I will send you a full report with every single trade that's in here. You'll see all of them listed. Also additional reports on the other things that we have, but I want to kind of keep it contained for the webinar. So I didn't want to go through all that, and all that stuff in here. But if you want it, just email me, ed@fulgent.ai, and I'll send you the data so you can look at it. You can look up the options. We do use a theoretical model. So the prices for these options in these trades is not exact. It's, it's Black-Scholes. It's pretty good. I mean, it's within, probably 10%. So there's going to be variances between actual, if you looked at actual historical data, but we've been doing this for a while. It's really very indicative of what you would see in our opinion, but you can look at that yourself looking at it. And if you have the product, of course, you can do a lot more. We're going to get to that next in terms of looking at numbers like this, because there's things that you can actually do with Metastock to also look at this. Okay, so let's move on and talk about that. So the summary of this whole section is you can put the odds in your favor and make consistent profits if we control risk. Got to control risk. Don't put the whole account on this stuff. You're highly leveraged. You don't want to do that. We reduce risk when we have drawdowns. So it's possible. I mean, I did my coin flip thing, the game. I mean, odds are very low that you're going to have 10, 15 losses in a row, but it could happen. So if you draw down your 10%, what you want to do is scale back to 5%. If you lose that, scale back to 2%. The leverage is so high on these things, you should recover. After 3 cycles of that, you should recover, let it build back up, and then increase again. So that just protects your account from, the very unlikely event, but it could happen. Okay, now, those of you who have Fulgent already know this, but I want to tell everybody else what else is in here because we've been working on it. Jeffrey's been passing customer comments to me since I first put this out, and we've been busy. I say we, my developers actually the guys that are busy. I've just been kind of cracking the whip and saying, hey guys, we need this. Please put it in. So the first thing is people ask me in these webinars, does it work with futures? Does it work with Forex? Can I use it in real time? They get very excited about this. I know these questions would come if I got to the Q&A and didn't answer this. So the answer is that now in version 1.1, you can retrain all of our experts on your data, your time frame. It doesn't matter. You just go right in there. I'll show you. It's so easy. You go into Fulgent here. Let's see, tools, Fulgent. And you see it says continuous training. Okay. That means that you want it to, as you've got the computer running, just sit there and train and train and train and train and train and find more rules on your data, your time frame, whatever it is. But the way you kick it off is with a special expiration called training. If I'll just show it to you real quick here. If I go here and look at the expirations, it's called Fulgent AI training. That's right down here. You see that Fulgent AI stocks training. If I just ran that on a list, a time frame, it kicks it off and it just does it. What you will see at the end of that process is a trained Fulgent AI expert. So again, to go back to that, remember I kind of mentioned this earlier. See, it says FT stocks retrained. This was an experiment I did. I'm going to show you what it was in a second, but it makes a copy. So you're never destroying the original. You can experiment all you want, try everything, throw the kitchen sink at it. It doesn't matter. It's going to make a copy. Okay. Again, this is all from feedback that we got. It was really good. Your customers are great about that. I've been love dealing with them. They're awesome. All right. So the other question I get is, does it generate shorts? I kind of addressed this earlier and showed you that it does if you turn them on. I tend to not turn them on because the accuracy is so much better with longs. But yes, you can get them. And we won't go there today, but they can be seen. Now here's the biggie. To me, this is the most powerful thing that it does. One customer actually said, hey, I want to train, I've got this Bollinger Band thing I use, and I'd really like to have the AI look at that and find rules around that situation. Like when my Bollinger Band breakout happens, I want to see if I can get a boost from the AI. Well, now you can, because what you can do is there's one Fulgent AI indicator file. It's very simple. You just go in it and you replace, there's a condition in it. The default is RSI 3 less than 30 for a long, and RSI 3 greater than 70 for a short. That's the default because that's this example was based on. You can make that anything. You can call any Metastock indicator, any expert from anybody, as long as you can call it and train the AI on it. See what can you find out there on this condition. So in this case, RSI, the theory was that when you're overbought, like in these red zones, or you're oversold in the green zones, that's probably a good place to sell or buy. Let's find out. So we retrained the AI again on quick move because it's based on quick moves, several bars, and the results were awesome. That's what the signals look like after I did it, just on RSI 3, less than 30. Isn't that amazing? Here's the really amazing part. Here's the system without AI. I mean, it's a pretty simple system, not much to it. Here's with the AI. So quite profitable by simply retraining it. And it took maybe, I'm going to say 15 minutes to train the AI on that. So pretty cool. So with this, you can apply, you actually, just by subscribing to Fulgent AI and using all the other stuff in it, you have this engine that you can apply to your problem and have the ability to, take any indicator relationship and make it profitable or more profitable by running the AI on it. All right, so that is pretty much, I think, that is it. So my summary for today's webinar is as follows. Fulgent AI seamlessly integrates into Metastock. There's 4 powerful experts. You can retrain on your own indicators, your own symbols, your own time frame. It can be used as a mechanical system or to provide outstanding trading prospects each day. And this is the great thing about this is I know you have these amazing add-ons from other people out there. I have used some of them. They're really good, folks. I won't mention names because that would be biased, but I've played with them and they're great. So you can use those in conjunction with this. You get a signal from Fulgent, look and see if you're, I almost said a couple of them, but if they line up and you'll even have a more confirmed trade. So it's just very versatile and we're having a blast. That's all I can say. So I guess, Jeffrey, at this point, I have to give it over to you to talk about what you're doing out there. There's my slide on it and what it includes. And I hope those of you who have the product, I've been able to help you today with options. Like I say, if you email me, ed@fulgent.ai, I will send you more information on those results and how they were done and all that stuff. So,
Ed, can you go back one slide? I wanted to point one thing off on this because I thought it was cool.
One way. There you go.
Right here, yeah. So right there, again with the commentary, one of the things I like about it is it's actually giving a signal rating, the signal occurrence, and a trailing stop as well. So a lot of the questions we've got, Ed, I'll let you kind of talk a little bit about real quick. We had a customer asking if he could retrain the data on his NSE stocks, and you showed how to do that. We had another person that said, can I use my custom indicators? You can do that. You've been really, really good at kind of addressing customers' wants out of this and kind of providing it available. One quick question off the wall for you. Are you able to scan for setups using Fulgent AI?
Well, that's what the Explorer does. So it runs all these experts. Is that what you mean?
Yeah, it was a softball.
All right. Okay. Yeah, there's an exploration that runs all 4. Now you can go into the interface and turn them off. I had one person say, "Look, I just want to do major reversal because it's so awesome, and I don't want to be bothered with the other ones." And so now we added the ability to turn off individual experts if you don't want to look at them.
Very cool. Michael says, "I love Ed's excitement, and you should give him more time."
I appreciate that. Thank you.
Yeah. We do love it as well. I appreciate you're looking at option scope so closely and stuff like that. I got some really good ideas in terms of how we could make it even better. So that's why I wasn't paying so much attention. I was actually emailing our lead programmer over here saying, hey, add these as things you can search for, like that bid-ask spread. That would be an easy thing to implement. So good work.
Yeah, a limit. Yeah, that'd be good.
All right, very cool. Well, Ed, thank you for your excitement.
Thank you, sir. Appreciate all you've done for us.
All right. All right. Very, very good. Let's go ahead and switch the slides back here real quick. And we'll just talk a little bit. This is included with all of the other indicators that we offer. Let me go ahead and kind of advance to the slide. So we did show you the expert advisor. You can test. It does full market scannings. And he's added so many new things to it, like the ability to retrain on any market you're interested in, whether like it's the NSE or the, you can, that kind of stuff. You can actually throw in, if you've got a good idea, if you've created a system that you like in Metastock, you can program that, throw it in there, and actually have that trained on AI as well. And it was rather telling to take a system that wasn't making money and all of a sudden that it is making money. I can only imagine the implications of putting AI behind a system that's already making money and then improving it with AI would be even more impressive. So it has been well liked. We've been selling it for a little while now, and people really, really do like it. So normally the price of the Fulgent AI is $149 per month. As one of the things we're doing as a summit special today is we'll give you a permanent discounted rate of $99 per month. So as long as you stay subscribed to it, you're going to pay $99 per month. And of course, we're going to give you the second and third month free, which we're doing with all of the subscription products today. So to take advantage of that, you can give us a call, 800-882-3040, or you can visit us online at metastock.com/saleschat. It is part of that Summit Traders Pack where you can get Metastock, our real-time version, the Zenith data, which is the news and the data. And I could talk for a while about that. I'm not going to because I don't have the time, but 3,000 reporters reporting into this news feed from 300 different news bureaus around the country, all kinds of fundamental as well as technical as well as analysis data included with that. Literally very similar to a package that Refinitiv, who used to be the Thomson Reuters analyst, and they sold it to Blackstone, but literally a package that they spent $1 billion developing, and literally something they charge institutions like 3 or 4 times what we charge for it. You can get the Knoxville Divergence, one of my favorite toolkits, the big trend toolkit. You can get the Fulgent AI, Jake Bernstein stuff, setup and timing triggers, 2 years of Unleash the Power of Metastock, 2 years of Stocks and Commodities magazine, our training DVD. Somebody will call you and help you get everything installed. It's really a great package. So normally it's $17.44 here today as a kind of like our holiday summit discount. We're going to give you almost 50% off, $8.96. So to take advantage of that, if you have questions, if you want to get started with the software that's been rated number 1 25 years, literally in a row, 800-882-3040. You can chat online with us at metastock.com/saleschat. So we're catching up. I'm only 2 minutes behind right now, so that's a good thing as well. I do want to say thank you to Stocks and Commodities for sponsoring today's event. We really appreciate that. And give us a call, 800-882-3040 or metastock.com/saleschat to take advantage of those offers. So our next speaker is going to be speaking to us for the very first time at a Metastock event. His name's Jay Soloff. I've heard he does a really, really good job. I'm interested to see what he's got to say to us. To kind of give you a little bit of his history, he's an options portfolio manager. We'll try my English later for Investor Alley. He's before he worked for Investor Alley, he did some other things, including working on the CME floor. And I'll get into a little bit more detail about what he does. But let's go ahead and I'm going to turn on his microphone. So, I can't turn on your microphone, Jay, because you need to do that. So if you could, let's go ahead and get you on here.
All right. Hey, can you hear me okay?
Oh, my goodness, you sound like an angel.
Well, I mean, I'm a little bit disappointed you didn't give me those extra 2 minutes now. I mean, that was just,
if you need them. If you need them.
There should be plenty of time. I imagine I have about 45 minutes of content, so plenty of time for questions. And
Cool. Awesome. Yeah, we're always running a little bit behind schedule at these events, so I try and keep everything as tidy as we can. But it's a dynamic event. So in any case, I did do a bit of an intro for you. Do you want to expand on those beautiful things I had to say for you?
I have a slide on my background. I usually start with some kind of hook, so
okay.
So I'll get to that. If it is everything just.
I can see your screen. I can hear you well,
okay.
And I can get out of your way and let you go.
Yeah, feel free to interject. I'm very much for the interactive sort of discussion, so don't hesitate to interrupt me and whatever you need to do. So, but I appreciate you having me on. As you mentioned, it's my first time here, so hopefully I will meet the standards that you expect from your speakers. So we're going to talk about trading volatility. It's my my specialty. I mean, I'm interested in all forms of trading and especially option trading, but volatility is, as a former market maker, that's really where I think I have the most edge. So I've been around it for 20 years or so. So we're going to talk about some easier ways that you can trade volatility without having the same access that I had to stuff on the floor. So I really like showing this stuff because I think it really puts things into perspective. So what we have, that red sort of curve there is your standard normal distribution, right? So if you've ever taken any statistics, or even if you just ever read an article talking about, sort of probabilities and things like that, you're almost certainly familiar with the normal distribution. That's kind of the way things kind of fall in nature, maybe like the height of trees in a forest, or it's used pretty extensively in college in terms of coming up with like a grading curve, and but also maybe the number of people who maybe like the weight of the average person, or and really works really well for the vast majority of probabilities. This is just a kind of a standard distribution that it really explains a lot of things. Now, what you see here, and this is about maybe 30, 40 years of data from the S&P 500, and the actual returns are these blue spikes, right? So if it's within the normal distribution, it's being covered up, but you can see that all these other sort of blue regions are monthly returns that didn't fall into the normal distribution. So you can see certainly there's a lot of activity that is even more pronounced around like very small moves. But really, you have these really outsized moves that are not explained by normal distribution, particularly losses, some really large loss months that kind of go well beyond what you would expect with a normal distribution. So to put some numbers behind that, this is to me one of the most fascinating tables that you can find on the market, and it shows you sort of the amount of moves. So like we'll ignore the sigma moves just in terms of like percentages. So this would be 1 day move, like a 1% plus or minus 1% in a day, plus or minus 2%, and all the way down 3, 4, 5%, how much you would expect given a normal distribution and what has actually happened. So this is you see almost 50, over 60 years of data, 66 years of data. So not, quite a bit less than you might expect. The plus 2% move is pretty well explained by normal distribution. But then you get into these big moves, and particularly like these really large moves. I mean, look at the 4% move. You would expect one every 62 years given a normal distribution. We've actually had 98 of them, right, over this 65-year period or so. And then the plus or minus 5% moves, 1 in 6,900 years. Like if we went with the normal distribution, we should never see a plus or minus 5% over this period. Instead, we saw 50 of them, right? So what you can see here is that a normal distribution does not really describe market returns. There's a lot more extreme action than what you would expect. And the question is why, and what can we do about it? Well, the why is, there's a lot of reasons, but a lot of it is memory, right? People remember, after 1987, for instance, that was a major change that really changed a lot of things in the market, changed how people started viewing insurance and protecting themselves. Like no one ever expected, 20% move in a day or a week, and it happened, and it really changed the way people viewed the markets. Like, oh man, I could lose 20% of my portfolio in a day. Like I really need to rethink how I do things. So some of it is memory. When market starts to go down, people get scared, they pull their money, and that exacerbates the problem. So some of it is memory, and and just some of it is just fear of, that most of these large moves are on the downside. And that's because no one wants to lose money, right? They're scared. You have the fear of losing your livelihood. So it sort of is a self-reinforcing issue. So what do you do to protect against it? Well, there's a lot of things you can do, but what I like to talk about in terms of this is volatility trading, because volatility trading really takes into account people's fear and greed to some extent, and it's a lot more predictable than trying to trade market direction. All right, so I'll just briefly mention this, and I'll talk about it at the end. But if you go to optionsfloortrader.com, you can see my primary product is a great little option trading. It's really great for getting your feet wet and kind of learning the industry. It's only $49 a year, so it's really it's probably the cheapest product on the market, at least that I've seen, for a couple trades a month. It's a really good way to learn. We do a little bit of volatility trading and stuff I'm going to talk about, but really it gets your feet wet in options. So if you're relatively new to options, this is a great way to get started. So I'll come back to this at the end. But all right, so here's me. If I get a functional webcam at some point, you'll see that I don't really look like this anymore. I was a lot younger then, so a lot more gray hair, definitely not that thin. And but this was me on the trading floor on the CBOE. So I've been doing this I've been in options for about 21 years, but I started as a market maker. The last 9 or 10 years, I've been doing more the financial publishing and online research and education and the stuff that I'm doing now. But the background I have from being on the floor is really invaluable. I also did some work at a hedge fund for a while and have a couple college degrees here and there. Okay, so we're going to talk about basically 3 steps for trading volatility, but let's start with talking about what is volatility. I've been talking about it a lot. Well, when we talk about when you hear volatility, you hear it in the financial media, you hear people like me talking about it. Generally, we're talking about implied volatility, and that is the expected rate of change of a stock or some other underlying, right? It's what we expect. It's not what's already happened. It's what we expect. Now, what we expect may happen is certainly going to be based to some extent on what has happened, but doesn't necessarily have to be. What can be expected may be very different than what has happened and based on upcoming events or something like that. So what it is technically is a percentage, which is an annualized version of the standard deviation of daily price moves, but you don't need to understand the statistical language. It's better, makes a lot more sense if you just look at an example like Coke, which is generally considered a low volatility stock. I looked at it a couple of weeks ago, it had a 12% implied volatility. So very generally speaking, it means that Coke is expected to move up or down 12% over the course of a year. So not a whole lot if you think about that in terms of a year. And then you compare that to something like Tesla, which is considered a volatile stock, and something like $350 stock that has an implied volatility of 39%. So if you think about, let's just round that up to 40. Think about a $300 stock plus moving 40% up or down a year. That's a ton, right? So there's a big difference in terms of volatility, and as you probably guessed, that impacts the price of the options quite a bit. And just to have some reference, SPY, which I use a lot for trades, is it's the main S&P 500 ETF, the most popular ETF in the world. Last August, when it got to be pretty volatile because of the trade deal stuff and what was going on and some concerns about the economy, it actually got up to about 20%. In July, it was only about 10%. Now, after the last Fed meeting, it got back down to about 10%. So you could see that, generally, 20% is quite a bit for SPY. It doesn't normally, 10% is a lot closer to normal, but you could see that even something like an index can change quite a bit based on events. So that is really the sort of the summary of volatility and why it's important. Oops, there we go. Sorry, mouse disappeared for a minute there. All right, so why trade it? Why trade? This is the $1 million question. Why trade volatility? Well, as I said earlier, it's a lot more predictable than asset prices. And you Google any sort of research on volatility properties, and there's a million academic papers out there that all kind of prove that it has mean reverting characteristics, means it goes back to its sort of middle price quite regularly. And it also has clustering properties, which means it'll kind of hang out, particularly at low levels for long periods of time. So you can use that to your advantage. It's also relatively easy to trade market volatility with ETP, exchange traded products, and just regular option trading. And that's what we're going to talk about. All right. So step number one is follow the volatility metrics. This is kind of your beginner step is to have an idea of what's going on with volatility. You don't want to trade volatility in a vacuum. The best way to do that is to look at VIX. If you're not, most of you, I imagine, are familiar with VIX. If you're not, it's the implied volatility index for the S&P 500. It's heavily quoted. It's heavily traded in terms of its derivative products. A really popular instrument. It's generally the best measure we have of volatility conditions. It's ubiquitous. You can pretty much find it everywhere. To be specific on its usage, it does only measure the S&P 500 volatility, so it doesn't, let's say, measure specifically small caps or European stocks or whatever. It's S&P 500. However, the S&P 500 correlates to just about anything stock related extremely well. So you're not really missing that much by using S&P 500 instead of, let's say, a more encompassing index, a Wilshire 5000 or something like that. I mean, it's all going to be really correlated closely to the S&P 500, but that is what it measures. It can be useful as a signal. As it starts to go up, it might be a good signal to maybe start hedging your portfolio. What I really think it's useful for is sort of an all clear signal. So it can definitely start going up and then maybe come back down, and you don't necessarily need to hedge. That might happen every once in a while, but it's almost always good in reverse as an all clear. Like if we've had some event, stocks have sold off. When the VIX starts going down, you can generally start to be a little bit more aggressive and know that's all right. That's when I can re-enter the market. It does a pretty good job of sort of the all clear signal. All right. So what is the VIX? Well, you can't trade it without memorizing this whole equation on the right. All right. No, that's not true. The calculation isn't even remotely important. What you need to know is that it just measures the 30-day implied volatility. So it's what the market expects to happen with stocks over the next 30 days. So why it's important is that as more people buy options, the VIX goes up, and generally options are purchased when investors are worried, particularly on the downside. They're going to purchase options to protect their portfolio, particularly at the institutional level, right? So as investors are concerned, they buy more puts, the VIX goes up. That's why it's also, you'll hear it called the fear gauge. And so the VIX is really another name of just buying portfolio protection. All right. So the VIX itself is an index. It's not actually tradable. You can trade futures, options, and then ETPs, exchange traded products. The way the VIX is designed, you don't actually have a exchange traded product that truly replicates the VIX. They're all based on futures, but that's where there's some trading opportunities there. But the most popular one is VXX, which is short-term futures. It covers the first and second futures month of the VIX. That's heavily traded, very popular, traded amongst retail and institutional. It's probably leans towards smaller traders, but institutions will use it as well. Now, we used to have a full inverse called XIV, which was an inverse of the VIX. That went away in February of 2018. I'll touch on that in a little bit, but there was a blow up of the short volatility funds. It was basically an overcrowded trade, and then something happened, and these ETPs weren't really prepared for that, and they kind of blew up, and that changed SVXY, which used to be a full inverse, into a half. TVIX is still around. That's a levered 2 times positive VIX, but it's got no options. And then UVXY is the levered one that has options, but they marked it down to 1.5 times. So what happened is we had this blow up. A lot of sort of individual small traders got hurt, so they kind of changed how these work. Now they're redesigning these things to make them better. So there's things go in cycles, and there's going to be a lot more of these products to trade in the near future as they've kind of corrected some of these problems. So I think we're going to have a lot more choices for how to trade this stuff moving forward. It'll take time to get things introduced. So recently there was one, in fact, called Spikes Index, which is very similar to the VIX, except it's based on the SPY instead of the SPX. And it's going to have all new products that come out that are related to it, kind of like these products above are related to the VIX. And then they'll probably have a full inverse and some other things. So there's going to be a lot more choices moving forward. Whether or not they gain traction remains to be seen. But said everything goes in cycles. So I think we'll see a resurgence of this ETP market here coming up. All right, so that's how you track it and that's how you trade it. So let's talk about actual ways of trading it. So step number 2 is we're going to talk about selling volatility. So you're probably aware, I just was talking about February of 2018. There are some notable blowups when it comes to selling volatility. Generally speaking, though, it's extremely profitable to sell volatility. And that's because volatility, as I've mentioned, has mean reverting characteristics, and it's really apparent with the VIX. And what that means for the VIX is that generally it's low and it clusters around low levels. So when it spikes, it tends to come back pretty quickly, unless it's like a major event like February 5th in 2018. It went way up because of what happened with the vol ATPs and then kind of slowly came down. But unless it was a major event, it almost always comes back down to this low level pretty regularly. But the up days generally have a larger magnitude than the down days. So that's where you have to be careful while you do it. But as I've said, the down days come in bunches. Now, the key is that you want to avoid a short volatility strategy. If there's a lot of market uncertainty, particularly like, an election or maybe a Fed meeting or something that could blow up the market, that's probably where you want to avoid these sort of trades, because there's still going to be plenty of opportunities to sell volatility. So let me show you what I mean. This is a fantastic chart put together by Thompson Capital Management. And you can see that over the last 10 years, the VIX has closed under 18. So there's pretty much 3 regimes for the VIX: under 18, 18 to 20, and over 20. 18 to 20 sort of no man's land. If you chart like what stocks have done when the VIX is 18 to 20, it's pretty sideways, like up and down, like no real trend. Over 20 is most stock losses have occurred when VIX is over 20, and then most of the bull market that we're all aware of happens when the VIX is under 18. And you can see VIX is under 18 64% of the time over the last 10 years. So it's almost always in this low regime. And when it does get higher, it comes back down to that low regime pretty quick. So that, of course, gives us some trading opportunities. So I'm going to talk about, when I'm showing some examples of these trading strategies, I'm going to talk about delta. And just in case you're not familiar, that delta means a few things, but it tells you how much an option price will move in relation to the underlying. So a 50 delta option, an at-the-money option, will move 50 cents for every dollar move in the underlying asset. So a 50 delta call, if the stock or whatever goes up $1, the 50 delta call will go up 50 cents, and vice versa if it's a put. They also give you a rough probability of an option finishing in the money. It's very rough, and it's really only accurate over very short-term periods. But 50 delta option basically has a 50% chance of ending up in the money. 30 delta, so 30 delta is less probable that's an out of the money option. So 50 delta options are at the money, below 50 are out of the money. Those are, none of the strategies I'm talking about are going to deal with in the money options. Most of it's going to be out of the money. It's a little bit at the money. So just when I'm using those terms, that's what they mean. All right, so this is a back test from cmlviz.com where I threw in some different information. I ran back tests. So these are the actual sort of trading strategies. I'm going to talk about a couple different things. So this is using that the VXX ETN, which is the short-term futures. Now, this is 5 years worth of data, but I want to stress that this is extremely general, right? I don't put any stops in, for taking profits or closing losers. I have it set to holding to expiration. So in reality, you're going to probably have points where you take gains or close losses. You're probably not going to hold to expiration. So everyone's going to have a little bit individual risk management that is going to change these results. So this is a very general way of looking at it, but I would imagine anything that you add to it would probably improve results. So I think that showing how good these are, even without even any sort of risk management, variables really shows just how powerful it can be. So this is 5 years of buying puts on VXX every 30 days. So you can see I used 50, 40, and 30 delta puts, and you can see that, while when you're doing these at the closer to the money buying puts, you win more than you lose, but then your wins are also really big. So over 5 years, you made 425%. And, once you get to the out of the money, it gets a little bit, you still make money, but you probably have to hold your positions for longer to get the gain. So this is just very simple buying puts in VXX. I'm not saying I necessarily recommend it. I'm just showing that because VIX often goes down and that makes VXX go down, then just simply buying puts without, sort of any sort of complex strategy would have been enough to generally just make money if you did it every single month and forgot about it. Now, if we want to look at, now this would be a more, now if you're talking about you want to actually be a little bit more precise with your strategy, you could instead have sold call spreads, right? Same sort of thing every 5 years. No stops, holding to expiration. If you just sold call spreads, now your wins and losses are just, massive amount of wins per losses. Your returns are a little bit less because you're not making, the amount you're making per trade is less, but then you're winning, 80 to 90% of the time. So this is an even safer strategy. By using call spreads, you're limiting your risk. So even if it blows up on you, it's not gonna impact your long-term strategy by doing this every 30 days for 5 years. Just shows you that, people buy these calls for protection, right? People buy VIX calls because they're worried. So they're overpriced. By selling them, you are going to do really, really well most of the time. Now, I have to put in this disclaimer, and I can't stress this enough. 2018 is a perfect study of why you can't just willy-nilly you can't just do what I said exactly and set it and forget it. Like, you need to use, I showed those as an example of basically no risk management, and they still made money. However, I would never recommend doing a strategy without using risk management, right? So in this case, when you're selling volatility, an easy thing to do is just avoid really volatile periods, or periods you expect to be really volatile, right? So don't do this trade over like an election period or a Fed meeting or even a jobs report. Even if they're going to work most of the time, why even take that chance? If you know you're going to win the vast majority of the time, avoid the times that potentially could be, blow up periods. The thing is that funds, institutions use VIX to hedge. So there's always demand for long VIX, and they'll buy in a hurry if something crazy happens. So it'll go up in a hurry and you'll hit max loss on, let's say, those call spreads. And even though it's, not a big deal with that strategy to hit max loss a few times, you still want to avoid it as much as possible. And VIX can blow up in a hurry. So really a good idea to exit positions when it's really volatile, a volatile period, some major news item, just stay out of the market until it starts to come back down. Now, even so, those strategies are designed to limit risk. So for instance, buying a put, obviously there's very little risk. It's just whatever you pay for the put. Selling a call spread, it just has to do with how wide your call spread is, but it's still very risk limiting. Also, a really easy thing to do because volatility goes down, as I showed you in that chart, 64% of the time it's going to close under 18. If you just wait for it to start going down, you still have plenty of time to get in while it fades back down. So you can wait for a vol spike, then do this, and in fact, you could only wait for a volatility spike and then do this, and then you won't have as many trades, but you're pretty much going to have a really, really high success rate. All right, now this is what I think worth the price of admission here, because you're not going to really see this. There may have been an article on Bloomberg, once on this. This is a topic that I think I'm really adding some value, hopefully, to your lives by telling you about this, because it's not really well known. But volatility selling, it's been traditionally a way how speculators have made money, as they take the other side of hedgers, right? So a lot of people hedging, a fair amount of people selling volatility to those hedgers, and generally because people use it to hedge, there's this premium on these, whether it be, let's say, index puts or VIX calls or whatever people use to hedge, there's a premium because a lot of people buy it no matter what because they want to hedge. And so that sort of gap between what they should be worth and what people are paying for it is known as a volatility risk premium. And it's been there for basically forever, like throughout recorded history. And a lot of people, will use it as a main strategy. Collecting that VRP, as it's called, is a consistent way to generate yield. Now, the problem is in recent years that fixed income products have no yields, right? Interest rates are so low that fixed income products are basically, they pay almost nothing. They're safe, but they don't make any money, right? They don't make any, the income from it is just minuscule, right? So a lot of pension funds in particular have moved into this field of collecting VRP. Now, it takes them about 5 to 7 years to make a strategy decision, which means it'll probably be 5 to 7 years before they were to exit it. So this is a thing that's probably a major structural change. And what's happening is that probably, 10, 20% of hedge funds are already in this and more coming. They're pushing billions of dollars systematically into the strategy of selling volatility in the index, and it's depressing the VRP. It's depressing this gap. So it's actually making it a little bit, for the first time in, oops, what's going on here? Sorry. Getting a little ahead of myself. No, sorry, I'm getting behind myself. Let's go the other way. All right. This is from Bloomberg. This is the one article that I've actually seen on this. You can see that, in particular, look at this red line. That's the average of the VRP as what I was talking about. And you can see since basically 2016, it's gone really low, like lower than it ever has been, except for, back, like 10 years ago. And that was very temporary. Now, again, like things go in cycles and this could be temporary as well. But there is the difference here is that these pension funds are selling volatility risk premium and they're doing it systematically. So this number has gone way down and it's making it less profitable to sell volatility, at least in indexes, right? There's still opportunities in lots of other products and maybe indexes that don't trade as much. But in terms of the major indices, it's the risk reward for selling VRP is not what it used to be. So of course, if that means vice versa, if selling volatility isn't what it used to be, then buying volatility may make sense, right? It's harder. Now, the problem with buying volatility, it's harder. You can't just buy it every month like you can with selling volatility. You do that strategy, you're going to lose. As you're going to take the opposite side of that, you're going to lose the vast majority of the time. Now, when you win, it's going to be a big hit. But meanwhile, like nobody wants to lose 11 months out of 12 and wait for the big hit. It's just not a sustainable strategy. So you have to, you have to probably have some kind of system, like you're waiting for a major event or you're just waiting for it to be really, really cheap. And then you're buying like a longer term option. I mean, there's different ways to do this. I'm going to show you some examples, but there are actual times where it actually makes sense to buy volatility, which is not the way it normally has been statistically. So again, there's limitations. It's not super easy to pick when to buy volatility, right? It's much easier when you're selling volatility. You can say, oh, okay, the VIX is up or it's spiked. I'm going to make sure it's topped out and then I'm going to sell. All right, easy enough to have a strategy that just sells volatility after every time it kind of spikes. Now, as I said, if you just try to buy volatility all the time, it's probably going to kill you. So you need to, you need to try to time it. So generally, you want to wait for some kind of opportunity, like, maybe you're buying it a month ahead of the election, or maybe you're buying, in a stock, before earnings, and something that is based on some kind of event. That could be one way of doing it. You could just wait for it to be really cheap. And again, try to buy it really cheap and just wait for smaller moves. I mean, there's different things you can do, but let's look at some examples. So I used the last 2 years because that is the last two, that's when the VRP has been diminishing from that chart you saw. Since 2016, 2017 is really when this has been more useful to buy. And the same sort of thing, no stops holding to expiration. But you could see why when this is a harder strategy to win at constantly. You don't have nearly as many wins, right? So buying 50 delta call every 30 days, buying 40, buying 30, you're going to lose most of the time, but when you win big. So particularly with a 40 delta call, 40%, but you're getting that from 4 trades. So much harder to do this, but actually a strategy that could, and this is buying every month, and even buying every month made money over the last 2 years because of the VRP being so low. Still, you're probably going to want to put in some sort of plan, right? Again, maybe based on events or maybe just based on how low it gets. But then this is as simple as just buying calls. Now let's look at buying call spreads instead, which would be, a much smarter way to do it since VIX calls can be expensive because they're used for hedging. Even with the VRP being so low, they're still, from an absolute value standpoint, they're very expensive. So buying one and selling a higher one. Now, the only one that doesn't work is buying the 50 and selling the 40. And my theory on that is because when things, people bid up that 50 call, that at the money call, that's what people rush into when they're scared. So it's been overpriced to the point where it's not profitable to do that. But if you just go a little bit out of the money, you can see your win-loss ratio is still, unfavorable, but your percentage wins are a lot higher, right? Because you're not spending nearly as much money. So that's what I was talking about, finding when volatility is really low, then maybe doing a cheap longer term spread or something like that. So if it doesn't work out, it doesn't kill you. But if it does work out, you've done really well. Again, buying volatility is not easy because timing the market is not easy. However, there is opportunity there, and it's just a matter of, tweaking your system and trying to figure that out. All right. So I've been talking about just trading ETPs, but the ETPs, exchange traded products, only relate to the VIX, which only relates to market volatility. Now, what if you want to do these sort of strategies with individual stocks or commodities or something like that? Well, it's easy enough to buy. It's much harder to sell, just pure selling volatility, because selling options for volatility trades is going to require a ton of margin. So it's very difficult to do. There's not really an easy way around that. There are some tricks you can do to lower margin, but for the most part, selling volatility is difficult to do for individual options. So probably if you're, more of a casual trader, I recommend just using the ETPs and doing it for selling market volatility. Now, buying volatility in individual stocks is a lot easier because you can use something like a straddle or a strangle, which I'll show in the next. I'll show on the next chart. I do stuff like this in that $49 service. I'll look for really inexpensive straddles and strangles and buy them. So that's what I like to do if I want to buy volatility for relatively cheap. So just to show you some examples of a straddle versus a strangle, this is the SPY, again, the S&P 500 ETF, this using the January 3rd. So this was a 30-day straddle. You buy the call and put at the money. In this case, it was 312. So with SPY was at 312. You buy the 312 call in January, the 312 put. It's expensive. Costs you $877. So $877 per straddle, which means it needs to move, roughly $9 in each direction to make money. But it's unlimited if it goes up or down from that point. So you don't need to know which direction. You're just buying volatility. You expect it to move. Now, all right, so you say, all right, well, that's really expensive. It really needs to move a lot. Well, then that's roughly, not quite 3%. Now, 3% over the course of a month is certainly doable. But what if you look at the strangle, which is what I like to do? A strangle doesn't use the at the monies, it uses a little bit out of the money. So in this case, it uses a 302 put and a 317 and a half call. Now, you still need to move quite a bit, right? There's a wider range. However, it only costs $3.40. So you're spending, less than half, closer to a third as much to buy it. Now you need to move farther away. However, if you expect volatility to happen, then you're going to get it. And it doesn't necessarily even have to get all the way to these strikes. If it happens quickly, you might be able to sell one out for a profit pretty quickly and then hold the other one. So it gives you some choices when you're doing the strangle. If you're managing it, the same thing with the straddle. You can do, you don't have to hold everything to expiration. You can close one and then close the other. And so it gives you some choices. It's still costly strategies when you're doing it on an expensive product like SPY, which is in 312. But now imagine doing this on like a $20 product, like maybe there's a $20 ETF. Like I've done this before on USO, which is the oil ETF. If I expect oil volatility to go up, and that was only like an $11 stock at the time. So then you're only spending about 70, 80 cents on a straddle. So you don't need it to move that much at all in terms of, percentage wise, it's about the same, but it doesn't take a lot for oil to move, 70 or 80 cents in a month if some kind of event happens. Like, for instance, it was just yesterday where Saudi cut their oil production surprisingly, and oil, got jacked up in a hurry. That would have been enough to win on a basic sort of 1 month straddle or strangle on USO. So just an interesting way to trade. It gives you some more options for trading volatility in individual products rather than index vol. All right, so here's my summary. Keep an eye on the VIX. That's step one. Just know what the VIX is, know what the general exchange traded products are, know their limitations. Selling volatility is extremely high probability of success, but can be dangerous because of the spikes. So you need to use risk management. Lately, because of the shrinking VRP, buying volatility has become actually more attractive, but it's a lot harder to time. It's a trickier strategy, but has become a lot more attractive recently. And then besides trading market volatility itself, like using the ETPs, you can actually trade option strategies in individual stocks by using straddles and strangles. All right, so I do a lot of this stuff in my service Option Floor Trader, Option Floor Trader Pro. You can check it out, optionsfloortrader.com. What's great about this is that it's $49, literally $49 for the whole year. And it's a trade every other week. I do a trade. Usually, it's either volatility related. I do directional trades too, but there's some volatility taken in account in a lot of those trades. So I kind of mix it. It's kind of everything. It's really all different sort of option strategies, but it's very simple. It's only buying calls and puts because I want it to be really easy for people who've never traded options to get in and trade. I don't want you to have a higher level of permission in your options account. I want to be able to make it as easy as possible. So usually anybody can get access to buy calls or puts just by asking your broker. So again, about 2 trades per month. I do, rate all these trades, use analytics, make detailed instructions. And there's always an education section in every newsletter, so you can learn a lot about it. And there's a full year money back guarantee, because even though it's only $49, if you're not going to use it, I want you to, take your money back. So, I want people to be happy with it. So I think it's a great product, and it's a really great way to learn trading options and get an idea for volatility trading without a lot of risk. So that's, if you go to optionsfloortrader.com, you can buy that. Oops. All right. So that is everything I have. Hopefully it was educational.
Hello. Hello.
Yeah.
Hey, thanks, Jag. You're a little early. We don't even have our next presenter here yet, but I'm not seeing a lot of questions. We did have somebody come in from YouTube, say that had some questions. I'm not sure they're really too on topic, though. He wanted to know how you avoid bad stock manipulation. And can you see it in volume?
Yeah, it's a tough call, because in most of the very liquid stocks, you're not going to have to deal with it, right? Stock manipulation is really the realm of really low liquidity stocks. And I generally don't, and most of those, either don't have options or their options have bid-ask spreads that are so wide that I don't even really deal with those. So, I mean, a way to avoid it is to just not trade that sort of thing. I stick to very liquid stocks. I like my bid-ask spreads to be narrow where you're not giving up a bunch of edge having to even get into the trade. So, I mean, it's not exactly the answer to that, but I would say, the more you avoid illiquid stuff, the better you are when it comes to manipulation.
Okay. And David wants to know, can we email questions to you if we get the service?
Yeah, of course. Always.
Tony wants to know what the range of return in the past has been.
Let's see. So I'll have to think. I don't have it in front of me. We've had this service for about a year. And we had we got off to a really good start, and then the volatile periods during the year kind of hurt me. But then the last couple months have been really good. So I don't know. I mean, I don't know off the top of my head. I would say we're probably at about a 40% win rate, which is, I think, is really good for a long option strategy. Keep in mind, long option strategies, like I showed you with the buying the options on the buying the volatility, is you're going to have less wins than you are losses because of the nature of the business, but your wins are going to be much bigger. So I try to shoot for as close to 50% as possible. But we're probably about, 40% I think is pretty realistic for a buying strategy. And I think that's about where we are. So again, the key is you want your winners to be a lot bigger than your losers to make up for it, because buying options with time to gain and all that is going to be, can be challenging. But it's also the best way to learn because you're not risking a lot of capital.
Am I live? Yeah. Okay. Bruno wants to know if there's a trend for higher above 20% in the coming 24 months. Do you expect the VIX to rise above 26%?
In the next, how long? Sorry, 24 months?
24 months, yeah.
24 months is I think when it comes to volatility, I mean, predicting long-term volatility is, I'm going to say impossible, but I mean, even if you look at like the VIX term structure only goes out about a year. So there's not even an exchange traded betting market for that. I mean, maybe you'll find something here or there, but anybody who trades that sort of long for volatility is probably institutional trader trading like variant swaps or something like that. It's really, really hard to predict that. I would say that in the next year, there may be a possibility for that simply because we have the election coming up and there's a lot of uncertainty around that. So it's possible. I don't see a 20% VIX, in the near future, unless, we get some sort of crazy, bad economic news or something like that. But after this latest jobs report, I actually expect volatility to remain pretty low for the time being until we get closer to the election.
Steve asks, do you have a comparison or a difference between TVIX and UVXY?
Yeah. They're pretty similar. The main difference is that UVXY is 150% levered, so it's 1.5 times the short, basically VXX, where TVIX is 2 times as much, but TVIX does not have options and UVXY does.
It's a pretty big difference. All right. Very good. Well, I think I'm going to say thank you for coming, Jay. We really appreciate it. And so to take advantage of that, go to optionsfloortrader.com to sign up. And any final thoughts?
No, thanks for having me on. I'll try to find about 10 minutes more material for next
It's okay. I'm going to go in and show how easy it is to run a scan for Metastock. I can talk all day, man. It's cool. I appreciate the extra time. All right. Thank you, Jay.
Thanks for having me. I appreciate it.
No problem. Okay. All right. Let's go ahead and kind of just give me a second. Let's go ahead and get kind of changed back over a little bit here. And you should be able to see my screen again. So, and I am just going to kind of do this really quick while I'm thinking about it. And I actually do really appreciate the extra time because I did want to kind of have a chance to talk a little bit more about how these expert add-ons work in Metastock. And for example, how easy it is to kind of go in and run an exploration and kind of go in. Because I think that's one of the most powerful parts about Metastock. So let me just go ahead and kind of drift over here to the Metastock chart. I've gotten right here, I've got the Apple. The AAPL.O. We had talked a little bit about the Big Trend Toolkit before, and I just am double checking to make sure that everybody can see my screen. So it looks like things are going well. One of the questions that we get a lot, and one of the things I think is most valuable about Metastock is the ability to skip over, as Price would say from earlier, the little opportunities and focus on the ones that have a big opportunity. So we'll talk a little bit more about scanning coming up when I spend an hour talking in an hour. But I want to show you how easy that is to kind of go in and manipulate and find. So I'm going to go ahead and open up what we call our Power Console right here for Metastock. Right here you've got the chart, you've got the quote option, you've got the scanner. This is our Metastock Explorer. You've got the ability to test trading ideas. We have a really cool system test. And in fact, I'm going to talk a little bit about how you can use system testing to kind of find what you should be scanning in the first place, and then our forecaster as well as our option scope program. Anytime you want to run a scan or an exploration, we call it an exploration. Somebody asked me the other day, why do you call it an exploration? And I was like, that's a really good question that I haven't gotten in 23 years. So, maybe Steve Akalis, the guy that started Metastock, really, really liked Indiana Jones. I'm not sure. But I do love the Explorer as a scan because unlike a lot of products, like we really have the ability to go in and scan through an entire list to find exactly what you're looking for. So this is a Metastock scanner. We've got I've got 37 explorations that I've marked as my favorites for the purpose of the demo today. And underneath here, you've got all of the explorations. So I'm just going to go ahead and unselect all of the favorite explorations. And what I'm going to do is I'm going to go ahead and let's say we just wanted to, I'm not going to go into the concepts of acceleration bands, of Price Headley. That would take a little bit too long. But let's say you really like Price Headley's work and you wanted to be able to find stocks right now that were having an acceleration band buy signal or an acceleration band sell signal. So what I'm going to do is I'm going to go ahead and select the exploration I want to run. You'll notice when I hover over, it kind of gives me a bit of a description of the actual scan I'm about to run. So this was designed by Price Headley to signify, and of course it goes away, strong accelerating trends which show the potential for dramatic price movement. So let's go ahead and run that one. And down here, I've got the different lists that I can run. Now, I've actually downloaded data so I can run scans really, really quickly. And I do that for the purposes of the demos, but I also do that on a daily basis so that I can run scans really quickly on an end-of-day basis to find opportunities for the next day. So we're going to run it just this acceleration band set up against the S&P 500. There's a bit of a watch list I could run against, or I could, there's a couple of different lists that I could use right here. But let's just do the S&P 500. I'll go ahead and start that as an exploration. And you don't really need to worry too much about the options over here. I am scanning on a daily basis. You can change that if you're using real time. You could do intraday scanning as well. And I'm just going to go ahead and click the Start Scan button right here. And you'll notice how fast it goes through the S&P 500. It really, really tears through them. Okay. Over here, we've got a list of the stocks that have a buy or a short or an exit or a short exit. And I can sort based on these columns. So if I was looking for a long opportunity for Monday, what I'd be looking for is the buy column. Right now, there's only one buy opportunity that exists on the chart right here. It's Newmont Mining. Okay. And I also have the big trend score that we talked a little bit about earlier. Now, the big trend score is what Price and I worked on as an addition to the Big Trend Toolkit 3. So what it does is it looks at all of his 10 of his favorite indicators, and it gives you a score of between 100 and minus 100. So 80 would be very, very bullish. 100 would be the most bullish. minus 100 would be the most bearish. This one right here is looking at an 80. So I'm going to go ahead and, since this is the only long opportunity, I'm going to go ahead and open that on a chart, which I can do just by clicking on here. And what I want to do right now is actually, right now we're looking at the big trend score breakdown, which we can do that. If we wanted to kind of see how everything was kind of lining up right now, we could see all the indicators that were showing bullish or bearish or neutral. The score that we come up, the proprietary blend, gives us that 80. Okay, right here we've got the setup. We're looking for a little bit of a trigger. The trigger will happen on Monday if it goes above the high. Okay, and what I'm going to do right now is I'm actually going to attach the proper expert. So I did a specific scan for the acceleration band system because it's a system that works really, really well on a variety of instruments. What I'm going to do now is I'm just going to switch this so that we're looking for the acceleration bands signals to get into the market. So I'm going to go ahead and attach that right here. I'm going to go ahead and click on close. And right now we're seeing that buy arrow that we scanned for. Okay, but right here the acceleration bands is currently indicating a long opportunity. If this bar is closed and the prior blues cars are above the 20 bar acceleration band, then this is considered a buy signal. So normally I'd go ahead and put the acceleration bands on this chart. Actually, this is probably the acceleration bands. No, these are the big trend bands. But again, what you're going to get is traders interested in taking advantage of this opportunity should look at buying the stock or the option trade in the second expiration month, as these signals can last 1 to 20 days. Very aggressive option traders will typically look at call options one strike out of the money or near the money around $200 or more. Traders should look to exit this position if the futures bar's close is less than the upper acceleration band, and you could look to exit at this particular point as well. So that's a little bit of an idea of kind of how scanning works in Metastock. It's really easy. It's very, very fast. It's just like how fast it went through those 500 stocks for us. And the expert advisor commentary as well. So I think our next presenter is having a bit of a hard time finding his presenter link, so I'm going to give him a call in a second. But here is that summit package. So you can get Metastock real time, the Zenith data, the Knoxville Divergence, that big trend toolkit, the Fulgent artificial intelligence add-on, the setups and timing triggers, Unleash the Power of Metastock, and 2 years of Stocks and Commodities magazine. Normally that's $17.44. It's $8.96. You get a savings of $848. You can give us a call at 800-882-3040, or you can chat live with us at metastock.com/saleschat. Okay. Now, give me just a second here. I'm going to go ahead and we're going to go ahead and take just a quick break. If you're watching through GoToWebinar, you're going to see a very, very fancy video put together by Greg Lewis. So in any case, give me just a second, and we're going to figure out how we can help our next presenter get online. So 1 second, please.
If you're a trader, you've probably heard of Metastock. After all, Metastock has been helping traders for over 25 years. But what is Metastock, and how can it help you make better trading decisions? Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? And of course, when should I enter and exit a trade? At the core of Metastock are the power tools. The power tools give professional-grade analysis tools to private traders. You can scan the markets to filter and sort securities that show buy and sell signals based on your criteria. You can test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. And unlike most tools, Metastock allows you to test multiple strategies on multiple securities. You can analyze stocks, currencies, futures, ETFs, E-minis, just about anything. And Metastock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the ease of use and built-in systems like the very popular Rahul Mohinder oscillator. Advanced traders will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you're going to love Metastock Zenith, the real-time news, data, and analysis package. Metastock Zenith is a comprehensive and flexible system with an extremely powerful search tool, which includes fundamental and economic data, and an array of options tools that have never been available before to the private trader. Add on the free world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 20 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
All right, welcome back, everybody. I hope you're doing well. We do have our next presenter, and so we're glad we could get him in here. Let's go ahead and I do want to say thank you to Stocks and Commodities for sponsoring today's event. They always do a great job. Greg, will you go ahead and post the link in there again for me? And if you don't have it, don't worry about it. I'll send it in just a second. Let's go ahead and actually that was a perfect little bit of a break for us. Let's go ahead and talk a little bit about Rob Booker. Rob is, I think, well known for being one of the nicest people on earth. Is that true, Rob?
Absolutely not.
Well, welcome to today's webinar. I'm glad we got you in, and I'm glad it wasn't that big of a deal once we got you the proper links and everything. So
that's great. No, it's so nice to be here.
We could even say maybe we did it on purpose so we could play that really nice "What is Metastock" video for everybody. All right, let's go.
That's great. I actually enjoyed that. I got to watch it as an attendee while I was getting the link.
All right. Well, here, let's go ahead and make you the presenter here. And I'll let you know when we can see your screen. You sound okay?
Yeah, perfect. And I'm just giving permission to record my screen here in... Oh, wow. It says GoToMeeting will not be able to record the contents of my screen until it's quit.
Yeah,
so
no, that's because we're already recording it.
Okay, cool.
Yeah, don't worry about that. In fact, we don't actually, you can say hello to both GoToWebinar and YouTube right now if you want to. We're actually simulcasting it.
Hey, everybody out there, it's nice to be with you. Good to be here.
All right. I don't see your screen yet, though.
Okay, let's see here. Oh, I see what's going on here. Oh, no, you should see it.
I see it. I see it now. Yeah.
Okay, cool. Perfect.
Yep, we see it. It's ready to go full screen. And I'm just going to get out of your way since we're just a few minutes late.
Okay, great. Hey, everybody. Super excited to be.
Oh.
Pleasure to be here together with you. I've got kind of a dual presentation ready for you today. But first, I just want to say, again, how excited I am to be here together with you. And some of the best stuff I've ever done is on the way in this presentation. So if you've ever wondered about finding those once in a lifetime trades, the bigger ones, we're going to talk about that today. And we're going to talk about the 3 patterns that I use to find them. but a basic element of every analysis that I do is Knoxville Divergence. So I want to just take a minute, because this is kind of a special presentation together here with Jeff and Metastock, and I've really loved working with them over the years. And I've been doing this for 20 years. And I built this indicator about 10 years ago, but the platform that it looks the best on is Metastock. So before I jump into the presentation, I wanted to share a few minutes of what this indicator is and the background on this indicator really quickly. And you can get it through one of the packages on Metastock. So hi, my name is Rob Booker. I'll do a more complete introduction in just a minute, but I want to jump right into the charts, and I want to talk to you about the basic indicator, the most important analysis that I do when I'm looking for big trades, and in particular, as we're going to talk about in a minute, what I call monster trades. So at the bottom of the screen here, you're going to see these two red circles, and they are showing bullish divergences. And if you've never looked at divergences before, it's definitely worth your time. And a divergence is when price is moving in one direction, but an oscillator or some type of indicator is moving in the other direction as a disagreement. It's a disagreement between price and an oscillator. So on the screen right here, you can see these two green lines circled in red, and I call those Knoxville divergences because I built the indicator in Knoxville, Tennessee, on a trip through across the country where I was staying overnight with listeners to my radio show, and we were hanging out and trading together and telling stories and whatever else. And these bullish divergences, I built this in the Java City Cafe in Knoxville, Tennessee. These show that price was moving downward, but the momentum indicator was actually at the same time moving slightly upward, which is crazy and shouldn't be happening. And you can see here, this is on the Metastock platform. And at the same time that the price was moving down and the momentum indicator was moving up, the relative strength index was oversold, thus suggesting that price had moved too low, too far, too fast. And just like when you throw, let's say, a ball filled with air into the water, it might dip slightly underneath the water, but the momentum is going to quickly shift in the opposite direction. And that's just physics. And Knoxville divergence is kind of just like market physics. It's just a way of showing that something has moved down too far, too fast, and needs to come up and move in the opposite direction. So if we move on to the next slide here in just a second, if I can, you'll see an example of a bearish divergence. And in this chart on the Metastock platform, you'll see that there's a red line going upward. I drew it in green, but the charting platform will draw it in red. And that's showing that price is moving upward, but the momentum indicator is actually moving down. It's like if you threw a ball up in the air and it started to drop. At the moment that you threw the ball in the air, it would be moving the fastest. And if you took a photograph of that ball at the highest point that it made, the photograph wouldn't necessarily show at that point in time that it was traveling slower. But you and I both know that as the ball travels upward, it's just physics. It has to start to switch in the opposite direction. And that's a momentum shift. That's exactly what you can show in the market. It's just market physics. And if at the same time that is happening, which is called divergence, the relative strength index is overbought, what you get is this really great combination of factors. Price has been moving up too far, too fast. Momentum is shifting like a ball that has been thrown up into the air. And the relative strength index is showing that there's an anomaly, that price doesn't often, if the relative strength index is set to 21, price doesn't often move into overbought territory at all. But when you combine that overbought territory with divergence, you have something extra special. And I call it Knoxville divergence. And on the platform inside of Metastock, you can see examples of this, whether it's currency pairs or the favorite stocks that you trade. You can see this over and over and over again, that these Knoxville divergences will appear near or at the extreme lows or highs or swing lows, swing lows and swing highs that a financial instrument will make. So here's an example of the euro yen making a bearish divergence. And whether you want to trade on the short-term charts or the long-term charts, the daily charts, or the 5-minute charts, you're going to see examples of this appear at lows and highs. So there we go. There's a bearish set of bearish divergences. And when they match up right next to each other, that's particularly interesting. Or you'll see a smaller line. Sometimes you'll see what I call a tiny Nashville, or a small divergence, which is made up of just 10 or fewer candles. These are really, really interesting moments in time where the market has just reached a point where it cannot move any further without some kind of release of its energy that it has been putting forward in one direction or the other. So whether it's the CAD yen or the SPY or Tesla or Snapchat or any other financial instrument that you want to look at, you are going to see Knoxville divergences print. It could even be the Chinese yuan. It could be the euro British pound around Brexit. And occasionally, as with any other indicator, you're going to have times when price will make a Knoxville divergence, and then it will just continue to make higher highs. And that will invalidate the setup. And so, of course, as with any other indicator, not all of the signals are valid, and stop losses and proper risk management is always a great idea. But a lot of the time, you're going to see that at exact lows and exact highs, whether in the currency market, the stock market, or the futures market, you're going to see a Knoxville divergence at the extreme levels. Now, occasionally, what you'll have are situations where, let's say, for instance, let's say this, this is Apple. So Apple is one of those financial instruments that tends to, despite this week as an exception, but tends to just move up. And so let's say that you've got a favorite financial instrument with great fundamentals and in the midst of a significant trend. You might drop down to a lower time frame chart and only look for bullish Knoxville divergences to buy your favorite financial instrument. And then you may, when you see a bearish divergence, you may just ignore that signal completely, or only expect a very small reaction to that bearish divergence. Because, like I said, if you know the fundamentals in this financial instrument are great, you don't really want to trade against those fundamentals. So you might be a fan of Tesla, or you might not be a fan of Tesla. And there was a time where no one in the world thought Tesla was good, and there was a time when everyone in the world thought Tesla couldn't do any wrong. So you have to also just use proper risk management, because sometimes you'll get a bullish divergence and price will continue to make lower lows, invalidating the signal, and then you'll get an extreme low again, and you've got to be willing, if you love the financial instrument, to give it another chance to come back from whatever it was doing. So this is Groupon. I used to make fun of Groupon as sort of the world's worst fundamental financial instrument. But what's crazy is on Groupon, on 5-minute and 15-minute charts, it's actually been one of the greatest bullish divergence, Knoxville divergence financial instruments that exists. And although I don't want to buy and hold Groupon for long periods of time, as a swing trading instrument, it's absolutely marvelous. And as you get started with the indicator, you might find some financial instruments that you really see that it works well on. And then others like Google. You don't really want to be selling Google. So you do want to factor in the fundamentals, and you want to say, well, this is a super high quality company that everybody in the world loves so much, and I don't really want to go against the grain. And then at other times, you might really definitely be loving the bullish divergences, like on Qualcomm, like a lot of people love it. Or you might really think that bank stocks need to take a break and need to fall. So for Bank of America, for example, you might be on the lookout for bearish divergences and then buy puts or do whatever it is. Or with ExxonMobil or whatever else, you may find that you want to be bullish or bearish depending on your own personal fundamental outlook. So that's how I wanted to start things off, because this is a special presentation here with Metastock, and I do love working with Jeff, and I do love working with the folks at Metastock. This presentation that I'm about to give you expands on everything that I just said, but it's a brand new presentation. And so I wanted to make sure that I got those Metastock charts in at the beginning of my presentation, because peppered throughout this Monster Trades presentation, you might see a less important charting platform with which I had a contract that now is expired. It just recently expired, and I'm free to change all the charts in this presentation to Metastock charts. But in preparation for today, we just didn't get all of that transition done. So I wanted to make sure we spent some time with Metastock to start things off. So if you are ready to learn about the biggest trades in the world, give me a thumbs up or a heck yes. And we're going to get this thing started. It's 15 minutes past the hour. Hopefully I'll present for about 35 minutes and leave tons of time for questions. And let's get started. This librarian holds the secret to unlocking huge trades. So who wants to hear about the librarian? You want to give me a thumbs up? You want to give me a yes in the comments? You want to give me a no, and then you want to go do something else with your time? That's fine. But most of you are probably going to say yes, because this is the secret to one of the most substantial patterns that I've ever found in the markets. And later on in this presentation, I want to share with you why the person sitting in row 37A on this United Airlines flight is such an important individual, and why it holds sort of a key element to why this pattern is so successful. So I'm going to share that with you later on, but I want you to think about that as we get started. So more about that, but first, I have a confession to make. I am super obsessed about something, and 2019 was the year that I really got serious about it. And I always spend December sort of visualizing what my next year is going to be like. And last December, I got obsessed about something. As the market was crashing, and as the VIX was going out of control, and as there were some of the biggest trades that I had taken in all of 2018, I began to be obsessed with something. I mean, thinking about it from the moment I woke up until the moment I went to sleep, and staying up late after the kids and everybody had gone to sleep and doing research. It's the same kind of obsession that you could see in films like The Big Short. If you watch this movie, Steve Carell, Michael Scarn, Michael Scott, or Ryan Gosling, or any of the number of, this is the guy from Succession on HBO, actually. Anyway, remember this movie where Steve Carell, in the midst of the guy from Deutsche Bank announcing some bad news, starts to think deeply and has an epiphany that leads to the biggest trade of his life? Every single character in this movie is based on a real person, like Michael Burry, the Stanford doctor, student that became one of the most successful traders of all time. Each one of these individuals first became obsessed with an idea and then dedicated themselves to perfecting it. That's exactly what this presentation is about. Now, I'm sure a lot of you have read Market Wizards. Has anybody here not read Market Wizards? Have you ever, so if anybody here's never read it before, I'd actually kind of be thrilled to hear that you hadn't, because it's such a famous book in all of trading. So many of you, so many of us, like, our introduction to the financial markets came from reading the Market Wizards book. And the first one is the classic and the best one, although there were sequels. This was a really, really big part of what inspired me when I got started in trading. And it's really the stories of top traders. And each one of them, if you read these stories, each one of them became obsessed with a technique or a trick, or they exploited some loophole that they had found. Nothing illegal, but stuff that most other people weren't looking at. And that's what this presentation is about. If you haven't read this book, I strongly encourage you. So Luis Lontop, I don't know, see your last name. I'm going to type in my email address, Luis. You send me an email, and I'm going to send you a copy of Market Wizards. Okay, so here we go. Let's continue. So Market Wizards. So the reason I talk about all of these things is first and foremost to say there's a lot you can learn from just movies or books or outside of even the stuff that I'm going to teach you today. And my goal here today is to build some trust and teach you something that I think is going to push forward your education and leave you better than I found you, and capable of finding some of these spectacular big trades by yourself. So I want to talk about really big trades. I want to give away some prizes, and then I want to ask if you and I can work together. So that's the format of today's presentation. That's how I'd want to be treated. I'd want you to be upfront with me, and I figure you probably want me to be upfront with you. Like, if we just set aside the webinar for a minute and we imagine that I'm just sitting across from you, Randall or Joseph or John or Tim or Michael or Jeff or Ann or anybody else or Herman, if we're just sitting across from each other and we're having this conversation, I'm sure that what you want me to do first is share with you some patterns that really work, that you can use after we're gone and you never have to talk to me again. And then for some of you, you might want to take it a step further and work together. So at the end of this presentation, I'm going to stop everything and I'm going to tell you I'm about to go into a sales pitch. And then if you want to, you can mute the microphone and you can step away and it's not going to offend me, but I'm going to give you advance notice for that so that you don't feel like it creeps up on you and all of a sudden you're getting pitched on something. But I am going to sell something at the end, and I'm going to be super blunt about it, and I'm going to be super salesy about it. But until then, it's going to be all content. So I'm going to give you a warning and separate the presentation into those two sections. Okay, that sounds all right to you. Let's keep this going. So this presentation is specifically for people who want more time, want to get into some advanced trading techniques, and you want ideas for trades that are like 20-to-1 risk to reward. Because I'm obsessed with finding the big trades. In the same way that explorers are obsessed with finding some city of gold, or Indiana Jones would be obsessed with finding some idol in the jungle, I am obsessed with, in combination with everything else I do, I'm obsessed with finding the big trades. I mean, what if your max risk was $1 and the reward was $20? That means that $1 could become $20, $10 could become $200, and $100 could become $2,000. And this technique is designed to be used with a section of your capital that you're willing to risk. So you could just have $100 and put it towards a trade that has the potential to make $2,000. And if it doesn't work out, then you're literally only risking $100 or $10 or whatever, meaning small risk, potential for great reward. You can see how you could quickly scale an account with this. Big, monster-sized gains. So I call these monster trades. So let's say you started with $25 and you took a 20-to-1 trade together with us. That would turn into $500. So I want to stop for a second here and I want to ask, what would you do with an extra $500? I want to hear Randall, Jeff, John, Tim, Ann, Herman, Michael, Steve, Dennis. Hey, Steve, I know you. Hey, Frenchie, BH, David, Martin, Gennady, Rama, Sunil, Klein, Bruno, everybody. What would you do with an extra $500? Like, just take a second here, jump into the questions panel here. If you're watching on YouTube, hopefully you can leave a comment in the YouTube or whatever it is, but jump in here and talk to me about what you would do. John would reinvest it. I'd love to hear some more answers. What would you do with an extra $500 if you were able to do that? All right, so keep those answers coming. I'm super interested in everything that you have to say, and it's really important for me to, as you participate together with me. So Herman's going to reinvest it. Jeff's going to pay some bills. I love it, Jeff. I love it. There is nothing that feels better, Jeff, than having all those bills paid. Do you agree with me, Jeff? Ann would go on vacation. That is so awesome. Tim would buy my new coaching service. That's really cool, Tim. I really appreciate that. Buy a trading program, risk it again, and get another 20-to-1. A weekend getaway, Neil. Give the money to a friend of mine who's in trouble. So Gennady Mativ, you send me an email to wrbooker.com, rob@wrbooker.com. I'm sending that privately. Gennady Matviv, you send that to me, and I'm going to PayPal you $500. Thank you for being here. Thanks for wanting to help a friend. I think that's a noble, important thing to do. So That is awesome. So that's what I'm here to do, is to help you first. Before I ever ask you to work with me, I'm here to help you first. So Gennady, we're going to help your friend. You send me that email, we'll get you taken care of. One of my team members will get in touch with you on Monday. I think that $500, as small as it sounds to some people, is a substantial amount of money to me. And over, $500 is life-changing. I spent 3 days this week in Alabama, had the police come, stop us on the street, got kicked out of a restaurant, jumped into a nail salon with my camera crew, and we gave away $2,000 in the nail salon. We gave away $1,000 at the restaurant that we got kicked out of. I met a biker at a bar, and we filmed the whole interaction. And we had each of these people trade my account and see how simple some of this stuff is. And it was amazing. And one of the things that I do is I turn around and I talk about how $500 at a time or $1,000 at a time, if able to be made consistently, is life-changing. A monster trade, for me, returns $20 for every $1 invested or more. And by now, you know the power of awesome risk to reward ratios. So who's following me here? Who's with me here? You've probably read Van Tharp, or you've read the stories, and you've known that if your risk to reward is spectacular, you can afford to lose every once in a while, because when you win bigly, as I like to say. So I spent early on in 2019, in January, February, March, and April, I spent an extra 2 hours every night. And I meticulously broke down every monster trade on just a small number of financial instruments over the course of the last 20 years. As part of my effort to make this idea that I had last year in December, a year ago, a reality, because I realized it would be a perfect complement to any other trading style. If you were doing short-term trading or long-term trading or swing trading or some position trading, if you had a monster trade every once in a while, it would perfectly complement everything else you were doing, because it wouldn't require a significant amount of your capital. And once you made the money on a big trade, even though they didn't happen very often, you could then help someone else in your life or deploy those winnings to some other trading style. And I believe that I cracked the code. And I'm going to teach you how and why these trades happen every month. So get ready to take some notes and get ready for some more prizes. So who's ready to learn how these trades work? You raise your hand, you say yes. If you're here on YouTube, you can leave a comment during the video. You can also, at the end of this presentation, later on, you can hashtag Monster Trades on Twitter or on Instagram, and you can ask me a follow-up question. And I do about once a week or once every 2 weeks, I pick someone who's hashtagged Monster Trades, and we send you $500. So it's a real thing. It doesn't, there's no link to Monster Trades in there, so it's not a technique to sell more monster trades. It's just something that I do to keep the conversation going and make sure that you know. I want to make sure that you know how to reach me. It's hard to reach me by email. It's impossible to reach me by phone. But if you hashtag Monster Trades on Twitter, Holly, my assistant, will walk in my office every morning and say, here's all the Monster Trades hashtags. Let's give away some prizes. Let's leave some comments and have some conversation. So let's talk about the 3 elements of a monster trade. And if you want to, you can take a screenshot of what you're seeing right here on YouTube or go to webinar. You can take a screenshot right here, right now, and post that screenshot on Twitter or on Instagram. And today I will search out all the people who screenshotted that, and we'll pick somebody and we'll give away another prize. Here are the 3 elements of a monster trade. It's got to be a repeatable pattern. It's got to have proper risk management. And you've got to be able to plan it together with others or a community, because that helps you retain confidence. When I take monster trades together with, so we take them now together with about 2,000 other people. We started this whole thing off in August after all my research was done. And it really helps to have a lot of other people behind you talking about what you're doing and sort of cheering each other on. So repeatable patterns, great risk management, and others or people that you can talk to, depend on, or feel confident together with in your trades. The first pattern that we're going to look at is what I call the flash crash pattern. So here's a screenshot from my Bloomberg, and you can see here this was a flash crash. The market just dropped suddenly and then rebounded. That's a monster trades pattern. It doesn't happen very often, but if you go back in time and you look at the most spectacular flash crashes in history, the Chinese flash crash in 2017 or whenever it was, or the Swiss National Bank flash crash in the euro, Swiss franc, those crashes wipe people out, but then create one of the greatest buying opportunities that has ever existed. And what's crazy is these will happen on a regular basis if you open up the universe of financial instruments that you're willing to look at. So here's Sirius XM Holdings. So my apologies to Metastock. I'm transferring all these charts over to Metastock, and my contract with this unnamed, lesser, lower quality charting platform company is now ended. It was a long-term contract, and it's finally over. And I've released all my intellectual property from them. But this same Knoxville divergence that you see at the bottom of the chart is also visible inside of your Metastock platform. This is a bullish divergence at the bottom of Sirius XM. And there's something really spectacular happening here. So Sirius XM back in 2009 was a financial joke to people. Howard Stern was even suing Sirius XM because he felt like they had overstated the value of what the stock would be worth when they gave him his stock awards, and he felt like they were worth nothing and it was trading at 5 cents or 10 cents or whatever. But imagine watching Sirius XM crash and then do a flash crash at the bottom where you see these really giant long wicks at the end of the candles, and you get a bullish divergence at 5 cents or 8 cents. And then later on, not even really, I mean, if it's just a couple of months later on, it's gone up 10 times. And if you wait a little bit longer, it's 20 times, 30 times, 40 times. Stuff like this happens all the time. And if you want to trade a 20-cent stock or a 30-cent stock or a 50-cent stock together with me, every once in a while, you can do that. And you can imagine, you can deploy $100 of capital with the potential to have a spectacular return without that much of a risk in terms of total amount. So all trading involves a substantial risk of loss, and past performance is not necessarily indicative of future results. But even given those risk warnings, it's awesome to have a trading system that doesn't require a significant outlay of money or time and effort. This was one that I really wished I had spent a lot more on. I traded 1,000 shares of CFMS. Within 4 hours of the time that we took that trade, it was up 8% or $212. This is the kind of thing that happens rapidly when there's a flash crash. This went way up from there and even further, but just in the first few hours, it was up so much. Sometimes we'll trade a currency together. Here's the Australian dollar, Swiss franc, and there's a few things happening here on the charts, and I want to share with you. So in case we never speak again, which I hope is not true, I hope we're good friends for a long time. I hope you feel comfortable working together with me so that we can take some great trades together. But I want to make sure I leave you better than I found you, and that you have learned something that's going to make you money together with me. Here at the bottom of this Australian dollar Swiss franc move, you have these giant long candle wicks, and you have this movement that is stunningly important. So for a long time, for the Jeff and the Metastock folks, I would give a presentation about missed pivot points and how powerful they are. And I've reduced that presentation to about the next 2 minutes. But if you will spend 2 minutes with me right now, I promise you that what I'm about to share with you, it was life-changing for me and could be life-changing for you as well. It's going to require me to tell you a little bit of a story. So if you're with me, take a deep breath. I'm going to tell you a story about a hedge fund manager who came out to visit me and the discovery that we made together, and I want to share that with you. So in 2008, I get a phone call back in the days when I actually answered my phone. And calling me on the phone was a doctor from New York City. And she said, "Hi, my name is so-and-so, and I'm an emergency room doctor in New York City. And I immediately, my heart jumped into my throat. I still had family that lived in New York City, and I thought something had happened. And she said, my husband is a hedge fund manager at Julius Baer, and he manages a portfolio of a few $100 million. And he's a huge fan of your radio show and podcast. And for his birthday, I'd like to fly him out to your office. And I'm thinking to myself, this is amazing. This is totally amazing. I can't believe this is happening. And I said, I'd love to have him come out. And my friend Gary Fluker flew out to see me just a couple of weeks later. And we spent a week together at my office. And what we did was we downloaded data from his Bloomberg terminal. We put it into a spreadsheet. And what we wanted to do was ask the question, what determines that a financial instrument must reverse and move in the opposite direction? And we stumbled across a memo written by Fisher Black before he left Goldman Sachs. And in that memo, he says, in my lifetime as a student of the financial markets, I've become obsessed with things returning to their natural state. And this is an internal Goldman Sachs memo that Gary was able to get because he was in an inter-company boxing league with members of other investment banks where he would box for charity. And he got a hold of this memo. And Fisher Black said, I am obsessed with things returning to their natural state. And so Gary and I studied monthly and weekly and daily pivot points. The monthly pivots are purple on the screen in front of you right now. Now, in every charting platform, whether it's Metastock or any other one that you use, you can chart monthly pivots, and they're standard issue indicators in every charting platform, and you don't need to spend any money in order to get them. When you see that a financial instrument has not touched 1, 2, or 3 monthly, weekly, or daily pivots in a row, something significant and substantial has happened, and you should stand up and take notice. Over the course of thousands and thousands, tens of thousands of rows of data in the currency market, the stock market, ETFs, and futures contracts, Gary and I realized that 85 to 94% of the time, in the same day, week, or month that a pivot is created, it is touched by price. You could see a candle touching this pivot. You could see a candle going right through this pivot. You could see a candle touching this pivot, this pivot, this pivot at the beginning of the month, 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 and then this one is missed. Price wants to go back and return to that. But when price misses 3 of them, that's when a giant move is coming. And this is a view of monthly pivots. They're always purple on my charts, so you always know if you see purple horizontal lines on my charts, those are pivot points. When, I'm going to say it again, because this is so important, and we're going to move on to other patterns. What I do is I have become obsessed with finding the best financial instruments that have missed not 1, not 2, but 3 daily, weekly, or monthly pivot points in a row. That means that there's no candle or bar touching this line in the month that it's created. And what has to happen then is it will start to hit its pivots, and then it will start to move in the opposite direction. And it will eventually get back to all of those levels. And that is a giant move. So pop those pivots up on your charts. Do some studying of your own. It will serve you well. But when you see exhaustion bars and candles and bullish divergences that also are accompanied by missed daily, weekly, or especially monthly pivots in a row, you have something really big. Because these are the trades that can make a difference in your account and life, we keep standing levels in place for potential crashes, meaning when something's missed 3 monthly pivots in a row, I've got a watch list that I keep with members of those financial instruments. And when they then crash even further away from those pivots, we know that the big return is happening. The return to its natural state is occurring. Gary Fluker went home, continued to manage money for Julius Baer, and then he went out on his own and managed money. And he was super successful. And guess what he did? Hedge fund manager still trades weekly and monthly pivots still to this day. And that's just one pattern, and we look for two more. We look for patterns because, as Mark Twain said, history doesn't repeat itself, but it often rhymes. Meaning, if you look back at this chart here, both of these major reversals, they don't look exactly the same, but they function in much the same way. And so if you find a repeatable pattern, it won't always look exactly like the previous one, but they look similar enough that you can start to trade and trust those patterns when you see them. And so once you find a pattern that repeats over and over, then you know you found something special. So there's the crash pattern, and then there's the librarian pattern and the day trade pattern. I call the librarian pattern the SSH pattern, which, you know, that sound a librarian makes if you're causing too much noise in the library, you know, she shushes you or whatever. That's what I call the pattern. So who wants to see the librarian pattern? Raise your hand, say yes. Come along with me if you want to do this. Here's the next one. We're going to turn something on its head. We're going to change something around that most people are taught. We're going to update a classic pattern and show you what has happened to it over the years. And I'm going to show you what happens to a pattern when everybody in the world starts to look at it. So here we have the librarian pattern, the SSH. Sometimes you don't get a flash crash. Sometimes you don't have missed pivots, but sometimes you get a divergence. And what you also get at the same time is what I like to call a shoulder, shoulder, head. You'll get a low, then a lower low, and then a lowest low. Traditionally, a head and shoulders pattern looks like this, with two shoulders on the sides and a head in the middle. Or if you get an inverted head and shoulders pattern, what it will look like traditionally is this, the lowest point in the middle. But what I found is, because the entire world is now looking at head and shoulders patterns, what you will find is that a market maker will allow the head and shoulders pattern to start forming, but then it will allow price or push price even lower. And the deepest point in a reversal could be the right-hand side of the pattern. In fact, you turn two shoulders over here, and then you get a head over here. And that's what has begun happening. And it's crazy, but it makes a lot of sense. Why? Because once everybody's looking for the same thing, the market makers or people that know will know they're looking for it, will stop those people out, and then the market can continue to go in exactly the direction everybody thought it was going, but only this time with only the market makers making the money. So here's another example of what a shoulder, shoulder, head pattern looks like. You get a shoulder, and then a head. You get the deepest level on the far right side. So if you have divergence, that bullish divergence that we looked at, and you have what looks like it could be a head and shoulders pattern forming, sometimes you'll get the right hand side of it and it'll be over. And a lot of people will think, oh, that's great. There's going to be, another reversal and then up, and it just takes off and it goes from there instead of doing any more shoulders at all. And it takes a lot of people off guard, and a lot of people don't see it coming. There's other variants of this as well. This is Dillard's. You get a head, shoulder, head. It's a completely different setup. That's what it usually looks like. And a lot of this is starting to fail. And so you'll get this, the Batman ears pattern. I'm Batman. Okay. So I'll erase all these drawings. I'll go back to the pointer. So when you make 44% in the first 3 hours, you know you have something special. And so as I started trading these back in May after a few months of research, I started trading small numbers of contracts on silver, on gold, on Dillard's, on the SPY, on Tesla, on Apple, on the UVXY, and lots of other financial instruments. And the only thing I regretted when I was doing this is that I wasn't backing up the truck and risking more money. But in lots of these instances, I would just risk $100. And then some afternoons, I'd end up making $44 on that $100, and the day wasn't even over yet. And I would hold the trade till the next morning, so I wasn't subject to the pattern day trader rule. And then I was like, I'm really onto something special, because nobody makes 44% in 3 hours. This was 7.78% in a day, with the potential for another 100+%. And this was the first trade that we took as Monster Trade members together. By the time I got to August, I was trading this with slightly larger amounts of money, risking $1,800 to potentially make 5, 6, 7,000, or even more than that. And on the first day of some of those trades, we were up pretty substantially. This was a 32.5% in a day. And the only problem was that I didn't buy enough contracts. And I kept telling myself, I'm not going to make that mistake again. But imagine if you only have $80 to start. If you only said, listen, I'm ready to do this together with you, but I want to start small, then you're in the right place. You're definitely in the right place if that's what you're thinking. And these are the types of trades that really make a difference in your account and in your life. On the day that I revised this presentation, it was a 19.42% day with the potential for 1,000% gain from here. It was a call option that I had bought for $2.70. So I'm just to trade one contract would be $270. Piece of cake. That's pretty easy for most people to do. Doesn't just work in the stock market or on options. I traded this in the currency market as well. I traded the Euro New Zealand back a few months ago, and we had just a couple of days into the trade, we were up $486 on a reasonably small sized, it didn't take a lot of margin to do that. Okay, so we had a 426% gain on XLF, a 220% gain on GLD, and a 44% gain in 1 day on silver. A 101% return on the British pound, when Brexit fears were really heating up. And we just finished out a current long Australian dollar trade that had a target of 200%. And these types of trades span across all financial instruments and can be taken inside a regular brokerage account. So this is, if you like FX, or you're willing to dabble in a little bit of currency trading, you could do that. Or if you just want to trade ETFs in your regular brokerage account, that's fine. If you want to trade futures or even options on the ETFs, you can do that too. So whatever financial instrument you're looking at, these trades can be expressed through the financial instrument that you're most interested in and experienced with trading. And as I did my research, I couldn't find a legit source for big trades. It's too scary of a thing for someone to run a service on. I couldn't find a Monster Trades service. So I created one. How does that sound to you? So I told you that I've got something special for you today, and here it is. So I'm going to spend a few minutes, and I'm going to tell you about what it is. I've shown you a pattern. I've taught you about those missed pivots. I've shown you that Knoxville divergence and how you could even chart it on your platform without any kinds of special indicators. I've told you about the flash crash pattern. I think if you rewatch this presentation, you're going to see a lot of stuff the second time that you watch it, so I encourage you to watch it another time. And now, for those of you that are interested in doing something together and taking this a step further, if you want to do something advanced, here it is. You can mute me for the next 4 minutes if you don't want to hear it, and then you can come back. But if you do want to hear it, if you give me a chance to explain it to you, here it is. I've developed an entire trading alert program specifically around these trades, literally sharing my Monster Trades game plan, where to enter specific trades, where to target, how to manage them, everything. So it's like I'm the Steve Carell, the Michael Scott, and we're all doing this together. My favorite story about Monster Trades, imagine this for a minute, is Paolo Pellegrini, who worked for John Paulson, who invented the Big Short subprime mortgage trade for John Paulson. He takes his wife on their last vacation. They're having marital problems and financial problems. He works for John Paulson. He takes the Big Short trade for John Paulson, but still isn't getting paid very much money and doesn't know if they're going to be able, what they're going to do when they get back, if they have to sell their apartment when they get back to New York City. His wife goes to the ATM while on vacation and sees $45 million in their checking account. It was part of his $175 million bonus that year. So it's kind of like that. We look for trades that surprise us, and we're happily surprised when we see them. These are the types of trades that really make a difference in your account and in your life. Okay, so who wants to watch me trade a $10,000 account and try to get it to $100,000 before the end of 2020? All right, we're getting a bunch of yeses. That makes perfect sense to me. I'd want to see that, and you're going to see that. So what I do at the beginning of every round of monster trading is I put $10,000 in the account, and I let it rip. So on January 1st, we'll reset the clock, and I'll probably do that a couple weeks from now, and we'll put $10,000 in another sub account, and we're going to go. So I want you to never trade alone again. And as part of this webinar, I have a way for you to get all of these signals for free. And you'll be an independent and happily successful trader if you want to learn these monster trade patterns. And that's why you're going to get my Monster Patterns course, an entire curriculum that trains you on how to find and trade these monster patterns. And then once you get it, you can join the Signal service and get my specific trades, all of them, right to your email inbox. But for today, for the folks that took the time to show up, if you want the alerts, I want to give them to you for free if you'll let me teach you the patterns in the course. It's kind of a crazy deal. The alerts are a $997 a year service, and my team consistently informs me that it's way underpriced, but I'm literally giving them away if you join the course. Oh, and I'm discounting that too to make sure that this is even easier for you if you're serious about taking advantage of monster trades. So if I can take a moment, I'm going to wrap it up and tell you what I've got for you. Oh, and by the way, you are the first ever group here in 2019 that I'm allowing access to this, and that's really good news for you, and I'll explain why. First, I have the Monster Pattern Bootcamp. I'm going to show you exactly how I trade these patterns, where to find them, how to identify them, what makes the big potential trades look different from the rest, everything that you need to know to become a master of monster trades. And I've recorded a thorough session on each of the patterns. They're located in your members area on demand. And plus, I'm going to do more bonus live sessions with Q&A on a regular basis to make sure you're a Monster Pattern Pro. And then you get the Monster Trades newsletter. And on the first of every month, you'll receive the 3 monster trades that I'm focusing on. You get my analysis and my specific trading plan around the monster trade. And each one of these has the potential to pay you 10 times, 20 times, or even 50 times your investment in the position. And we've had 4 newsletters so far, and it's killing it. These are some of the happiest members I have of any service that I do. And I've got a special bonus options trade this month because I think I found what could be the trade of the coming year, a super low risk, super high reward way to take it. And there's room for everyone in this trade with plenty of volume, and that's why I want to send it out. But then again, you're my charter group, so I literally just updated the newsletter this morning to make it extremely timely, and it's being uploaded to the members area as we speak. And then you're going to get ultimate money management. Okay, we all know that trading means nothing without money management, so I want to give you a complete ultimate money management program together with everything. And also Booker Bites, because not everything is a monster trade. Sometimes I have something different going on, a tool you should check out or an indicator I want to give you for your charts. Maybe it's something outside of the currency world, and you'll get my take on it with your free subscription to Booker Bites. It shows up automatically in your inbox for your convenience. And then I want to give you private mastermind access. So if you want to see what $5,000 worth of high-level in-person training looks like, I want to do this. So what I did was I recorded an event where I spoke to folks who paid $5,000 to sit there, and they got to interview my friends that have made at least $100,000 trading, and they got to look at their account. We recorded the entire session, and I want to give you that recording as well. Plus, you get monster support. So I am a newsletter editor in a company of 80 people. So I'm just the editor of the newsletter, but we've got 7 people in customer service. We've got a bunch of people that staff the sales phone line. So if you call, there's real people. And we've got an entire company that stands behind me in this. So it's not just me. We've actually got a whole company of people, headquarters. The brand new headquarters are in Jacksonville, Florida. And there's an entire group of people who are literally specifically set aside to make sure that you get the support you need in a timely manner immediately when you have a question. So this whole package is a $2,997 a year package. But like I said, we've been a little crazy to make this a no-brainer. And if you're ready for this, first, I'm giving you the signals for free. So that's $997 off. And we're at $2,000 a year now. Then I decided I'd do 50% off. And everything we just talked about is, if it were only $1,000 a year, you could make that on one monster trade. But I wanted to make sure it was accessible to everyone. So I created a monthly price of $79 per month to get started with monster trades. And here's where my team gets a little frustrated with me. They already saw that I priced everything too low. So if you want to get a little bit crazier, how about $79 for the full year? You get the Monster Patterns Bootcamp, the newsletter, the mastermind access, everything valued at $59.85 for $79 for a year. And you can go to robbooker.com/metastock right now. Or if you want to call and talk to the folks, you can call 321-888-3958. That's robbooker.com/metastock. And you can get all of that for $79. So I've got one more thing for you. I want to talk to you about you being on this plane. So this is my office in Houston, Texas. I, once a month, invite one Monster Trades subscriber who paid $79 for the year, just like everybody else, and I fly you out, all expenses paid, to come trade with me at my office. And that is only for Monster Trade members and one person a month. We're still doing this. This is the last time we're going to do it. We're closing this out this is the last event where we make this offer. So if you go to robbooker.com/metastock or call 321-888-3961, you could be one of the folks that flies out. I fly out at my expense, and then we open it up to anybody else. If you are a Monster Trade subscriber and you want to come out at your own expense and you didn't win the trip, you can come out as well. So you can get some in-person help and you can see me in my office and we can work together a bit. So come trade with me. That costs $5,000 a day when I offer it, but one subscriber this month will get that for free, all expenses paid. So let me know if you're in. You get the boot camp, the newsletter, the mastermind access, the ultimate money management, the unlimited support. One member a month trades with me at the office, all expenses paid. That's a total value of $5,985, but it's $79 today. This is the last time we're doing it for this. This all increases in price after this event. And you can go to robbooker.com/metastock or call 321-888-3958. I'm so grateful that you were here together with me. I went as fast as I could through the presentation. I'm super grateful for your time, everybody. Thanks so much. Whitney says, I have it already. It's a great service. Whitney, you just might be someone we want to invite to come out to the office. David says, this should sell out. I used the principles on one of the patterns and made back my money. It was a very good value. David, you are awesome. Jeff's in. All right.
The site's not working.
Super excited, super grateful that I got to be here. Jeff and the folks at Metastock, I'm so grateful that you let me come on. Thank you so much for having me here on this Saturday. I hope I did a good job for you all. I love the Metastock software. I love the folks at your company. I love everything about what you do. And thanks so much for spending some time together with me, everybody.
Okay. Thank you, Rob. Really appreciate it. So looks like a lot of people are in. Great presentation. A lot of good compliments. Good to have you in here, Rob. Thanks again. Okay. All right. Let's go ahead and kind of talk a little bit about the Knoxville Divergence. Rob did discuss this a little bit. Go ahead and kind of just do this. Let's go ahead and change the presenter here. Show my screen again. You guys should be able to see Rob's nice picture up here as well. So I really want to say thanks for that great presentation. As Rob had kind of talked about earlier, we did create the Knoxville Divergence. It is an add-on that works with Metastock, and it does a really, really good job. It also allows you to go through and find that divergence between the momentum and the relative strength to find really good entries in stocks or futures or Forex markets. It works on any time frame and in any market. And the add-on includes like an exploration to help you, again, go find those trades. The expert advisor gives you the crystal clear advice for the entries and exit opportunities. does a really, really good job. And much like Rob, his add-on is very, very inexpensive. Normally it's $99 as a one-time cost. Here at the Summit, you can pick it up for just $50, $49. And like everything that we sell on a one-time cost, it has a 30-day money-back guarantee. It is part of our Summit Traders Action Pack today as well, where you can get Metastock Real-Time, the Zenith service, the Knoxville Divergence, the Brig Trend Toolkit, Fulgent Artificial Intelligence, Jake Bernstein Setup and Timing Triggers, the Unleash the Power of Metastock, somebody from my staff to call and help you make sure everything's installed properly, walk you through the software a little bit, our white glove installation treatment. You'll get 2 years of Stocks and Commodities magazine, as well as Unleash the Power of Metastock. And the nice thing about this package is most everything's on a subscription basis. So that $848 is basically, if you buy a 3-month subscription to all of the packages, you can get a full look at them. And it's really a good time to start trading. So normally everything would be $1744. It's $896 here as part of the Summit offer. And you can give us a call at 800-882-3040, or you can chat live with us at metastock.com/saleschat. So hope you're enjoying today's summit. I do want to go ahead and say thank you to Stocks and Commodities for helping us advertise and market and being a partner in the event. Great magazine. If I haven't talked you into signing up for the free issue at least yet, you definitely should do that. It's free. What do you have to lose? That actual free trial subscription will actually include 1 month access to all of their 17,000 plus articles, trading article archive. They have about 1.3 million subscribers, and they've actually been publishing since 1982. So you should claim your free issue. It's a great magazine. And there's the link for that, bit.ly-2. And we'll paste that in the chat for you in a second here. So, in any case, do want to talk a little bit about Metastock in a little bit more detail. We do offer, if you just want to try Metastock, we do offer a buy one, get two free trial of that. And you can get a hold of us at metastock.com/saleschat to do that as well. Again, it's been rated number one in its price category for 25 years in a row. So, in any case, it's my turn. I get to talk for about an hour now. So I hope you're looking forward to this. I do want to say thank you for coming today. And I'm going to go ahead and start by reading. I do need to actually kind of refresh this a little bit. So let me just go ahead and hit the refresh button on here. Let me go ahead and start. Hopefully it'll let me start from here. Yeah. And let me go ahead and get rid of this extra screen. I'm not sure what to do about this. So let me go ahead and start with the legal disclaimer. Today's demonstration is designed to instruct you on using Metastock, the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So, all right, very good. How's everybody doing? Let's go ahead and we can take a little bit of a breath. I've got like an hour to talk. I want to know how you guys are enjoying the summit today. How are we doing? And go ahead and kind of chime in here. Basically, what I'm going to say is, in the chat, on a scale of 1 to 10, 10 being good, let's be clear about that. How good are we doing today? So just let me know.
Jeff, I give it a 10.
Oh, thank you. Thank you. And in any case, let me tell you a little bit about me. I'm getting actually very, very few votes. So, Jeff says excellent. Paul says good stuff. Greg Lewis says 10 out of 10. So I'm glad you're enjoying it. If you guys have any feedback for me, very nice. 9.2. I'll take it, Lewis. Jeff Mitchell says 10. Craig says 10. Great. Awesome presenters, Neil says. Okay, very good. Very good. If you guys do have any feedback, people you'd like to see at the event, that kind of stuff, I run the summit. We started it, if you can believe it, we've been doing this for like 6, almost 7 years now. And if you have feedback about kind of people we should invite in or kind of things that we should do a little bit differently or stuff like that, please feel free to send me a email. I want to hear that feedback. I'm very proud of how well this summit is actually kind of done, and we want to always be working on getting better. So if you do have some feedback for me, I'll just type in my email address right here. Be more than happy to answer your questions and all that kind of good stuff as well. So in any case, let me talk a little bit. Go ahead.
Sorry. Comments from the YouTube side.
Oh, there's a comment from my YouTube side is right here, guys. It's right here.
Okay, I didn't know you could see it. Scott Gow says 11 out of 10.
Oh, 11 out of 10. Montreal says 10.
Montreal Lucy says 10.
Great. I'm glad you're enjoying it. We put a lot of work into these. It's been really good to kind of rely on people that, I've built such good relationships with. And, they come in and people that I really, really respect and give us really good classes. So I'm glad you're enjoying it. So let me tell you a little bit about me, because I'm sure that's what you want to hear about. I won't talk too long about it. I've been working here at Metastock for 23 years. In March, it'll be 24 years, if you can believe that. I started in inside sales. I did that for about a decade. And I'm trying to get my headset. I actually don't need this for a little bit. I'm going to take it off so I feel more comfortable. I started about 10 years ago. I started the first 10 years I worked in inside sales, and it's just been a great company to work for. If you had questions, you'd most likely talk to me. I'd talk to you a little bit about how you're trading, what you're looking to improve, and it's just been a great company to represent. For the next decade or so, I did business development. That's where I kind of formed relationships with Rob Booker or Jake Bernstein or Price Headley, pretty much everybody that we've seen today. And that was a lot of really good stuff. I learned so much about the market. Like I said, Price was the first person I'd really worked with that was like an educator in the market space. And I've just learned so much over the years. So I really appreciate these people that come in and teach us and that kind of stuff. I've been able to really specifically look at what they're doing and kind of help them code it into Metastock in cases and get products that are designed to kind of scan for what they want to find and give advice that is going to be useful for Metastock users. It's been a lot of fun. For the last 2 or so years, I've been actually in charge of the sales team here, as well as all of our US-based partners. And that's been a lot of fun as well. I'm almost to the point where I feel like I'm decent at that job, and pretty soon I'll be, whatever. So Metastock from a nutshell, I started in 94, but it was a company that had been in business since 1982. I started actually in 1996 because we were already part of Reuters, who later became Thomson Reuters. And our relationship with Reuters, we bought ourselves back from Reuters 6 years ago. And we have a good relationship with Reuters. If you're not familiar with Reuters, well, it was Reuters, then it became Thomson Reuters. They sold the analytics side of the business off to Blackstone, and then it became Refinitiv. But they're basically a huge company that makes about, with the last time I looked at the financials for Reuters, they make about $19.2 billion a year. And 90% of that was actually selling real-time news, real-time information, charts, stuff like that to their institutional or the hedge fund clients. Now, we did purchase Metastock back from Reuters about 6 years ago, and we've kept a really good relationship with them. And that's been good. We've been able to, on the one hand, refocus all of our programming into Metastock and get really, really specific about what we wanted to include there. But by maintaining a good relationship with Reuters, we've been able to, Refinitiv, we've been able to provide data for just about anything on Earth and really good news for just about anything on Earth. I mean, they cover 200 plus exchanges. There's several 100,000 instruments you can look up in Metastock. And that means I can go and I can go over to Singapore and we can look at Singapore stocks, or we can go to India. We can look at India stocks. And it's helped us. Our relationship with Reuters over the years has helped us maintain a global footprint for traders. We had one of our customers in India that was asking some questions earlier. We have a lot of users actually in India. So it's been great. The divestiture has really allowed us to refocus as I just realized that that Greg is going to be irritated because I forgot to put the new box art on this slide. Sorry about that, Mr. Lewis.
Oh, no, you did.
The other thing that I've mentioned all freaking day is the fact that 25 years in a row, it's been rated #1. That's 2 years more than I've actually worked here. I have a sales rep that's actually younger than how many times we've been rated the #1 software in the price category. So it's a very well respected software. It's something that I would recommend. I wouldn't trade without it. Let's get into the class in terms of what we're going to talk about today. So I do have this quote from Richard Dennis up here. I used to go into the Richard Dennis story, the story about the turtle traders. Richard Dennis and his partner Bill Eckhart basically put together a group of traders. They had a bit of a gentleman's disagreement, and they decided to train a bunch of people on how to trade their method. It's called the turtle trader method, and it's actually in Metastock. But the result of that experiment is they made a whole bunch of money, and there was a couple of key quotes that came out of that whole experience that Richard talked about that I thought was really, really interesting. The first was he talked a little bit, I don't have the exact quote here, but he talked about how he could teach 85%, I always say you could publish rules in a newspaper and no one would follow them. The key to trading them is consistency and discipline. Okay. The other thing that he talked about is like most people could come up with rules that are better than what he actually created. And again, it just came down to consistency and discipline. So I do have a bit of an audience participation question. I am going to have a free prize for whoever answers this question correctly. And it's not going to be $500. It's going to be a free month of Metastock. So the question that I'm going to ask you guys is, what is the best profession for trading? Okay. What is the best profession to have before you start trading? So in other words, out of all the professions, doctors, physicians, nurses, those kind of things, what is the best profession you can have to start trading? And the first person to answer correctly is going to get a free month of real time on Metastock. Engineer? Okay, that's a good guess. Cleaner? No. Nope.
Rodeo clown.
Nope. Any novice? Well, actually, that's a pretty good guess. Randall wins. And he just beat out Steve Belknap. Okay, so let me write that down. Randall, you're going to need to email me. He got the right answer. I'm going to just jot down your name. You're going to need to email me, Randall, and we'll get you set up with a free month of Metastock with the real-time news service as well, the service that they spend $1 billion on. So,
Jeff, what's the right answer?
Well, okay, I'm going to get to that.
Okay.
So the correct answer, and a bunch of you have gotten it, is airline pilot. So airline pilot was the winning answer.
I'd like to point out that on YouTube, Darts Player 32
also answered it correctly?
right at the same time. I think he deserves.
Should we give 2?
Yeah.
Do you think we'll get in trouble?
I'll talk to Jeff Gibby about it.
Okay. So now you'll need my email address. We didn't really plan on doing this, but I thought it would be fun. And I was inspired by Rob Booker and the fact that he just gave away $500 cash. So Darts Player 52 and
32.
Randall 32. Well, hopefully 52 doesn't also email. Drop me an email, jeffrey.gibby@metastock.com, and I will get you set up for a complimentary Metastock real-time account, as well as the Zenith News Service. But airline pilot is the correct answer. And just go ahead. Anybody that wants to email me if you have questions about kind of like today's classes or maybe a question we missed, there are a lot of people here. If we missed a question or if you have anything you want to kind of talk to me about, just send me an email, jeffrey.gibby@metastock.com. Give me a little bit to respond. I usually get a lot of emails after I give my email address on air. But in any case, I put a lot, back to the point. I put a lot of thought into why is it an airline pilot, right? And the key is discipline. So, like for example, if you're if you're getting on a plane, you're the pilot that's piloting that cabin. Hopefully, number one, is not drunk, but hopefully is following a complete checklist of, okay, here's what I need to do to take off. Here's the instruments that I need to check. Here's how much I need to throw the throttle back to make sure that we have enough airspeed to gain the altitude that we need to kind of get in the air, right? They have a complete checklist. If something goes wrong, they have a complete checklist. Here's what's going to happen if we get into trouble, and maybe the end of that checklist is I land the plane in the Hudson River, but here's the exact checklist of what we're going to do to follow the rules. And what we're going to talk about today is rules. And how trading systems work and how to kind of analyze them and just find out before you start trading which is the best system for you. Okay, but the key is discipline, and I can help you with the software identify systems that work well with the stocks that you're interested in. And it doesn't, I say stocks a lot because I trade stocks, I trade options, but that you can use it with Forex, you can use it with futures, you can use it with VIX. It's the same kind of mentality. In fact, when Forex got really popular, back when I was in Inside Sales still, is when Forex got really popular. A lot of people would call and say, well, a lot of the stuff that does technical analysis work on stocks. And so we did a bunch of testing, and actually it worked better on Forex than it did even on stocks. And so we were able to answer that. But it comes basically down to the financial instruments. So we're going to basically kind of, for today's class, what I want to do is I want to, number one, show you a methodology. I'm going to teach you exactly how, and it's going to be MACD. I'm going to teach you exactly how MACD is calculated, the way that you can use it and interpret it, how you can get buy and sell signals out of it. And the reason I do that, and the reason I go so much detail into that, is I want you to understand what a trading system is. And then I'm going to show you how to test that, how to identify if that's a good indicator on the stocks that you're using, how to go in and then find if there's maybe better indicators, if it's going to work for you based on kind of your risk-reward portfolio, all that kind of stuff. So let's talk a little bit about the MACD. The MACD was created by this gentleman here. His name is Gerald Appel, and he created the MACD indicator. So I promise to show you how it's calculated. Hopefully this, I know the reason why I decided on MACD, which on a completely side note, is a lot of people, our most popular video was how do you use the MACD on YouTube, when I actually created and went through kind of this presentation, and I've just been doing it ever since. What's been interesting to me is a lot of people use the MACD in their trading, but they have no idea how it's calculated or how to use it or how to interpret it. So I think that's important. I'm going to kind of walk you through exactly how it's calculated. So what stock do you guys want to look at for this today? And we'll just go with the first one. Randall says, Paul says, follow the rules and look at your instruments. Exactly. Randall says, plan your trade and trade your plan. So this is the Knoxville Divergence. I was going to show it exactly how it works. I actually did give a bearish divergence here. Has a really nice expert advisor. I'm going to go ahead and kind of clean up this chart a little bit, though. I'm going to actually kind of get back to kind of a blank chart. Okay, and I'm waiting for you guys to throw in a symbol. I'll just take the first one. We're just going to be talking about MACD. Okay. All right, so now I've got a clean chart. Shop. Theo answered with Shop as the first one. The second one was Apple. So let's go ahead and take a look at Shop. In Metastock, anytime you want to change a chart when you're already looking at a chart, just type in the symbol. this this dialog box that opened up on the wrong window or on the wrong screen for me is going to pop up. Let me drag it over here. Just trying to grab it underneath all the question windows that I've got open and stuff like that. Okay, so let's go ahead and just talk about MACD on Shop. And for those of you that have typed in Apple, there's actually about 5 people that have typed in Apple now, and somebody that typed in ACB. We'll actually do those in a second when we start looking at system testing. So I'm going to go ahead and look by symbol. I'm not familiar with Shop. I'm going to assume maybe that you want to look at this Class A Shop, that it trades in the U.S., and that it's Shopify. So that would be this symbol here. There's also a Shopify that trades up in Toronto. Again, we have a lot of data. If you're looking at it on a specific, or for it on a specific exchange, you'll be able to find it here. So I'm going to go ahead and open this up. I'll just go ahead and hit enter on the keyboard, and we should be looking at is just the chart. Now, there's some stuff on this chart. This is a demo machine. It doesn't have a few of the settings set that I'd like to look at, but I'm just going to go ahead and clean it up real quick. So let me go to the expert advisor. I'm going to detach what we call the expert advisor. And let's talk a little bit about how a MACD is calculated. Okay, so let me go ahead right here. I'm going to grab the moving average first. And what I'm going to do is using Metastock, I'm going to drag and drop this indicator where I want it to be. So this is a list of all of our indicators here. There's a couple hundred of them in here. If I come to the very top of this list, it's actually going to keep track of the indicators that have been used on this demo machine most recently. Okay, and you'll have up to 20 in here. Apparently, not a lot of indicators have been used on this demo machine. It's a new installation of 17, but up to 20 will be right up here at the top. So I don't necessarily need to find moving average on the list. It is under M, but since it's something that's been used frequently, it's just going to be at the top of the list. And what I'm going to do is I'm going to drag that out of the quick win list, and by drag I just hold down the mouse button. I hold it down. I'm still holding it down. You'll notice right now that the bars are pink. That means if I drop it here, I'm going to put a moving average on price. And I think that's actually kind of cool because I could also drop it down here and I could see an average of the volume, but that's a little bit beside the point for now. I just kind of talking a little bit about how easy Metastock is to use. I'm going to take this moving average and go ahead and plop it down right here on the thing. And I'm going to basically do 2 moving averages. The first one I'm going to do is a 12-period exponential moving average. I'll go ahead and click on OK right here. And it came up a little bit light. I want it to be a little bit thicker. I realize we're broadcasting this. I'm not sure what kind of resolution you have. But even for me, I'm blind in this eye and I can't see out of this eye. I want a bit of a thicker line. So anytime you want to change anything in Metastock, just double click on it. That'll bring up this properties dialog box, and I'm just going to make it nice and fat so I can see it in both of my blind eyes. Okay, I'm going to grab another one and exactly the same. I'm going to make it on the price. And what I'm going to do is I'm going to make this a 26-period exponential moving average on the close. Okay, I should have changed the price there, but I'll just double click on it. I'm going to make this one blue. Okay, I'm going to make it a little bit thicker. Okay, and a little bit thicker. Okay, I'll go ahead and apply that, and now I've got my 2 moving averages on the chart. Okay, I'm also going to apply MACD. So right here, again, just grab it in the watch list. I don't necessarily want to put MACD here. I want it to be in its own inner window, and to do that, just point it to either the top of the screen, the middle of the screen, in between the windows, or at the bottom. Wherever you drop this, wherever you let go of the mouse button is where it's going to show your MACD indicator. Okay. Now, for the purpose of MACD, I'm going to just double click on this, actually kind of change it around a little bit. I prefer to see this, again, a little bit thicker and in a histogram format. So I'm going to go ahead and change that. I'm also going to change what's called the signal line, which I'll get into in a second, to be a little bit thicker for you as well as a blue color. It'll just stand out a little bit more. Okay. Now the MACD is designed to look at trend and momentum. Okay, it's a trend indicator. It's also a momentum indicator. And I'll kind of talk a little bit more about how that works and kind of how you can see it. You look at it to visualize momentum, but that's primarily what you're looking at. You're looking at MACD to analyze the trend of the market. Is it bullish or bearish? And the momentum, how strong is this particular Shopify? Okay, all right. So if I wanted to calculate a MACD, that's where the moving averages come in. If I was to subtract this red line, if I was to subtract the blue line from the red line, the difference I would get is this value here. So on the very current day, I'd get a total value of 11.4417. Okay? So all it's doing, all the MACD is really doing, is it's comparing a 12-period exponential moving average with a longer 26-period exponential moving average. That's it. There's no real science. That's the science behind it. That's all it's looking at. Okay? And the reason that it measures trend, the reason that it's designed to measure trend and momentum, is if the stock is moving up, like it is, the Shopify has been moving up from here to about right here when it started going down. When it's moving up, the shorter term moving average, since it's going to be closer to the price, is going to be above the longer term moving average, and you're going to have a positive value. So right here where we've got positive values, that basically just means that your stock is trending up, or your future is trending up, or your instrument is trending up. If it starts to drop, that means that the stock is starting to flatten out and starting to go bearish, as it is right here, where you're getting negative values between the difference between that shorter and that longer term moving average. Does that make sense? Do you have any questions about that? Thea says, it is clear to have them as a signal line, and we'll talk about the signal line in a second. So if you have questions, please let me know. This is designed to be easy because it's not really that difficult. And after 23 years of working in the market, what I found that helps me a lot with my discipline, I'm going to say most, but I'm not sure most is the right way to say it. What helps me a lot about my discipline is if I understand why I'm placing a trade, it helps me with my discipline. Okay? And I don't see any questions coming on, so you guys all understand this, or I was clear. So let's talk a little bit about the signal line. The signal line is basically just a moving average of the difference here. So what you've got is you've got a 9-period exponential moving average of the difference between the moving averages. Tim says this is not a predictive indicator. Absolutely. You can use it, and we'll talk a little bit about how some people use it as in terms of a reversion to the mean, but it isn't. It's a trend following indicator. And I'm sure you've heard like the trend is your friend, or befriend the trend, or a rising tide lifts all boats. This is not an indicator that's like an overbought, oversold indicator. It's designed to say, okay, what is the trend and when should we trade it? You can use it a little bit as a predictive indicator, but it really does work better as a trend following indicator. Okay. The signal line is exactly, it's a signal line. And the way that it works is if your MACD is above its signal line, so if I took a little bit of a vertical line right here, if your MACD is above its signal line, then you're going to say your MACD is in a bullish phase. Since it's in a bullish phase, we would expect Shopify to go up. And since it's went up above its signal line, it has gone up. It was at about 314 here, and it's at about 364. So it's gone up pretty well. Okay. If it's crossed down below its signal line, you'd expect it to go down. Here's where it crossed down below its signal line right here on the chart. And during that time frame, it did indeed kind of have a retracement. Okay. And so that's one of the ways that you can kind of look at the MACD. There's about 3 ways I'm going to talk about interpretation of the MACD. But before I kind of talk about the second and the third way, I'm going to attach the expert advisor to the chart. Okay. So this right here, this guy in the bolo hat, this is our expert advisor. And I'm going to go ahead and attach it. And I'm going to go ahead and click on it. There's going to be one in here that I'm going to look for that's called MACD by Metastock. Okay, so there's a bunch of systems that come into the program. A lot of the add-ons that we talked about have these expert advisors. And what the expert advisor is designed to do is actually just give you buy and sell signals and help you analyze the chart. Okay, so I'm going to go ahead and scroll down here to the M's. There's our MACD by Metastock. I'm going to go ahead and attach it to the chart. I'll go ahead and click on close. And now you'll see a couple of things because I'm going to point them out. Number one, you're going to see that when that MACD is trading down below its signal line like it is right here, you're going to see that it's in a bearish phase. Okay, when it crosses up above it, it's going to go over to bullish. When that cross happens, and I'm just going to zoom in a little bit so you can see the chart a little bit better. When that cross up happens, it's going to go from bearish to bullish. And since it goes up above its signal line, it's going to give you a buy signal. Okay? So that's the first way to look at the MACD. You can look at it as an overbought or oversold mechanism. Okay? Another way you can look at the MACD is you can look for it as a bit of a stretch indicator or a little bit of a reversion of the mean indicator. So I'm going to point out right here that the last couple of days of Shopify have been actually highlighted in red. Okay, you'll notice right here they were highlighted in red. You notice right here they were highlighted in red. Okay, so what does that mean? Well, the other way that you can look at MACD is if you've kind of gone into kind of this huge extended move, a lot of times there's a tendency for the MACD to kind of, or for price to kind of spring back and do a reversion to the mean or a reversion to the mean type of trade. That's when the MACD gets overbought and oversold. So when we start to kind of measure the MACD as being overbought, oversold, we're going to notify you of the chart that, all right, now the MACD is overbought or oversold. Okay? And then there's a third way to kind of take a look at MACD, and it's called divergence. Drew a blank. Alexander Elder is a great technician. He wrote Trading for a Living, one of my favorite books on trading, but he always does a really good job of looking at of webinars with us and stuff like that. He calls a MACD divergence the most powerful signal in all of technical analysis. And you guys know what a divergence is, but what we would be looking for is two peaks in MACD. So if this had started to go down and had peaked, we could kind of, and I'm just going to draw it real quick here, we could start to look at kind of, if we look at a peak in MACD and a peak in MACD, and we do the same thing at price at about the same time, well, right now these numbers are about the same, so they converge. But if we had a MACD peaking about higher than price was peaking, that would be that divergence. And that's a subject of a whole nother webinar, but that's a third way you can look at MACD is by divergence, okay? Now what we do in our expert advisor is not only are we drawing all of this stuff on a chart for you, we actually kind of outlay it in that commentary. So if I come into the expert advisor, I'm just going to go to view, expert commentary. And when I do that, right here above the very last day, that's highlighted red for Shopify, you're going to notice that there's a red bar. Right above that, when I opened up the commentary, a little triangle that points down is right above that bar. Okay? And so this is the bar that it's analyzing, and it's going to go through those three conditions. It's going to say, currently the MACD is bullish since it's trading above its signal line. The MACD crossed above its signal line 16 periods ago. Since MACD's crossed its moving average, Shopify Incorporated's price has increased 16%. And has ranged from this price to this price. Right now, it's in an overbought range. Okay, and what does that mean? I remembered I can kind of make this a little bit bigger, so maybe you can see it, so you can read along with me. The MACD is in an overbought range. Prices may continue to move higher for some time. Wait for prices to move lower before considering any short positions. So what's that saying is right now it's looking a little bit overbought to me. Trends can last for a really long time, though. So in order for this to be valid, you're going to want to see it to start to kind of go back down a little bit. And that's where the way it can be used as a predictive indicator, Tim, is with that. And then if it finds any divergence within the last 5 days, it'll actually list that right here as well. Okay. There's a couple of questions. Randall asks, was there a reason 12, 26, and 9 were chosen? You would actually have to ask Gerald Appel that. I don't know the answer to that. I can tell you, though, that with MACD, he didn't actually use full numbers. In fact, if I come in here, there's a really, really cool help feature in Metastock that'll allow me to kind of look at how different indicators are created. But I'm going to come in here and kind of show you something. I'm going to right click on this MACD. I'm going to go to help. Okay. And if I go to the overview, there's also interpretation, parameters, tips. There's all, we used to print a version of this manual. It was over 500 pages long, and it talked about all of the hundreds of indicators that were included in Metastock, and it's a great glossary. But when Gerald Appel created it, he actually used a 0.76, a 0.075, and a 0.15 exponential moving average. The reason we say 26 and 12 are those are the closest days that actually match up to that 0.075 and 0.15. So he didn't actually use whole numbers. And I can't even begin to explain to you how that works. I'd have to learn it first. But the reason we say 12 and 26 and 9 is because those are the closest to the MACD calculation of 0.075. Okay. Interesting side note. Ron Lowe asked, can you use just 2 MA on the chart instead of the MACD? You could if you wanted to. Absolutely. Some people will trade the cross of a shorter term and a long term moving average. Is the simplest trading system that exists. So you can do whatever you want, Ron. I'd test it to make sure it works well, though. Can you attach the Elliott wave indicator with this chart? You can, Theo. I'm not going to just because I'm looking at the time and I need to keep moving on it. But we'd be happy. We just included a bunch of Elliott wave stuff into Metastock. We'd be happy to send you some charts of that. Just get on line with us at sales@metastock.com or metastock.com/sales chat. Ask them to pull a chart of Shopify with the Elliott waves attached. Be more than happy to do that. Paul asked another question that's really good. Can you use this on an intraday? You can apply this to any time frame. If I just click on right here to D, on this day here, I could move this down to an hourly, whatever time frame I want. The calculations remain the same. You can use it on any time frame you want, and you can test it. As long as you have Metastock real time, you can test it on any time frame that you want as well. So, okay. Let me organize my thoughts for a minute in terms of where I want to go, but hopefully that gives you a good idea in terms of how MACD works. And that's kind of the way a technical analysis system works, okay? Most of the time they're looking at price or volume or volatility, but they're usually the ones that I like are very simple. They're easy to understand. But that's not the only reason that I like them. I like them because they're objective. If we said, okay, I'm gonna ask you what we're looking at right here in terms of whether the MACD is right now bullish or bearish, everybody could come up with the same answer. If we were looking at the MACD right here on this day and it had just generated a buy signal, I'm not making a buy signal because I think that there's going to be a tweet on Shopify today and it's going to drive the price up or down. I don't think that. I'm just looking at the trend of the stock. Every single one of us that are looking at MACD right now, all of the hundreds of us that are looking at MACD right now could look at this bar and they could come up with the exact same decision because it's objective and not subjective. Okay, and when you're objective, you know why you're getting into a trade. I think it's also a lot easier to maintain discipline, which is one of the most. And there's a lot of indicators in the market. We've been talking about indicators all day. So, and a lot of them work. Some of them may work on Shopify. Some of them may not work on Shopify. You know, there's 200. Also, the other thing is there's 200 indicators in the system, in the Metastock program, and there's about 50 or 60 systems. How do we determine which ones work best? Well, we could, like we did with Shopify, we could come in here. We could look at where it was selling. It sold right here. It bought right here. That's good. That's a good trade. I could even go in, okay, well, if I sold this, I would have gotten in probably at this bar's open, 389. I would have held it until I went long right here. So gotten out at about 326. I made money there. I would have bought here and sold here. A bit of a break even. I would have sold here and bought here. Made a little bit of money. Lost a little bit of money, but I have a completely objective way of measuring how MACD performs on Shopify. Okay. Now, one of the things that I like about system test, and one of the questions that I get a lot, because as a new rep, I would make some mistakes, especially as a brand new rep. It's so easy to kind of get lost in all the things Metastock offers. I mean, let's be honest. We've been working on this software for over 30 years now. It's been rated #1 for 25 years, and we always try and add good things when we do an upgrade, right? And so one of the things that when I first started at Metastock that I'd start talking to people is like, yeah, there's 200 indicators, so you can apply them all to the chart if you want. There's 54 different systems. There's all these different scanning capabilities. And a lot of times people will be like, well, that sounds really good, but how do I know what's going to work well on Shopify? Or how do I know what's going to work well on Apple? Or how do I know what's going to work well on ACB, which JB asked us to look at? How do I know how often I'm going to trade? And you could look at it. This is objective. You could look at it and figure out exactly how often you're trading in a given year. You could see how well this works. You could compare it with the other 54 experts that are built into Metastock, but we've got computers for that. Let's find out what the best set of systems is for Shopify or for Apple or for all of the optional stocks for that matter, and let's look at how well that works. Okay, I'm going a little bit long, but that's okay. I will go a little bit quicker here. Okay, so I'm going to go back into, this is what we call the Metastock Power Console. We've been working mostly with charts. This is our quote object, if you would. This is our scanner. We talked a little bit about that in the extra 10 minutes I was given. Right here, we're going to click on the system tester. We also have a forecaster. We probably won't cover the forecaster or option scope that much. Ed did a great job of kind of showing off the new option scope, but let's talk a little bit about system testing. So, we've spent 40 minutes talking about MACD. Does it work on Shopify? How well does it work? Maybe we should spend our time looking at systems that work better. Okay, so what I've done here is there's a ton of systems that are in Metastock. There's about 90 that are built in. You can create your own using our formula editor if you want. But I've gone through the list and I've purposefully included all the ones that I know are included with Metastock, so they're not ones that I created. And you'll see that, we'll just kind of go through the list. Here's one that's built on stochastics and RSI. Here's a pattern trading system. Here's a MACD histogram. Here's a couple of versions of a fractal. There's even going to be a turtle trader in here as well. Okay, and I've made a list of all the ones that aren't optimized because I want it to run fast, and that I know are included in Metastock, so they're not something we created or installed with an add-on. And I came up with a list of 54. So I'm going to go ahead and select those. Okay, one of the things, a lot of platforms these days do offer system testing. And we could go ahead and throw one instrument in there and kind of see how well our system performs against the 54 stocks. That's something you can do in Metastock. But one of the things that's fairly unique to Metastock is I could also take this entire list and test it against the entire S&P 500. I could even go back to as far as 1980 if I'm looking at daily data on most of the U.S. stocks and really kind of get some good data about how everything worked on the S&P 500 or the optionable stocks. It has the ability to test like whole baskets of stocks. And but it does take a little bit of time to do that. We are a little bit limited in time. So we're going to go ahead and use Shopify, which was shop.k. We'll go ahead and use a couple of the other stocks you mentioned earlier. There was ACB. Okay, so we're going to test ACB as well. I'm going to just do an instrument search for that to make sure that ACB is a symbol that we can pull. It is, okay, a cannabis company. And then in addition to that, we'll go ahead and type in AAPL.O. Okay. And so what I'm going to do now is I'm going to take these 54 systems that you'll have access to in Metastock with just the subscription to Metastock. I'm going to test them against Shopify. While I'm at it, I'm going to do ACB. And while I'm at it, I'm going to do Apple. And I'm going to go in and do long and short trades. So it'll take long trades. It'll take short trades. It's going to go back about 1 year of history. You look like you want to ask a question, Mr. Lewis.
Oh, I'm so sorry to interrupt your flow.
Did we have a question?
If you're glancing over at the YouTube chat once in a while so they don't feel
I
left
am.
out.
I'm going to actually, I have a couple.
There's a few symbols they threw out that you weren't.
Oh, let's put them in here. We don't want
to. Darts Player 32 said RTN.
Okay.
And Steve Mazur said PRI. But far be it for me, Jeff, to interrupt.
Oh, no, you're fine. That's actually really good.
Masterful
Okay.
presentation.
Okay. All right. We'll throw in PRI. I didn't find a symbol real quick for RTN, so I'm not going to throw it in there, but we'll throw in PRI from our YouTube audience. And I'm going to look at questions in a second. I know there's a few here too as well, but let's get the system test started, and I'll answer questions while it does it, which won't take very long. I'm going to go back about 250 days. It's not set to daily right now, so it's going to go back 250 bars, which is about a year. You could go back, like I said, you could go back to 1980. You could choose a specific time frame if you want and do some walk forward testing. I'm going to go into trade options here and just kind of give you an idea of how the testing is going to be accomplished. You can change these, but I'm going to start with 10,000 US dollars. I'm going to trade, and you can trade different position size based on a number of units, a transaction cost, or a percentage of available equity. I'm going to do 80% of my equity. So the first trade, just to be real clear about how this works, will be 80% of $10,000. If that account doubles, it's going to do 80% of whatever is in its hypothetical account. Okay? In terms of trade execution, and I am purposefully going a little bit faster right now. In terms of execution, I'm going to leave it set to realistic market prices, which just means it waits till the bar is closed to make sure it's getting the signal for that day. And since the bar is closed, it's going to buy on the beginning of the next open. Okay. There are all kinds of options you can set. I just want to make sure you guys all understand how we're doing this. I'm going to go ahead and start that system test. And we'll talk a little bit about, so it's going to run 216 tests. It's going to be done before I can answer some questions. What is the cost difference between the live and end of day data feed in Metastock? That's exactly the difference. The real-time, RT stands for real-time, and that'll give you real-time markets as well as intraday markets. DC stands for daily, so that'll give you daily, weekly, monthly. If you have real-time, you do have all the daily options as well, so don't worry about that, but that's the big difference, is real-time and intraday versus daily charts. Okay. Crow Maze says robbooker.com/megastock doesn't work for a $79 deal. Well, let me just, it's METASTOCK, not MEGA. So I'll just type that in real quick. And I'm sure that will work for you. Okay. I did have Steve with the right email address that was saying the Rob Booker site is not working. It looked like it was working for me earlier, but if you do want to get that, if it isn't working legitimately, drop me an email, and I will forward your information to Rob. I'm sure they do definitely want to get there for you. Trevor Gastay says, Jeffrey, shame on me. I didn't know and got here at 3:30 p.m. or so. That's okay. We recorded the whole thing. So within an hour, you'll get the YouTube link, and it'll actually be, you can start watching it immediately. Okay, so that system test is done. I'm going to go ahead and click on the report button here, and we'll take a look at add the reports. Usually there's a little bit of a pop-up, but I talked for too long. And we'll go ahead and click on view report. Okay. Wow, I didn't expect. Usually there's a little bit more red in here. So, but over here, what we have is those systems that we tested. No. This is just the MACD. Okay, so let me see. Where's the report that I just ran? Right here. Let me go ahead and click on view that one. And we'll go ahead and click on view right here. Okay, this is a little bit more along the lines of what I expected actually anyway. Okay, so we have a listing of all of those systems. The fractal trading system was the best, number 2, followed by ACT, Mama, Fama, ACT. And you'll notice, because I'm going to point it out, average net profit, average percent gain, best profit, worst profit, average number of trades, average trades versus average loss, average profit versus average loss. It's all averages because we're looking at those 4 stocks I typed in. So it's the average if I would have taken every single trade for all of the stocks in the basket that I tested, the average result in the case of the fractal trading system would be a 44% gain last year. Okay, the best result would be 6,600. The worst performing result would be 3,000. I have 4 trades that were winners on average, with an average profit versus average loss of 3.0 to 1.8. So this was a very good performing system on average. Okay, and when I kind of talk about system testing, I kind of talk a little bit, if you looked at the description now, which you probably don't remember, I talk about finding the right strategy for you. Okay, so what I mean by that is right now what I'm looking at is I'm looking at average number of trades. So it actually is very, very convenient that my best performing system on these 4 stocks was the fractal trading system number 2. It made 44%. And for every instrument I was trading with it, if I would have followed every trade, it would have only traded 4 times a year. Okay, which is perfect for me. Okay, that may not be as active as you want. You might want to be able to trade more often. For me, I work. My wife says too much, but that's a discussion for later. But I work a very full-time job, and then when I get home, depending on the day, 2 to 4 kids are around the house, and for me, being able to find a system that made 44% last year, traded on average 4 times per that year, was very, very good. If I was looking at something a little bit more active, maybe like the Mama Fama system, which made about 14 trades. Okay, so I'm going to go ahead and click on View right here, and as soon as I do that, you'll be able to see all of those stocks that we tested. If we had tested 500 securities, it would have 500 different green or red bars. But since I only tested 4 securities, I only have 4 bars here. Okay, and now I'm looking at individualized results, and now I'm also realizing I need to move a little bit quicker. So Shopify was the best performing, so good job. I can't remember who brought that up, but Shopify, Theo, yep. Shopify was the best performing with this fractal trading system, followed by Apple, followed by Aurora Cannabis, and Primerica. Okay, and we can see that had we traded Shopify the last year, we would have taken 7 trades. Of those, 4 of them would have made money and 3 of them would have lost money and would be actually up about 66%. So what we've been able to do right here is identify how well these work on an average of stocks. And we've also been able to narrow it down which ones work the best. Because when I'm trading, what I want to be able to do is I want to trade the best strategies, but I also want to be able to pair those up to the best stocks. And because with Metastock, it allows us to test multiple strategies at a time against multiple stocks at the same time, I can kind of get an idea of how well this works. This method works on an average of over 4 stocks or 500 or all the optionables. I can get a good feeling of how good of a system this is over the last year, but I can also narrow it down to the Shopify or the Apple or the best performing of that list that I tested. So again, it's about finding the right match for the right stock and finding something that works pretty well. Okay. There's a whole report. I'm not going to spend a lot of time on the report, but this will show that it had 66% gain, 7 trades total, 4 betting it would go, 4 were profitable, all of them were to the long side, 3 were not profitable, and all of them were to the long side. Now I know fractal trading system quite well because it tests well over and over and over again, and I know it only takes long positions. It's looking for very, very specific things, okay? There's a whole bunch of other stuff, including like an equity curve, which I do want to show. It'll show us how our equity grew over time. But I don't really have time to go into much more detail. What I will say is if you click on the help button here, again, it's a magnificent help file. It'll actually show you. And we have training that'll actually go into detail as well in terms of what all these numbers look like. From a perspective of looking at that on a chart and learning about the method in general, we're already looking at the best performing stock. So what I'm going to do is I'm going to attach that expert system, which was so we'll just go back into the expert advisor. I'm going to find that fractal system number 2. I'll go ahead and click OK. It looks like it generated a long signal right here. You'll see where the buy signal is. Okay, but if I come into the commentary, it's actually going to explain what this signal is doing. So right now, if we were looking at about the 18th of November, so about a month ago or so, it would have told us to get long. And it says, well, many definitions are available for fractal securities trading. This is based on the Bill Williams methodology in his KS-BOS trading models. Here's what the definition of an up fractal is. Here's a down fractal and how it's defined. And I am skipping a little bit, but this system is basically buys when you have an up fractal and it sells when you have a down fractal. And the fractal is just basically it's a middle bar with two lower highs on each side. So it's an up pivot. When that up pivot actually breaks, you buy. And then you sell when it happens to the reverse. But you can read this. Now what we've done is we've enabled you to find the best strategy, and now you can learn about the strategy. You can understand how well it works. You can understand the drawdowns for that particular methodology. We haven't even talked about testing, but the honest truth is we don't have time. And we did talk about scanning before. So if you do find that strategy that works well for you, you like this fractal trading system, now you can take that, you can go into the scanner, and every day you can just have a quick watch list of just those stocks that work, or have a buy signal for fractal system, and you can kind of choose your best ones. But, system testing, the ability to kind of go through all of this data here, instead of learning about hundreds of indicators or 50, 60 systems, really helps you shortcut your learning process. And I do say shortcut intentionally, because I still think, you could jump straight to trading the fractal system. You could go in and run a scan. But I still think it's better to understand why you're trading, whether it's the MACD indicator or the fractal system or the turtle system. Understand why you're trading, where your stops are going to be, what you're looking for to get out of that trade, because it's going to help you, again, with that discipline that you need to be successful. Okay. So, and, Metastock's huge. System tester, the expert advisor, laying everything out for you, one of my favorite tools. I think the scanner is my best because I could actually easily go in and say, show me all the buy signals today. We wouldn't want to buy Shopify today, right? It had a signal 14 days ago. Is it going to still keep going up? Who knows? But we haven't tested that. What we want to do is find actionable intelligence today that we can get into the market with. So anyway, there's a good showcase of a couple of our tools. In any case, let's go ahead and go back to Gerald Appel here. We'll talk a little bit about how much Metastock does cost. Okay, there are a couple of different options that are available for Metastock. You can buy it, you can lease it. You always need data with it. Pretty much to kind of keep things real simple, I focus on the lease prices. There's a couple reasons I focus on the lease prices. The biggest one is so I can give you a 90-day trial. What I want you to do is install Metastock, run it, have experience using the software that's literally been rated number 1 25 years in a row. And then if you like it and if it makes you good trades, well, then obviously you'll keep it. It's worth it at whatever the cost is, right? But in that type of a scenario, after you're done using this in February or March, give us a call, talk to your sales guy. They'll help you convert to a purchase option, which is about $100 cheaper, really. So, but Metastock real-time costs $250. That includes the news that comes from Refinitiv, formerly Reuters. It includes the software, Metastock, that I just showed you. And it excludes the exchanges. The exchanges, if you want real-time data, a lot of them charge you money. And those are extra. They're like taxes. New York Stock Exchange, I think, wants $3.50 from you every month to get real time. And so it doesn't include those. If you don't pay for them, you still get delayed data, but you don't get real time. Okay? So that's our real time package. It's $250 per month. Our end of day program is $69 a month, so about $20 a month for end of day. That includes Metastock. It also includes the data that you need to get running. It's also been rated number 1 25 years in a row. It'll also include somebody to help you install the program. Both versions include this, by the way, but it'll include the Unleash the Power of Metastock to help you understand all of the tools and how they work. And so yeah, if you want to do DC to get started, it's about $20 a month for the next 3 months. You pay $70, you buy one, you get 2 free. Okay, you can do those independently. We'll include still the white glove installation. We'll include our support. Our support is awesome. We have more people in our support team than we have in ourselves and marketing teams put together. And I didn't check the survey results for our support desk this month or this week, but usually they get 100 out of 100 in terms of the feedback that they get. It's amazing. I was talking to Jake the other day that said I had just a question about Metastock. I talked to Merrill. Merrill was awesome. And I'm like, I'm not surprised. We really run. All of our staff is based right here in Utah. And I hear good things about our support team almost all the time. And I think that's important, kind of somebody you can call or chat online with, help you just get through a question real quick. It's available for you. It's part of the package. And the fact that they've actually gone a little bit more proactive about it and actually help you install it is amazing. So part of the Metastock Summit offer, if you buy 1 month of either real-time or DC, we'll give you 2 free months. It includes the data region of your choice, WhiteGov installation support, unleash the power of Metastock, and a recorded bootcamp session. So to sign up for that, give us a call at 800-882-3040 or chat live with us at metastock.com/saleschat. Okay. It is also, you'll get full real-time access as part of the Summit package that we've been talking about all day. You get Metastock real-time. You get the billion-dollar news product that they spent $1 billion designing and supporting with 2,000 reporters, 200 news bureaus. It's a great service. It's similar to Bloomberg. You get all of the add-ons from Rob, Price, Jake. All of that is just $896, which is a discount of $848. I'd encourage you to try it. 800-882-3040. You can chat live with them at metastock.com/saleschat. And I hope that was helpful for you. I hope it encouraged you to try it. As I said at the first of this, I wouldn't trade without Metastock, and I'd encourage you to try it. There is a reason it's been rated number 1 25 years straight. We haven't missed a year yet. And that's by the readers of Stocks and Commodities, by the way. Michael asked a question that I'm going to answer real quick. Can you test one indicator to find the best settings, or even better? Yeah, you can test anything you want. We didn't talk about how to create your own systems, but it's really easy. You can create your own systems. You can create your own scans. It's a toolbox. And one of the things I love about Metastock is it's not a toolbox that you're going to outgrow. As you learn more about trading, as you get better at trading, it's going to grow with you. I've seen so many packages and so many software over the last 24 years that cost like $3,000 and you have to buy it and it's a one-time cost and it's like a couple of moving averages and you grow out of it immediately. This is a software that will grow with you. It's a serious software, and that's why we've been able to maintain that award for so long. Thank you for the question, Michael. Ron asked, any future in iOS with Metastock? Yeah, we were talking about that the other day, and we're looking at that. And I'm not going to promise it, but we were looking at it in a development meeting the other day just to kind of see the feasibility of it. There are a lot of people that ask that question. We do get a lot of Apple users, and that does require boot camp. Okay? Ann says, I can't get to this Rob Booker site. Email me, Ann. I'll get you to the right place. Maybe there's a malfunction over there. But we definitely do want to get that to you. Okay. All right.
You want to take a question from the GoToWebinar side, or are we out of time?
We're give us one question. Rob, or Steve says he can't hear the presentation, but he can't turn on sound. Steve, do me a favor and unplug your microphone and plug it back in, and we'll see if we can hear you.
All right.
Okay.
You there?
Yeah, it's working.
That's hysterical. Oh my God. I've been troubleshooting for 15 minutes. I had to switch over to a laptop. This got exciting really quick.
Oh, okay. Well, we've had our share of missteps today. We've had a couple of technical issues. But I'm glad you were able to sort yours out. We had to play a commercial earlier.
Okay.
In any case, we can hear you. We're going to take one more question and turn the time over to you. Is that okay?
Yeah.
Okay, perfect. Okay, what's your question, Greg? We'll do it fast.
Oh, yeah. So DartsPlay32 said, is it possible to run the tests for 2018, then run the best system on 2019 to see the results to remove?
Yes. People call that walk forward testing is kind of like the technical term for that, and you can absolutely do that. You notice that I had it set to all current bar. You just basically you uncheck that and you put in the date range that you want, and you can test whatever period you want. They call that walk forward testing, and you can do it in Metastock. So in any case, Stephen, we're glad you made it. Okay, before we get to you,
sure.
Want to say thank you to Stocks and Commodities for supporting and sponsoring the event. I want to show a picture of you, Stephen. And I want to say, how are you doing today?
I'm good.
Okay. All right.
Doing great. Excited to be here.
I'm going to give you the opportunity just because I want to give you the opportunity to kind of talk to us a little bit about yourself. And mostly is because I didn't get a chance to real quickly review your bio before we started talking. So it's a little bit of me being lazy, I think.
Right. It's fine. There we go. Okay. For those of you that don't know me, my name is Stephen Place. I am the founder and head trader at Investing with Options. I've been trading and educating with options for, I think, 11 years now. We're coming up on past a decade. I'm based out of the Gulf Coast in Florida. It is about 70 degrees outside right now, which is really nice.
That is nice.
Yeah.
Okay.
So,
well, I'm going to get out of the way. I'm glad we got you on. I'm glad your audio is working. I can tell you everything's working well. If we get some questions through YouTube, we'll ask you at the very end.
Oh, cool. Right on. So, do you see my slides?
Yeah, everything looks great. We can hear you well.
All right. I'm on this 13-inch laptop as a backup. Normally, I have two 24-inch screens.
It looks great, Stephen. Yeah, sure.
So I'm going to take questions a little bit later, and it's going to be a little bit of a slower pace for us. In any case, thank you all so much for coming to this event. I'm excited to be talking about buying the dip. This market, as it stands right now, is, it's very strong. And if you aren't prepared to take advantage of safely buying the dip when you can, then you're going to miss out. There's going to be opportunity costs. So we're going to talk a little bit about that. We're going to talk about some option trading strategies that you can use. We're going to talk about some psychology and some trading systems that I do believe will help you become a better trader. This is the disclaimer. Everyone knows this disclaimer. Options trading and any other kind of financial speculation can change your life. Whether it changes it for the better or for worse is going to be up to you. How you manage your risk, how you manage your stops, what kind of position size you work with, what kind of stocks you decide to trade, what other assets as well. I believe that it can change your life for the better, and that is why I am here today. We just have to make sure that you do understand those risks. Option trading, just like leverage stock, futures, Forex, Bitcoin, tulip bulbs, all have financial risk. And if you don't understand how to manage that risk, you're going to be in a lot of trouble. So my name is Stephen Place. I'm the founder and head trader at investingwithoptions.com, and I help folks just like you realize their financial dreams through options trading. I've been at this game over a decade now, through massive bear markets back in 2008, 2009 to massive bull markets in 2013, 2017, and everything in between. I will never say I've seen it all, because as soon as you say I've seen it all, the market gods will come down and smite you. So I do believe that the strategies and the systems that I've developed for myself and my clients over the past decade are very robust. And I'd like to share one of those strategies with you today. So let's talk about buying the dip, right? There is a process that happens when you think about psychology and missing out and wanting to get those profits, but you also want to get a good price on a stock and get good risk reward. Here's what you think buying the dip looks like on paper. So here's a chart. This is of Lululemon, L-U-L-U. It's one of my favorite trading instruments right now. And we'll take a look at some actual trade setups in Lulu in a little while. But this is the idea where you see a nice move higher, and then the stock slowly pulls back, and then you get bullish the stock and you get long the stock, however you do it. And then immediately, just like that, the stock rips higher and you get some very nice profits. That's how when we think of buying the dip, that's the ideal scenario, where as soon as you enter into the stock, that is the absolute bottom, and the stock only goes up from there. Easier said than done, right? This is what it looks like, because what will happen is you'll see all these opportunities, and as soon as you decide to strike on that one opportunity, you buy the dip in the stock, and then it absolutely falls out of bed. We're going to talk about some techniques you can use to avoid that kind of trap. But what will happen here in this cycle is that you'll get burnt on a couple trades, a couple investments go wrong, and then you say, okay, I'm just not going to even look at it anymore. I'm not going to try and buy the dip in these stocks. And what happens next is all of the stocks in the world run without you. This has been the case this entire year in 2019. Because at the end of 2018, if you remember, the market crashed. We basically ran 20% to the downside. And it flushed a lot of people out. And where we stand right now, and this is obviously not an evergreen sort of class. We're going to talk about timely events. The markets are at or near all-time highs. And if you actually look at total equity inflows, the people who are buying stocks, it has been negative. During this entire year, people have been selling stocks. And so we're at this point where the markets are running with as few people on board as possible, which means dip buying is one of the best ways to get re-involved. In fact, over the past 2 weeks, the market did manage to dip. What happened with everyone there? Right, I don't have a chart on it, but if you go and you look at a chart of the S&P 500, there was a big level at 3030 that the market broke above. We ran up to 3190, and then we started to pull back. Well, what happens here? Everyone starts to look at that 3030 level and says, okay, I may not be long stocks right here, but I do want to wait for that pullback. But everyone starts to wait for the deeper and deeper and deeper pullback, and then it never comes, and then we come back to all-time highs. Right? That's the kind of frustrating process we have to deal with, and we have to find ways to get around that. So we know the problem. We know that it is easier said than done to be a dip buyer in stocks, because we think in our heads, as soon as we buy the dip, the market will fall out of bed. And then the one trade we miss out on is an absolutely massive winner. So let's talk about some solutions. We're going to talk about mind games, systems, some key technical indicators and strategies that I like to use to make dip buying a much easier process. So first and foremost, dip buying is a psychological problem. It is mostly between your ears. You've probably seen this before, where you research a stock or you're paper trading and it's going well because you're picking the right kinds of stocks and the market's moving in your favor and all of these other things. But as soon as you put money at risk, something changes, something shifts in your head. And there is a part of your brain called the amygdala. And the amygdala cannot tell the difference between a saber-toothed tiger chasing you and financial loss. And so as soon as we put money at risk in the market, that amygdala, that lizard brain, immediately goes into overdrive and we start getting scared. And we can actually see that fear reflected in the price action of stocks. And that's one of the ways that I like to view the market and profit from it. But we need to start to overcome some of these psychological problems and then start looking at systems. So one thing that you need to think about is mindset. Let's say you went on a trading sabbatical, an investing sabbatical for 1 year, and you came back in 2021. Let me ask you this. If you missed out on an entire year's worth of market action, do you think all of the opportunities would be gone? Of course not, right? That doesn't make a single bit of sense. The amount of money available every single day is awe-inspiring in the markets. And you only need to take a small chunk of that to realize your financial dreams. So one thing is that even if you miss the first move in a stock or the second or the third, or the market has run without you, you can still get some amazing opportunities. There are investors and pundits who are still anchored on the market crash from 2008, from 11 years ago. There is still this disaster imprinting, and everyone feels as though the S&P has to retest 600 for, some kind of, I don't know, narrative fulfillment, something along those lines. We don't have to think like that. So one thing I want to do, and we can do this in the Q&A box, so I'll make sure to pull it up. We've got two scenarios here. Let's say you have a stock at 20 bucks and you buy the stock at 20 bucks and then you sell it at 30 bucks. All right, that's trade number one. And then trade number two is you buy the stock at 50 bucks and then you sell the stock at 60 bucks. Which one is the better trade? And let me know in the Q&A box. Let me make sure I've got this thing set up properly so I can start seeing answers coming in. If you haven't noticed, this is a trick question. And I'm not sure what the delay is on this. So just give me 1 second. Let's see what your audience view is too. Yeah. Okay, cool. So let's scroll this back down. Man, doing webinars on 13-inch monitor is amazing. Okay, a couple coming in. Scrolling. There we go. We're seeing ones. Sandra's saying, I like trade one because it's the greatest ROI. Bob's saying 1% is better. Here's the trick question. Okay, it doesn't matter. Yes, percentages are great if you are managing a hedge fund. I don't pay my mortgage in basis points. I don't pay my mortgage in percentage points. $10 on a stock is going to be $10 in the bank. It's not going to be 50%. It's not going to be 25%. Now, this is really important because there's another psychological thing called anchoring, where we anchor onto a specific price. So let's just say you were researching buying Apple at $100, and then Apple breaks out, and then you miss the trade, and then Apple's now at $200. But your brain has still anchored on that one trade you missed at $100, so you can no longer see the opportunities available in Apple. All right, that is a very dangerous thing because limiting those opportunities creates opportunity cost. Sometimes you miss out on the best kinds of trades because you don't go back to the same stocks over and over and over again. With my trading style, I'm focused on the same 75 to 100 stocks every single day. I look for the best opportunities in those every single day. And I don't care if Apple is trading at $200 or $500 because my time frame is about 1 month out and I'm looking to make money. I'm not looking to make percentages. Okay. So we want to avoid this anchoring bias. And one thing that I like to think about is being price agnostic, where we care about profits regardless of where the market's trading, regardless of where the individual stock is trading, because there are dangers associated with believing that the S&P is still at $2,000 a share when it's over $3,000 a share. We don't care. We just want to trade the market. We want to trade the stock and pull profits out. So let's go back and let's take a look at a few trades, all in the same stock. This is the first trade. This is in Lululemon. And this was back from a couple years ago, back when Lululemon was trading at $80. All right. Now, the way I prefer to trade is I tend to focus on being a net seller of options. If you've never traded options before, this may look a little bit advanced, but this is the basic idea. All right. So this is back in 2018. This is a bull put spread, also known as a put credit spread, where you sell the 70 put, you buy the 65 put, and you get a credit of 70 cents. All right. So for every $430 in margin, you earn $70, right? If you do 10 of these, then you earn $700. If you do 20 of these, you earn $1,400. Okay. Now this trade worked out. It worked out really nicely. Now there's some other things in the risk plan with exiting early and scaling in and scaling out and things like that that we can talk about later if you want. But the basic idea is it was a good trade. The stock ran and this trade made money. Now, fast forward a year, Lulu's not trading at $80 anymore. It's trading at $150. Does Lulu trading at 150 make it less of a viable candidate? No, of course not. All right, because we're traders. We don't necessarily care about, I mean, we care about the company, but we care more about the stock. There is a difference between the company and the stock. Right? We are focused more on liquidity and trading opportunities and volatility than we care about what the stock's going to do 10 years from now. Me personally, I don't want to find the next Amazon because I can go trade Amazon over and over and over again and get the same kinds of returns. And those add up. So here's another one. This is where Lulu's trading at, maybe not 180, it's trading at 200. Same kind of structure, except we're looking at strikes that are $100 higher. Does that mean the risk reward is bad? No, not necessarily. All right, we're just trading the natural volatility of the stock. So this is the November 2019, 180, 175 bull put spread at 90 cents. Again, this trade worked out. Now what happens next is, let me see if I can get some drawing tools on here. There it is. Caption pointer. We'll do a pointer. Maybe you guys can see the little laser light show. All right. So what happens here is the stock breaks out and then it comes back and it retests this 50-day moving average right here, starts to bottom out. Okay. Now a month ago, Lulu was trading at 190, and then a month later, Lulu's trading at 190 again. All right. That's one of the benefits of being a net option seller, is because you can actually make money even if the stock goes sideways. Right. So what happens here? Same kind of structure, just on different expiration dates. Sell to open, the December 170 put. Buy to open, the December 165 put. Catch a credit to 74 cents. You do 10 of those at $740. Then you scale in, scale out. Okay. We could go back to the same stock over and over, and we can be price agnostic. We don't necessarily have to care about where price was 10 years ago, because we're not trading on that time frame. We're trading on a 1 month time frame instead. So we've talked a little bit about eliminating some of the psychological issues that we have with anchoring bias and disaster imprinting. And we talked a little bit about some behavioral psychology and some fancy brain terms like the amygdala, some less fancy brain terms like the lizard brain. One of the things that I like to do is create systems to take myself out of the equation. Okay? If you own a McDonald's franchise, right, you get a franchisor book that tells you how to operate that franchise. So when I think about trade systems, I think about having my own little McDonald's where the operations manual dictates the kinds of trades that I want to take. When I do that, it takes the lizard brain out of the equation. Okay, it removes some of the ego associated with it. So the first thing you need to do is you want to find stocks to buy pullbacks in. I'm an options trader first and foremost. So the main thing I focus on is options liquidity. If a stock doesn't have a liquid options board, then it doesn't make sense for me to trade it, because if I get in, it's going to be very difficult for me to get out if things start to go wrong. Okay, so what I'd like to do here is have just a running list of about 75 to 100 stocks that I look at day in and day out. And I don't even have to look at them every single day, because I've got scanners and screeners in place that do this for me. So normal things, right? Your name brand stocks, your Apples, your Amazons, your Googles, your Facebooks, your Exxon Mobils, your Amgens, your Biogens, your Celgenes, larger cap liquid stocks. Again, I don't have to find the next Amazon. I don't need a 10x stock, because I can trade the natural volatility of the stock and get the same kinds of returns. I can just trade Amazon over and over and over again. So what I like to do is I use an upside down list to sort and find the strongest stocks. When we want to buy the dip in stocks, we don't want to knife catch. All right. Now I've got knife catch strategies, but those are completely different. Okay. When we talk about normal dip buying, we don't want to look at the weakest stocks in the market. We want to look at the strongest stocks in the market and then wait for pullbacks. So how do we define these setups? How do we define what the strongest stocks are? What I do is I just use the RSI and I try and keep it as simple as possible. So this is a power console Metastock, and I've got a list of my best traders in it. And all I do is I go to the Explorer, I go to the forecaster, I go to RSI overbought, and then I run a scan. Basically, when you have an RSI reading that's overbought, that doesn't necessarily make it a bearish stock. In fact, it's quite the opposite. What tends to happen when stocks get overbought like that is that they will see their first pullback and then rally again, or they'll go sideways. Excuse me. I'm going to open it up to questions really quick in case I missed something. Okay. People are still stuck on the trick question. Michael said there's less capital at risk for the same profit when we look at trade 1 versus trade 2. I tried to keep it simple because it is a trick question and it's supposed to kind of upset you, to throw you off a little bit. When I think about trades, I think about in terms of R. All right, R multiples, if you've ever heard that before, and MAs and things like that. So technically, yes, percentages, but again, we care about absolute dollar outcomes. And I think it is very useful to consult to the stock that I missed out on has already rallied, because I can play it again if I want to. So it's a very useful psychological exercise, because no one's going to say to you, if you go out and you pull out, let's just say, hold on, excuse me, let's just say you get a $500 profit on a stock, the bank is not going to go to you and say, oh, I'm sorry, we can't accept that $500 deposit because the stock was overvalued. All right, that's not a useful mental model to have. So it's helpful to have some kind of a psychological reset to allow yourself to explore all the kinds of opportunities in the market. Okay. All right. There we go. Cool. So yeah, every single night I just look at the strongest stocks using the RSI, and then I look at the chart and I start planning my entries. And I want to do this before price gets hit. This is a very useful system to have. If you do track your trade performance, and you do track your trade performance, right? One thing to do is, if you put on a trade where you discovered the idea in the same day, you need to write that down. I call those impulse trades because they're normally based off of an idea that I picked up from somewhere else. And I may not have researched it quickly enough, or taken too much time, and I found that my impulse trades don't work very well. I like to have my entries planned out on a stock a couple days before, maybe a week or two before the price is even hit. Give me 1 second. View percent. All right, we're gonna, yep, there we go. So the next question is, after we've identified the strongest stocks, what kind of support levels do we want to look at? And this really does depend, but I'll show you the best ones, the most effective ones that I use in my trading every single day. Okay. This all stems from the idea of supply and demand. Now, this is a chart. This is a level 2 chart. It's not a complete level 2 chart, but this is the basic idea. On the left side, you have the people who want to buy a stock at a certain price. On the right side, you have the people who want to sell the stock at a certain price. All right. So the demand is on the left side. The supply is on the right side. If there is more demand than supply, prices rise. If there is more supply than demand, prices fall. So what we want to do is identify levels in a stock in which demand has previously exceeded supply. All right, so we're not looking at anything outside of that framework. All right, it has to be within that framework. We have to identify levels in which we expect demand to exceed supply. So there's only a handful that I look at. The first one's simple enough. This is previous price support. All right, if a stock sells off into a price level and there is demand there, the price will bounce. This is responsive buying. Okay, I'm a big believer in market auction theory, and I think that that's a good, useful thing to have. So if a stock comes back into a price level again, odds are demand will exceed supply again, and that will be a good time to buy that dip. The more times a price level is tested, the higher the odds that it will fail. So you want to only trade the second or third retest of a price level. Okay. Then you also have previous price resistance. There are instances in which these are breakouts and very obvious levels of resistance. We will see a market sell off into that previous resistance, and that now becomes a new source of demand. Now think about this. What is the why behind that? There are investors on the sidelines who sold or in cash or are waiting, and they said, oh, I missed the most recent breakout, but if it comes back to that breakout level, it becomes sort of a self-fulfilling prophecy. So I look to identify previous price resistance levels that tend to act as support. So this is an example in Nike, where Nike had earnings and it gapped up and it took out 90 and it ran to 96. And then it got hit really hard on news that their CEO was leaving or something along those lines. And then the stock came back to that $90 level. Now what happens? There is a failure to see follow through to the downside. When you see that kind of failure, there is a tendency for support to get built out right there. And that's exactly what happened. So we're going to look at a case study in Nike in just a little bit. I also look at major moving averages. Me personally, I tend to focus on the 20-day moving average and the 50-day moving average. It's also important for me, I like to see confluence. I like to see multiple technical support levels at or around an area to take advantage of it. So if we see a previous price resistance level coinciding with a rising 50-day moving average, I will look for the stock to sell off to that level in order to dip buy that stock. All of that research is done before I even take the trade, and it is not done on the same day to avoid any sort of psychological issues with me putting on impulse trades. Here's another one, and this one's a little bit more clever. Okay, we talked about the upside down method just a second ago. And it's the counterintuitive idea that an overbought stock with an RSI reading over 70 is not necessarily a bearish signal. It's not necessarily going to say the stock is ripe for an absolute reversal and a big sell-off. The converse is true as well. If you see a stock that's drastically oversold, that on the RSI, that usually is not the absolute bottom. You will see a new lower low with something called an RSI divergence. Okay. In very strong stocks, if you wait for an oversold reading on the RSI, odds are it's not going to come. Oh, go back. So one thing you can do is if the stock has an overbought RSI reading, and then the RSI goes back to neutral, and neutral is right around 60 or 50, that is going to be a good entry point to buy the dip. One reason that this is useful is because that is more of a momentum-based characteristic, saying, okay, momentum has cooled off enough. We're not running super, super hot. It also allows you to dip buy stocks that have just gone sideways for a while and still offer good risk reward opportunity because it's still a very strong stock, but you're not seeing aggressive selling because buyers are still in control for way too long. Let me check the questions because I can get a question thing now. Okay, cool. Michael's saying stocks will usually bounce off bottoms faster than off the top, where faster than the top where it may linger on a trending higher setup. I actually have a completely different trading system for that using income calendars, which is pretty cool. But yes, overbought markets and market rallies do not trade the same as market sell-offs. And it is a good idea to, especially with RSI, and this applies to a lot of other technical indicators out there, sometimes those overbought readings are not massive sell indicators. They're actually telling you that there has been enough of a momentum shift and the technical characteristics of the stock have changed enough that odds are it's going to continue to drift in the direction of whether it got overbought or oversold. Anyone remember December 2018 where the markets were oversold and then it got oversolderer, right? It's being an overbought and oversold and looking for a reversal is not a sufficient enough condition to start looking for aggressive mean reversion. There are some other things you need to add on with respect to volatility, range expansion, and what I call parabolics. But for normal market rallies, you can use this, okay? Now, because I am a net option seller most of the time, excuse me, I use something of my own design called the turning point indicator. And this basically shows me the rate of change on a stock over a certain time frame and how that rate of change has acted over the past couple months to couple years. The reason that this is useful is because I can go to a stock and then I can say, okay, the stock is sold off 5%. Off its highs going into options expiration, normally the maximum loss on a stock will be something like 10%. All right, so then I can go and I can start looking at selling spreads where the odds are much more in my favor because I have aligned it with what has happened in the past with a stock. Okay, so I'm going to try and say that a little bit more clearer. This turning point indicator doesn't give you exact market bottoms, although it does. This indicator helps to guide what options to trade when you trade a stock. Okay, so let's say a stock's trading at $200 and we know that the stock normally, a normal sell-off is 10%, so that'd be $20, and the stock's already sold off $15. And so we know that normally, statistically, there's not much downside left. But what tends to happen in market sell-offs like that is that the option premium and the fear will be higher, and that the market will start to overprice the risk on the downside. If we can find that overpricing, then we have a single distinct edge in our trading. This is a very, very useful indicator. And it's something that I use to guide my trading decisions when I start looking at what strikes, what option strikes to trade with my options. Let me check the questions really quick. Tim's asking, I don't understand the turning point indicators drivers. So the basic idea is you've got a rate of change on a stock on a percentage basis, and then the bands are volatility based. All right, so what I'll do, for example, I'll look at a 20-day window, and I'll say, okay, what's the stock's rate of change over the past 20 days? And we can say, okay, it sold off 5%. And then I can say, well, what happens statistically over a 3 to 6 month window? And we can say, oh, the stock, given the way it's moving, it's going to, 2 standard deviations is going to be right around 7%. And so I can start looking at selling put spreads at strikes that are lower than the 7% sell-off. That's not a guarantee, but it drastically shifts the odds in my favor. Oh, speaking of stacking the odds in your favor, we're going to get into some options trading, just a really, really quick second. What are the risks, right? You buy the dip, you buy some stock, and then the market absolutely falls out of bed, right? And then you're sitting at a very large loss. That risk can be significantly reduced if we use options to protect ourselves. So I like to focus on credit spreads. These are also known as vertical spreads. With dip buying, we look at bull put spreads. This is where you are short a put at a certain option strike, and then you're long a put that's slightly lower than the option strike. All right, so taking all the advanced stuff out of it, it's basically a bullish trade with limited risk and limited reward. Okay, the reward tends to be lower than the absolute risk because the odds are in my favor. And here's why I like to do this. This is a chart of how I view the market, where the market will rally, and then it'll go sideways and then sell off and then go sideways and then rally. Which means is if you buy the dip, especially on strong stocks, the first or second dip with strong stocks, even if it doesn't go back to new highs, if it just goes sideways, you still make money. It can even sell off just a little bit more and you still make money. All right, the only time you lose money is if the market or the stock absolutely falls out of bed. And there is a tendency for strong stocks to not do that, at least not yet. There's normally a time period between 1 and 3 months where the stock will undergo sideways, ugly, garbage price action sideways, and then it sells off. That's why we look at credit spreads. Okay. We're going to look at some case studies, but this is my secret sauce. This is where we get really, really advanced, because we talked about systems and we talked about how you can kind of franchise your trades and treat it more like a McDonald's rather than financial speculation. You want to remove yourself from the equation as much as possible. Futures traders and program traders already do this. If you go look at a depth of market and you look at how some of these orders are automated with futures traders, where they say, okay, I'm going to buy the S&P futures right here. I'm going to run a 2-point stop and a 2-point profit target on a half, and then a 4-point profit target on the second half. All of that can be completely automated with your executions. Very few people I know do that with options. I do. So here's a case study in Nike. We talked a little bit about this. The stock gapped up. It ran up to $97. It pulled back and retested previous support as well as a rising 50-day moving average. Now, we don't know if the stock is done. We don't know if the selling is completely over. We don't know if the stock's going to zero. But because it was one of the strongest stocks in the market just a few weeks ago, it gives us good risk reward on the trade. And because stock selection in and of itself is a form of risk management, if you focus on the largest, most liquid stocks, they're not going to be like penny stocks or super small capitalization stocks where there's always a risk of a 50% drop on an FDA approval, right? It's Nike, right? Everyone kind of has an idea of how Nike trades. Okay, so we see the pullback to $90 a share. Well, again, we don't know if it's going to continue down. So what we want to do is automate our entries. So if the stock does continue to move against us, we can actually kind of root for it a little bit and trade like a market maker to get filled. So here's an example. This is selling the December 82.5, 80 put spread. So this is where you sell the 82.5 put, you buy the 80 put. All right. I like to trade in tiers. These are also known as tranches, right? Where I'm not going full size all at once. I'm actually allowing the stock to move against me a little bit so I can get better fills. I do this because oftentimes one of the risks that we have with dip buying is being early, because you don't know when the exact bottom is going to get carved out. Sometimes if you're early, you're going to see a little bit more heat against you before the market decides to rally again. So what I do here is I set good till cancel limit orders at 31 cents, right? So that means my margin on this trade is going to be $219 I think I did that math right. And then my maximum profit is going to be $31. $31 may not seem like a lot, but if you do 20 of these spreads, all of a sudden it's $600. You do 40 of these spreads, all of a sudden it's $1,200. All right. One of the beauties about credit spreads is that if you're brand new to options trading, you don't have to put a whole lot of money at risk to get experience. And then it scales up quickly. If you can successfully trade credit spreads with 3 spreads, then you can do it with 30. All right. The liquidity is still going to be there. One of the other things I like to do, I do not hold credit spreads to expiration. All right. There's some technical reasons for it, but the reason that I think gives the best explanation is that the market gods will come down and smite you. I'm a big believer in the market gods. And if you look at this and you say, okay, I'm going to make money as long as Nike doesn't hit 82.50, as soon as you say that, the market gods will say, okay, we're going to jam that sucker down to 82.50 and you're going to get stopped out. Right? We don't want that to happen. And sometimes what will happen is you will have this trade, it will be at a profit, and then enough time has gone on, but the premium is sticky. All right, that's the technical side of this, where the bid ask is the bid is always going to be a non-zero number because a market maker is not going to give you a free option. Okay, so that's why we want to scale out a little bit more aggressively. Okay, let me hop over to questions really quick. All right, Craig's giving me a great testimonial saying there's an excellent workshop with fantastic information. I can't believe I got it for free. Well, Craig, thank you. Let me know where to send your check. Rick is asking, do you have low options commissions? I'm not a broker. I probably should have said that at the beginning. I'm not a broker dealer. I'm not your financial advisor. But if you're asking for low option commissions now in 2019, the web-based trading is free at Schwab. Web-based trading is free at TD now. Web-based trading is free at E-Trade. Okay, so it's commissions are kind of a moot point. And I know we talk about options commissions. God, I've been talking about how to control your option commissions for a decade now, how to negotiate with your broker and how to add volume to help your negotiating leverage. It doesn't matter anymore because they went to zero, right? So yeah, it's fine now. What that also does is it allows us to trade a little bit more aggressively, so we don't have to worry about commissions. Okay. Are there any other questions about what we talked about? We talked about why dip buying is hard to do, the psychological issues that you must overcome when you're dip buying. We talked about what I think is the best kind of option trading structure with dip buying, specifically BUPs or bull put spreads, where you can sell spreads that are lower than the current price of the stock. So if the stock goes sideways, rallies, or sells off a little bit, you still make money. You got my secret sauce with respect to how to scale in on a stock for faster profits. All right, this kind of scaling protocol is incredibly useful in automating your entries. What you can do here is you can put these good till cancel orders out, and if you get filled, you put your closing orders out there. All of this takes 10 minutes a day. It can, if you choose it to be, it can be completely automated. Now, I know, look, if you're on this webinar, you're a market junkie, right? You're not going to be that kind of the person that goes to the beach while your market orders work, right? I do it sometimes on Friday mornings. If it's nice, I'll go out on the beach for a little bit. There's this nice coffee shop that has good Wi-Fi, so I don't have to get my laptop sandy. But I don't like trading from the beach at all. It's too hot, too sandy. There's water everywhere, and I get distracted. So you're going to look at the markets, but this helps to remove your ego out of the equation. You can take this kind of principle and apply it to any kind of trading you wish. Okay. Any other questions? And we'll get to some other stuff really quick. Okay. I'd like to introduce you to swing trade secrets. So we talked a little bit, the idea of looking at the RSI and using an upside down method and then looking at retracements. I call this the RSI retracement setup. I have a course available for you that offers 6 other trading setups, as well as my overall approach in the market. So a couple other things that you can learn in this course, and this is an online home study course. You can identify the SLP pattern. So that's what I call stop loss profits, where you can get amazing entries in a stock without a ton of risk. All right. And in stop loss profits, just really quick, I'll go on a rant. If you buy a stock and then you place a stop loss at a very obvious level, the brokers and the market makers and the high frequency traders will all know where that stop loss is. And what's going to happen? They're going to jam that stock back underneath that stop loss level and then jam it back higher. We see this time and time again. So we want to turn that on its head and say, okay, let's identify the stop loss level first, wait for a key reversal condition, and then we get bullish or bearish the stock. You'll get 4 major secrets that help to provide a framework for stock price movement. You'll learn about magnet levels that have a high odds of being tested. So if you have a stock that, for example, let's say a stock sells off really hard and it drops from $50 to $30 on some bad news. And then what happens? Well, it bounces. What tends to happen there is that into the first bounce, the stock will retest the low because that low wants to be retested. It's a magnet level. So if you can identify those magnet levels, that gives you a framework to say, hey, here's where I want to enter, and then that's going to be a good place to take profits. You also get some quantitative studies and scans so you can find the best stocks to trade. For this webinar only, here are the special bonuses that you can get with the class. First off is Mastering Your Mind. This is my option trading psychology book. So we talked a little bit about anchoring bias, your lizard brain, disaster imprinting, things like that, that as an investor, as a trader, as an options trader, there are key things that you must overcome if you do want to be successful. And all right, we'll just move. It's really good. I wrote it 8 years ago, I think, and it still holds true today. It's crucially important that you get your mind under control if you do want to be successful in financial speculation. The next thing is you get my system on foolproof option buying. All right, so this will show you exactly how to use R multiples. So we talked a little bit about R expectancy earlier. So this shows you a lot of the time you say, okay, I want to be bullish. I want to buy a call. What call should I buy? And this guide allows you to be consistent across different stocks, different asset classes. It completely foolproofs your option buying. And then you can take the concepts you learned there, and then you can apply it to other trading strategies as well. You also get the turning point indicator from Metastock. It's so useful, especially if you trade options. It gives you an idea of how far a stock can move and what the odds are implied for that stock price movement. Right? So if we give about a 10% chance that a stock will sell off $5 and the options market's pricing in a 30% chance, 30 is greater than 10, so you want to sell that. And that allows you to create a little bit more of a systematized approach to trading options, especially being a net option seller. Trevor's saying no beach in Ontario, Canada. Trevor, there is a beach in Canada right now if you are brave enough. Okay. If you want to get access to this, it's I think it's $97. You can go to investingwithoptions.com/trade. That will take you to our secure order form. Fill out your information there, and then our system will generate your username and password, and you'll get access to the course. And I'm just going to see if I can pull up the course really quick. So let's see if this will work. So just give me 1 second. We're doing this live. And then just give me 1 second. Because a lot of people, when you look at courses, I've got other courses available. So the reason it's only $97 is because this is an introductory course. I've got plenty of other courses available depending on what you're looking at. I also have other trading systems and trading services and trade alerts available. But what we're focusing on right now is just swing trade secrets. So you get module 1. Oh, and here's the live chat that just popped up. Hopefully you can see that. Let me see if you all can see that really quick. Yeah. So the live chat right there is actually direct access to me. It also goes to my phone during trading hours. So if you have any questions, let me know. So module 1's a foundation. This is where you get 12 training videos. You get the tools. So showing the technical studies and the things that I like to look at. You get the setups. So the RSI retrace, the Moon, Icarus, stop loss profits, 3 standard deviation lower lows, J hooks, magnet trades, and then the conclusion right there. And then you also get the trading resources. So foolproof option buying, you get my option trading scans, the turning point indicator, the mastering your mind PDF, how to find the best options to trade, installation of the turning point indicator, you get a swing trade journal, and a white paper on market cycles. So yeah, there's a lot going on. And that Metastock just put the wrong thing out there. So Jeff, it's going to be investingwithoptions.com/trade is going to be the secure link to the order form. IWPremium.com is going to be where your course will be hosted when you do pick it up. And then once you see that and see how amazing it is, you can get in touch with me and get bundles to all of our other courses and trade services as well. I do offer a credit spread trading service, and then I also offer something a little bit more advanced if you do want to go down the rabbit hole with options trading as well. Let me just pop over for any other questions really quick. And if you have any others, feel free to reach out. You can go to the site, and there's a chat box. And I'm not going to answer any chats right now because it's Saturday afternoon. But on Monday, I'll get back to you if you do have any other further questions. And that should wrap it up. So thank you all so much for coming. I hope you got a lot out of this presentation. A lot of it was high level, but then I think we did take a pretty good deep dive, and you probably learned some things you've never heard before. And I think that if you do apply them, especially scaling and automating your entries, it's really going to work out for you. So thank you so much.
Thank you, Stephen. We're getting a lot of good comments. Thanks for pointing out the mental aspects. You can't find success without it. Good presentation. I can't believe I'm getting all these great classes for free. All kinds of stuff like that. Good job today. I really appreciate you coming in and spending some time with us.
Sure, it's my pleasure.
Okay, awesome. Thank you. All right, let's go ahead and kind of move on. Craig says, you were great. Thank you. All right, very good. All right, let's go ahead and talk about that. Just another plug of the Trader Summit pack. It'll get you the Metastock Real Time, the Zenith, all of the add-ons that we've talked about today, the White Glove installation treatment, the 2 years of Stocks and Commodities magazine. All of that will be a total of $896 or a discount of $848. So if you'd like to take advantage of that, give us a call, 800-882-3040. You can chat live with us at metastock.com/saleschat. And let's go ahead and talk about our sponsor. Thanks, Stocks and Commodities, for sponsoring today's event. We really appreciate it. You can get a free issue, and we will put the thing back in the link as well. So let's go ahead and go into Mary Ellen. Mary had spoken in our November conference, or our last conference last year. And she did a really, really good job. I really liked what she had to say about kind of the way she looked at markets. I thought she was incredible, actually. So we saved the best we saved a really, really good presenter for last this time. So Mary, how are you doing? I can hear you.
Good. Yeah, great. I'm glad you can hear me. And I want to thank you for having me back again. I cannot believe it's been an entire year. I remember it very vividly because I happened to be visiting in Manhattan, visiting some clients. and I'm back in, I would like to say sunny California, but we're getting a little bit of a rainstorm, surprising in Southern California here. But thank you again for having me.
Well, we're inverted, and so it's all murky outside. It's gross in Utah right now. So
Oh my.
you
Yeah,
might as well stay
yeah,
inside and watch a really good technical analysis presentation, right?
absolutely. No doubt about it. Yep.
You've already got fans. Trevor just said you're a boss, or she's a boss. So, in any case, we do have, and you won't be able to see them, but we do have quite a few people watching on YouTube. So, if we have some questions, we might bug you at the end for them. The other thing that I should mention is with YouTube, we do have like a hard 8-hour limit, but they've never cut us off before. so,
Okay.
they might
I think we'll be fine. We'll be fine. I'll make sure to
keep it within the hour.
Meet that deadline.
All right, very cool. It's all yours. I'm going to get out of your way.
Okay, super. So,
Oh.
okay, I'm back.
Yeah.
Welcome, everyone. I know it's been a long day, but I do want to say welcome. We're going to be covering a fair amount today. Let me introduce myself, take a bit of a minute here for those of you not familiar. This is Mary Ellen McGonigal with MEM Investment Research. And I do have quite a bit of experience, not only on Wall Street. I did start my career out on the trading desk at Goldman Sachs many years ago, went on to manage over 2 billion in assets. A lot of that was wonderful, but the real fun relating to stocks was during my 15 years with William O'Neill and Company. And for those of you not familiar, Bill O'Neill is the founder of Investors Business Daily, the publication that's designed to help investors get in front of these big, fast movers just as they're about to take off. And during that time there, I was working with top portfolio managers and analysts throughout the globe, really teaching them this methodology and also helping them with stock selection and broader market interpretation. So I now, more recently, actually it's been over 4 years now, I've started my own investment research firm, MEM Investment Research. I do still work with institutions, but now my work is mostly focused on helping self-directed investors. And I have to say it's been wonderful. Very, very rewarding. I also do have a couple of shows on Stock Charts TV. For those of you at the end of this, if you'd like to see more, I have a show that airs on Friday afternoons at 5 p.m. Eastern, and then actually Thursday at noon or 3 p.m. Eastern is Wealthwise Women. Friday show is the MEM Edge show. So lots of great information there as well. And then I mentioned that I do have a newsletter, and you'll probably hear about it as I go through today's presentation, because a lot of the stocks that we're looking at either have been part of that newsletter, MEM Edge report, and you'll be able to see why as we move on. So today I'm going to be focusing on how you can increase your total returns using stocks that have both growth characteristics as well as income. And I'll tell you, I did come upon this because I am in the throes at the beginning of next year. I'll be launching a growth and income, actually high growth income monthly report. So it led me over these last 2 months plus to really dig in and do some research. And I was very, very excited at what I uncovered. And I think you will be too as I go through and share with you the real power of combining growth with income. That some of the returns are really very spectacular. So let's get started. Yeah. So what I'm saying here is that there are going to be current charts, no recommendations, just educational purposes only. So let's take a look at what we're going to be covering here today. The first is this concept of compounding your growth. And this will make sense as we move forward. It has everything to do with investing in stocks that provide dividends and reinvesting those dividends. It's a lot of you, I'm sure, are very familiar with the concept, but when we show you some of these charts, I think you'll be pretty impressed. And then also the Dividend Aristocrats. This is a group of stocks that have, I will get more into this, but also we will cover that. And then also some technical indicators that can help guide your buy and sell decisions, and then where you can locate the best candidates. And Metastock, I know, has the ability for you to screen for these yield stocks. I'm going to show you another quick way too as well. But perhaps I'm wondering if Jeff maybe can spend a minute at the end and share with you the best way for you to get in front of these higher yielding growth stocks. And then history is a guide. Quite simply, we're going to be looking at charts using historical precedent to guide, to help provide you with some guidelines. So let's get started here. The first thing that we are looking at here is quite simply a view of the S&P 500. This is a 25-year chart, and the orange line here very simply is the price appreciation over a 25-year period. It's not a current chart, but it certainly tells the story. In this case, over this 25-year period, the S&P price appreciation alone was up 517%. And then this blue line, we can see a significant outperformance. It's almost double that price appreciation. And this is the S&P 500 as well, but it's that total return. So in other words, this is taking the dividends within or among those 500 stocks and reinvesting it throughout this 25-year time period. So quite simply, a double of your return through that concept of compounding and reinvesting those dividends. So I'm sure that makes a big point. So what is exactly total return? Quite simply, as mentioned, you're taking that price appreciation, that price return, and then you're adding in those dividends. So that is total return. So that's a concept that I'm going to be talking about a fair amount today, is that total return number. So let's take a minute and talk about this Dividend Aristocrats. Now, this is not something that I'm entirely wed to, but I will explain it to you because quite simply, it is a listing or a group of stocks, and it is maintained by the S&P Global Corporation, and they have a board and a panel that decides which stocks are a part of this Aristocrats group. The reason I want to focus and spend a minute on this is because among and within these Aristocrats groupings, these stocks, there have been studies done that can be really helpful as far as, again, drawing you in and sharing with you this concept of total return. So in order for stocks to make it into this Dividend Aristocrat grouping, and it's very public, you can access it on S&P or just Google it. But for today's work, the stock has to have increased their dividend payment for a minimum of 25 years. And there are stocks on there, it's been over 40 years, and each and every year they are increasing their dividend payouts. So super high quality companies, when you think about it, they're going to have a pretty big cash flow to be able to keep paying out those dividends. Another thing is the company has to currently be a part of that S&P 500 index, and the stock has to have, the company, a minimum market capitalization of $3 billion. So those are the primary factors and the screening out for the stocks that make it to this Dividend Aristocrat. And with that, now you have a group of stocks, high quality, and you can talk about it, do studies, and what they have found is that the long-term track record, it really does showcase that effect of compounding where you're reinvesting those dividends. So for the 10-year period, and they'll do it again this December, but from December 2018 to that prior 10-year period, the S&P Dividend Aristocrat Index actually beat the NASDAQ by 2.37%. Now, I will tell you that is a risk-adjusted number because the NASDAQ, for those of you, I'm sure you're very familiar, a lot of high-growth tech names, healthcare, can be quite volatile. So they did do a risk-adjusted comparison, and that had the Dividend Aristocrats beating the NASDAQ. And to me, that was quite impressive. I do a lot of work around the NASDAQ. My work currently is identifying these high growth stocks as they take off, and oftentimes it does involve that NASDAQ. So over that 10-year period, it's a 16.2% increase. And also among those aristocrats, the companies, they span all 11 sectors, and they do have both large growth and value. But I'll tell you that growth component really is not there. Probably only about 2% of the stocks are growth. You'll see certainly a lot of utility stocks and so forth, which makes that improvement even more impressive. So 16.2% over that 10-year period. So my work is drawing me toward those stocks that have the type of characteristics of a dividend aristocrat. They're high quality, but growth stocks. So because what you'll find, for instance, is because this company has to have a long-term 25-year track record, it's not going to get a lot of these newer growth companies. Certainly the FANG stocks are not 25 years old. So if you think about that, so I saw that there was a need to be able to capitalize on these growth stocks that may be newer, but offer a nice yield so that investors can capitalize on this total return concept. So let's take a look at, this is a 5-year chart, and each of these lines, of course, is representing a different stock. So I'm taking you back to December, in this case, actually 4 years. So December 2015. And this high outperformer here is AVGO, and that is Broadcom semiconductor stock, and the purple up here in the top. And Avago, I'm sorry, it's Broadcom, as it has been for a while now. You can see this super big outperformance. Right now, they're offering a 3.4% yield, but this chart that you're looking at over this 4-year time period, it includes what's called total return, a continued reinvestment of those dividends, plus you're getting the superpower of that growth. So we can see over the 4-year period, 160% total return as compared to the S&P 500 listed down here at the bottom in red. That is 50% over that 4-year period. So we can see triple as far as the outperformance. And then I also included utility stock, so this kind of purple line is Con Edison, ED, a little bit more than the S&P, 60%. And the green line is McDonald's, and we can see that had about a 90% return over the last 4 years. So just kind of giving a comparison so you can really see how powerful with a growth stock, a high quality growth stock that has a very significant yield, how reinvesting that can really supercharge your returns. So let's go ahead and move on from here, because I want to share with you some concepts that, again, are part of my expertise and that can be applied to these dividend stocks. So we're going to be looking today at which stocks will advance the most. And we'll get into that. Also, we're going to take a look at timing your entry and exit using some overlays on these charts. And then how long should you stay with the stock? And this is a really important element of all of my work, because I view it to be very critical that you have an exit plan in place. You want to make sure at the very least you preserve your capital, stem your losses, and really keep that confidence level high. And that's going to be all about having a strategy of knowing when that uptrend is over and when it's time to exit. So which stocks move the fastest? Well, what I'm sharing with you is based on historical precedent. I again mentioned that I worked at William O'Neill and Company, and a lot of that work had done, Bill O'Neill had done studies of the markets going back to the turn of the last century, looking at the common characteristics among these big fast movers that are up 100%, 1,000%, and so on. And there are actual common characteristics. I have courses that share that if you're interested. But today, for today's work, I wanted to share one of the components. We're looking at a weekly price chart of a company called Ring Central, RNG. This is a software stock. So this weekly price chart, each bar is 1 week of activity. So what I've done here is drawn what's called a saucer type base underlying this activity here in late 16 into early 2017. And this is a stock that actually hit the MEM Edge report right here as it broke out. We were able to get in front of this nice mover. But more importantly, the big consistent driver, and I'm sharing with you that the stock did advance 375% over this multi-year period until it fell here in line with the broader markets in the fall of 2018. But what is that big driver? The primary driver in all these big movers is growth. And by that, I mean earnings growth. So each one of these arrows here on this weekly price chart is pointing out the release of that company's RNG quarterly earnings reports. So I can tell you going back here and throughout most of this period, a lot of these earnings reports were triple digit year-over-year quarterly earnings growth, and the stock just continued to soar higher. So that's something to keep in mind, that these higher growing stocks are going to have really nice earnings that are driving the stock higher. So let's go ahead and take a look from here, because there are certainly other key ways that you can uncover what I call top candidates, stocks poised to outperform the markets. And these are just some of the many characteristics, but I've found these to be quite key. And the first one is you want to make sure that the industry group that your stock that you're considering is that industry group outperforming the broader markets? Are you in a strong area of the markets? And a lot of people might not realize it, but group affiliation as far as the potential for your stock's advance is very critical. I've seen it at the attribute as high as 68% of a stock price movement is attributable to which industry group it is a part of. So you want to make sure, and I'll share with you one way that you can do that. Is your stock part of a group that is seeing a lot in the way of money flows, interest, and is it outperforming? Are the growth prospects promising? And I did touch on that with the earnings. You certainly don't need to see triple digit, but you want to see not only current growth, but future prospective growth looking quite strong. And does the stock have what's called a sound reason for doing well? I know that sounds rather vague, but oftentimes what you'll see is particularly different areas of the market that will begin to do well because companies are offering products that are innovative. They are advancing the way products are delivered. A lot of that, for instance, we can see with 5G has been a big topic with the advanced ability to provide corporations and individuals with the ability to get data faster and sort that data faster. That's a big area, also cloud computing and so forth. So that's what I mean here by that sound reason. You want to see institutions involved in the stock. About 80% of that volume you see on your chart is institutions. And I like to call that smart money. These guys have analysts, their feet are on the ground, they're out there meeting with management. So more importantly beyond that is institutional involvement with their big assets under management. They are the drivers of a stock, either up or down, whether they decide to get involved or exit. And then you want to make sure the economic backdrop supports a continued move higher. And we'll take a look here as we move on how you can identify that. So how to pinpoint your entry and exit points. We're going to share some charts, but just for you to have an idea, one potential entryway to enter a stock is when a fast moving stock pulls back to a simple moving average. We're going to share some charts with that. As the stock then moves away from this moving average, you want to see volume. That's going to be those institutions in there supporting the stock. And then if the stock breaks out or forms the right side of a base, and I shared that with you with RNG, that can be a very critical way that you can pinpoint your entry point. And here we are with an exit point, if the stock breaks below key support, now key support for me is going to be those simple moving averages. So if it does so on volume, and particularly if during that period, if it breaks support and the broader markets are advancing, this is not a good sign. So that could be very easily a key reason to exit the stock. So here is a view of the broader market. This is the S&P 500. We're looking at a daily price chart. So each bar here is 1 day. And I've overlaid, and I do know certainly Metastock is very, very good with these simple moving averages. This green line is your 10-day shorter term simple moving average. The red is your 50, and the blue is that longer term 200-day simple moving average. So when I'm looking to see if the markets are in a confirmed uptrend, are they healthy? This is going to be my first go-to, because we can take a look here at this nice recent rally we've had in the NASDAQ, I'm sorry, the S&P 500, NASDAQ as well, but we're looking here at the S&P 500. We can see that in the beginning of October, when this index broke back above this 10-day, and quite clearly it's finding support at this upward trending 10-day simple moving average. And I have some wonderful, one wonderful course that talks a bit more about these simple moving averages for those that want to get a bit more into it, but they are very critical to my work. So we want to see the S&P continuing to find support during this uptrending period. Of course, last week, and we did get a pullback. It broke below, but we can see that we ended the week back above that 10-day in good standing. So this is one way that you can develop a system to help tell you whether the markets are in an uptrend. Are they healthy? Is it safe for you to put money to work? So I also have some other technical indicators that I use. This RSI is a relative strength indicator. You want to see this RSI above neutral, which is 50, and trending upward ideally. So we're in good standing there. And then another momentum indicator, the moving average, convergence, divergence, MACD, also up above that neutral 0 and seemingly heading north. So broader markets from this analysis is in good standing. So let's go ahead and move forward from here, because I talked to you about group affiliation. So one way you can do that is by looking at the charts for these groups, these sectors. So here we're looking at XLK. That's the technology sector for the S&P 500. And we can see that this is a daily price chart. So in line with the markets, a very nice uptrending period here. But I will tell you, technology year to date is up over 45%. Super, super powerful area. Very strong place to certainly be fishing, if you will, for those big outperformers would be within technology. So let's take it down a little bit further and take a look at one of the sub-industry groups within technology. IGV is an ETF, a software ETF. We can see this one had this is a lot with cloud computing and otherwise. We can see that this is taking us to the beginning of this year. Super big outperformance among these software stocks. By mid-year, many of the sub-industry groups in software were up well over 20, 25%. They did deteriorate, but we are seeing a potential move back into some of these software stocks. And I'm pointing that out because these software stocks are very big, a lot of big growers. I mentioned to you that RNG, that is a software stock. There are a number of stocks among or within this area that can provide excellent returns, provided the chart is healthy and the interest among these stocks continues unabated. So this is what I'm doing now, is kind of sharing with you how you can uncover where the strength is and then capitalize on that knowledge. So let's move further on and take a look at a stock within software. And this is ADP, Automatic Data Processing. I'm pointing this one out because it's part of that Aristocrat stock group, the S&P Aristocrat. This stock has a 2.2% yield. And quite simply, what we're looking at here is not the dividend reinvested, it's just the price performance. And we can see we're looking at a weekly price chart. And in this case, this red line is your 10-week 50-day. And then the blue line is your 40-week or 200-day simple moving average. And this can be really helpful as well when you see a stock pull back to this 200-day simple moving average. Oftentimes that can at some point be an opportunity to enter the stock. We can see historically it has been a buy point. But again, using these other technical overlays, the RSI and the MACD, we can see as we drill down from tech to software to an individual stock, how that can work. So I also wanted to pinpoint, share with you how one of the ways to pinpoint your entry and exits. I'm not a big user of intraday charts, but they really can be helpful for this purpose because, of course, intraday, I'm using a 1 hour or 60-minute price. Each bar is 1 hour. They will, of course, tend to be quite a bit more volatile because you're drilling down into these shorter term time periods. But more importantly for today, as far as how you can utilize these for identifying buy points, we can see ADP. This is the beginning of November. The stock had a bit of a 5-day downtrend, but this reversal is what would interest me. The stock breaks back above, in this case, I have a 5 and a 13-hour simple moving average. And as it breaks back above these simple moving averages, you can see that these averages now act as support. And you want to combine that with an RSI that is turning positive. It's going up above the dash net neutral. And then also the MACD is going to give you a nice early signal, the moving average convergence divergence, the black line going up through this red signal line gets even more positive up here above that neutral. So when we can marry these together, this would, in this case, be an ideal entry point for this stock. So another way that you can identify sector strength is using something such as this. This is a thumbnail view of those 11 sectors among the S&P 500 as well as the S&P listed here. So quite simply, just getting a snapshot view again on Metastock of these, in this case, this is a 2-month chart of these sectors. And you can see quite simply based on their behavior where the strength is. And healthcare has really come into its own here of late. Super strong area up here in the forefront. Financials had a nice week last week. So really just by taking a minute and looking at those sector charts, this is a daily view, you're going to very quickly get a sense of where the strength is relative to the weakness down here with utility, real estate. Some of these more defensive areas are pulling back. So this, again, I would urge you to really just take a minute. If you did it at the end of each week, you'd be well served to then be able to capitalize on where that strength is in the markets. So let's take a quick look, because what I wanted to share with you, I apologize for not having a heading on this, but this is an example of the total return performance of a growth stock versus the S&P 500. So what we're looking at here, this purple line, is Qualcomm, another fast growing technology stock, and then the red is the S&P 500. So I'm taking us from the beginning of this year, and quite simply we can see the total return on the S&P 500, 25%, and Qualcomm over that very same period, 50%. So you're doubling your returns. Qualcomm is another high high dividend. Currently it has a 3% yield. And by reinvesting those dividends coupled with the growth component that Qualcomm has, it's part of the semiconductor grouping, and it is a big grower. So quite simply, you can see the clear outperformance that can really get you just even over a 1-year time period. So from here, what I am pointing out to you is another look, another view at Qualcomm versus the S&P 500. However, in this case, this is a 5-year view. And the reason I'm pointing this out to you is over this 5-year period, the red actually outperformed Qualcomm. And the reason that I did want to share this with you is because it's not just one and done, buy a growth stock with yield and walk away. There will need to be active management on your part, or you can always subscribe to my upcoming newsletter where I will be closely watching each and every holding for signs of deterioration versus signs of growth. And I did also want to share with you this concept that oftentimes when people think of dividend stocks or yield stocks, you think of consumer staples, food stocks, certainly drug stocks and utilities, more safe. But there are going to be periods of time where these, in this case, consumer staple stocks actually turn into growth stocks. So what we're looking at here is a weekly price chart of Tyson Foods, TSN, Tyson Chicken. You may be familiar with them. They are part of the consumer staples, normally a pretty boring group, but sometimes they turn into growth stocks. And in this case, Tyson on this weekly chart, take a look at this big outperformance here in 2019. And this has everything to do with the protein-based or plant-based food products that are being developed and are really consumers are embracing them. So plant-based meat products has really pushed revenues higher for this once stayed chicken provider. And so this is the kind of thing, because TSN does offer a nice yield, it's part of that consumer staples group. My point is you can seek candidates outside of high growth tech and healthcare. Oftentimes you'll see other candidates that are growing that are in areas that are once normally viewed as quite staid. So here's a year-to-date performance of Tyson TSN versus the S&P 500. So again, year-to-date S&P 500 total return 25%, and take a look at Tyson up 70%. Again, reinvesting that dividend and capitalizing on that growth factor. So over here, quite simply, I've shown you that year to date, 10,000. If you reinvested those dividends, your total return as of Friday would be $12,193. However, that very same time period with Tyson, higher yield, also growth prospects, you would have seen 16,581, and that's just 10,000. You can add a zero to that, and you'll see that would be quite a significant increase in your total return using that growth and income concept. And then you can look in other areas. For instance, Starbucks is actually a growth stock. And what I wanted to share with you with this one is we're looking at a daily price chart, SBUX. And I talked to you about that need to have an exit plan. Starbucks was on the MEM Edge report as part of my MEM investment research. We were able to take part in a lot of this uptrend here, but I wanted to share with you when we removed the stock and why. So one of your first signals that a stock may be entering a period where certainly in this case it's consolidating and you can put your money potentially to work elsewhere. One of the ways certainly that you can identify this is this moving average convergence divergence. This is really a very powerful indicator as far as spotting trend changes. So quite simply, this black line down through the red on this daily price chart. Now it's still in positive territory. It's not giving any sell signals, but it is quite simply telling you that this uptrend has shifted. And you'll see this happen a lot as stocks consolidate. This MACD, the MACD, is going to trend downward. But from my work, the real sell signal comes if the stock's price breaks below this red 50-day simple moving average. We can draw our eye down and see, in fact, it did occur on very big volume. Marry that with the RSI turning negative, and the MACD trading below this 0. So this was our exit point. We can see that subsequently it has declined quite a bit since then, and it could be reversing. This is the opposite of this phenom. So we have it on our watch list. Starbucks still has great growth prospects. They're moving into China and so forth. So we will want to capitalize if this downtrend reversal takes hold. But more importantly, I did want to share with you that exit point, so you can add that to your process. McDonald's, I talked about this being a yield stock, 2.45% yield. Another example of a nice big winner going into the third quarter. Price breaks below that 50-day simple moving average, and then your other indicators turn negative in line. So that is your one of your ways with that exit strategy. So let's take a look, because I did also want to share with you a Dividend Aristocrat stock that has been a really steady grower. Now this, they have had periods of 30% year over year increase, but by and large, this is CTAS, Cintas, and they provide uniforms to any number of industries, healthcare, the restaurant, hospitality, but they are a very steady grower. This is the kind of growth stock that would make a lot of sense if you are looking. These arrows again are pointing out the release of very strong quarterly earnings. So we're looking at a weekly price chart here of CTAS. And from here, I was going to share with you a 5-year view of the outperformance of CTAS. And we can see again, this is taking us back to December 2014, the S&P 500 up total return 50%, but take a look at CTAS, 270% total return. Again, that's combining those nice high yields with a very, very steady grower. Of course, this is that bear market 2018 that impacted pretty much every stock, but barring that, you can get a real sense of what a growth stock, when combining it with that income, just really how powerful that combination can be for your returns. So that was something that I did want to share with you. I'm just going to take a minute here and exit out of this and share with you if I can. Let's see if I can do that. Yeah, we can go over here. So what I wanted to do from here is share with you, this is, I talked to you about the S&P 500 Dividend Aristocrats, and this is quite simply from Wikipedia. You can access this anywhere. And this is going to share with you the studies that have been done as far as the performance, what components, why they're aristocrats. We talked about that yield improvement, but also cash flow needs to be incorporated. And then here at the bottom is a listing. So it's a very healthy listing of stocks. And if you just take a minute, there are some names that will be very familiar to you. Certainly Walmart is here, Target, nice big growers. And then of course you get into some of these consumer staple areas that are not as big on the growth side. McCormick, MKC is more staid, Pepsi and so forth. So if you just took a minute, this is something, again, I've been doing a lot of work in here, really kind of pinpointing, looking at why some of these are bigger, much bigger performers over others. And consistently, that growth aspect is the primary divider. The ability to kind of pinpoint the growth. And as a, for instance, a Pepsi, while it will get you a nice return, I'm just going to share with you, this is the total return chart. It's not just price appreciation. So we're looking at Pepsi. This is just taking us back a couple of months to February, and we can see the advance the comparison difference. But if we go back, you'll see that there's really not a big, 10% total return versus 22 is certainly healthy. But by and large, when you compare it to a CTAS, and we looked at Broadcom, AVGO, those are going to be your really big super outperformers relative to the S&P 500. So again, just really kind of drilling home that concept that when you marry growth with the income, you're going to see really significant outperformance. One other thing I did want to share with you, and again, this is something that I know that you can do on Metastock, but I'm going to share with you how to create a screen for these high growth dividend stocks. And if you can take these characteristics and use them with Metastock, you will really be well served. So this is a screen and it's really super simple. I only have 3 components that are going to help get in front of some of these growth stocks with the dividends. And quite simply, the first item I have here is I want to see stocks that are currently offering a yield over 2%. Right now, the S&P 500 average yield is 1.8%. So simply asking it to be higher than the S&P 500. And then from here, we can go over to what I call fundamental. And this is where that growth component is going to come in. So in this case, I asked that the earnings per share, the EPS growth this year is at least 10% or higher. So a very low metric, but certainly one that will get rid of the outliers, those companies that are not growing. And then the earnings per share growth quarter over quarter. A lot of companies just finished releasing their Q3 results, over 10%. So really that simple. From there, you can get certainly more technical and you do a lot of work with those simple moving averages that I talked about. But this list really refined it down to 240 stocks. I know for some of you that might be daunting. For me, that's perfect because pretty much my work all day, every day, I am screening the markets, prowling for that next big winning stock. I want to see where the strength are the markets shifting? So this kind of list is not daunting at all, but you can certainly narrow this down further, maybe up the growth components. We talked about free cash flow being a critical component for these stocks that are offering these yields. Now, you can also, even by country, reduce, but quite simply what I've done since from there is gone ahead and sorted it by sector, and you can do it by industry group. So I talked to you about my desire to get, I'm much more interested in stocks that are offering growth as well as the dividend. So there are utilities. I'll tell you, I had utilities on the MEM Edge report for a good part of this year until they fell apart. The utility stocks can be very, very good proxies. There, we had a handful of growers among the utilities that really served our subscribers well. So I wouldn't entirely dismiss them. Certainly, if the markets get into trouble, this could be a good area to search. But for today, just going down and taking a look within technology, because by and large, these tech stocks, they're going to be bigger growers. We talked about the NASDAQ and some of the volatility. So you can see not all of these stocks are going to be a great candidate, but there certainly are some names that some of you might be familiar with. Hewlett Packard is an example. We can take a quick look at the chart before moving back. This is a gap up here on earnings, and it's digesting that gap up. So it could be in an uptrend. I just wanted to take a peek. But more importantly, I'm sharing those components that you can then take with you to Metastock, and just again, keeping it simple. And of course, from there, you can modify that screen even further to meet some of the criteria that would be really critical to you. So let's go ahead and move on a little bit from here and take a look, because I mentioned to you that technology and some of these growth stocks, there's not a big contingency, but those that are, you can really then drill down. Services, this is going to be consumer cyclical. This is another very rich area where a lot of high growth stocks come out. Target is certainly one of them. This has been on the MEM Edge list. We picked this up just before its recent breakout. So big grower there. This was a big winner over the holiday shopping period recently. So from here, you can just, of course, drill down, and you can do this certainly with your screening service, where you can go ahead and take a look at some of the underlying characteristics of these stocks upon your screening. So that was one thing that I did want to share with you. And we can certainly take a look, because there are going to be stocks here that are smaller, and these smaller stocks, this is CATO, they certainly are going to move a lot faster than some of these bigger cap stocks. We're starting to see a move into, this is the year to date on Starbucks, but we can take a quick look at something such as that small cap stock that hit the screen, and we can see that the outperformance certainly is there. So the S&P 500, again, this is only going back a couple of months. We can just drill it back to the beginning of this year, get a little better picture, and we can see that year to date, the CATO, this is a small retail apparel retail store, and up 38% relative compared to 26% with the S&P 500. I'm not quite sure the yield on CATO, but it really does span many industries, and you can really take advantage. I'm kind of, I thought that I may have had more, but I do not have a lot more. I can answer questions. It looks like I might even end a little bit early. I hope that's not a problem. I did have an offer today, and this is for one of my really premier courses, because my expertise is how to trade in what are called momentum stocks. These are these faster moving, higher growth stocks. I do have this course. Normally it is $197. And you can access it today for only $9. It's going to really help you. A lot of historical precedent there. It's going to show you how you can more work with pinpointing your entry and exit, and one key signal that tells you when that upward momentum is over. So it's going to really share a lot of ways that you can uncover these big movers, these best performers. Very much an introductory course. I will tell you that I have a Mastering the Art of Uncovering Winning Stocks, which is much more involved, really goes into true detail. This is just a kind of a primer, a beginner course, but still quite effective for those of you that want to take advantage. There's a link here. And then I also wanted to share with you, at this point, it's just the logo, but for this high growth income monthly report that I'm going to be offering in January, we're putting all the pieces together right now. And for those of you that would like to get on the wait list for that, to get more information, you can go to support at the MEMgroup.com and just go ahead and provide your email. It won't get on any list. You won't be spammed. It's very, very much centered around keeping people informed as far as the development of this report. I have a really well-renowned person that I'm partnering with on this project, and so I hope you'll come by and take a look at it. So that is something else that I did want to share with you. And I'm wondering, Jeff, if perhaps there are any questions or anything else that we can potentially cover here.
Very good, Mary Ellen. We have some great feedback on your presentation from YouTube. Scott enjoyed it. He said, I always like listening to Mary Ellen. Thanks for the information. In YouTube, Trevor had to say, or in GoToWebinar, Trey had to say, "She's a boss!" Explanation point. So
Very good.
Craig agreed that
Very
the
good.
weather sucks here in Salt Lake City, and he's actually also in the same town we are right now, Taylorsville. So it does look like there's some sun outside though right now.
Wow.
Michael did have a question though. How much do seasonal trends play into your choices, like 6-month switch over from consumer discretionary to staples, et cetera, et cetera?
Oh, can you repeat the beginning of that, please?
How much do seasonal trends play into your choices? Like, and he says, as an example, 6 months switch over from discretionary to consumer staples, some stuff like that. Do
Yeah.
seasonal trends play in?
All of my work. Well, sure, they do play into it only because you will see seasonality, certainly within certain sectors and certain areas of the market. We're at a period now where seasonally small cap stocks, December, they tend to do well December into January. So yes, there is always going to be a component. Oftentimes, as it relates to consumer cyclical, by and large, the group has been in a go nowhere environment right now. But during Q1, sometimes a lot of these names will pick up after the holiday season, and these companies report if they do come out with strong numbers. You'll see a select few that will just really take off. Those are your big outperformers. So that's what I'm going to be on the prowl for. And yes, we will ebb and flow as the market dictates as far as where stocks are that are on that MEM investment research MEM Edge report. So it is going to be very contingent upon where we're seeing that relative outperformance. Where's that strength? Where are the money flows?
Cool. We have a couple of requests for that link. I'm trying to type it in. Another question while I'm typing the Infusion Sync that Infusionsoft link at the bottom is how to get the $9 book, right?
It is, yes.
Okay.
And you can always just go to my website, meminvestmentresearch.com. You'll see this, how to trade momentum stocks. It's right there. And that is the price that's been put on that for today's presentation. So you can take advantage of that.
Okay. I'm going to actually just type in the easier link then. So just click on the how to trade momentum stocks. You'll get the $9 deal on MEM.
Investment Research. You'll see a tab and it'll say how to trade stocks and then more courses. And that'll take you right to that link.
Okay. Very cool.
Yeah.
Michael asks, sectors are very broad measures, whereas industry level identifies subgroups moving relative to broader sectors. Do you focus on the industry level or the sector level?
It's going to be both. And it will start primarily with that sector level and then drill down beyond that. And that's how I was trained, because it's one thing to know that the sector is moving. I talked about financials doing well this week, but I will tell you wholeheartedly that there were only 2 areas within financials that moved constructively this week. Bank stocks was one of them. There were many more areas that did not do well. So you really do need to take it a step further, go down into that industry group and make sure that you're in a sub-industry grouping that is also showing relative outperformance and strength. And Greg, I don't know if you even have the ability to share your screen, but I would love to share that, how to do that with Metastock. But,
how to do what?
Be able to look at that sub-industry grouping level.
Yeah.
Kind of a thing.
So for that kind of stuff, I was really taking notes during your presentation, and I would say for those people that want to get those scans, it's going to take me a few minutes to put them together. It's not hard to do with Metastock, but just email me and I will send you. I'll send out the details Tuesday or Wednesday of next week. So, and my email.
Hate to give you extra work, but I know that your work is incredible, and that ability, quite simply, to get the yield and uncover yield stocks that have growth, I'm sure would just be a simple screen. And,
hey, it's okay. I like to work. That's why I've stuck here for that's why I've been here for 25 years. I shouldn't say been stuck here for 25 years. That's not what I meant. So I do. I am up here on your website real quick, Mary Ellen. I'm just going to change the view to me because I want to make sure that we have enough people asking how to find this. So
Oh, okay.
I'm going to go ahead and show my screen and we'll walk through it. So you'll want to go to meminvestmentresearch.com.
Oh, there you go. Yep, you're there.
Okay.
And then what you'll see is that tab that says Learn How to Trade.
Okay.
And then more trading courses, and it'll take you to a bunch of the courses there. Now, someone did mention that the link, I'm really surprised that it does not have the proper price, but it's right there, that beginner's guide to trading momentum stocks. And I apologize.
Right. Yeah, right
I'll
here.
go ahead and change that right now, and so that the proper pricing is reflected, and you can take advantage.
Okay, no problem. So right there, just give her a few minutes, maybe 5, maybe 30.
2. 2 minutes.
2 minutes.
This is the golden age of the internet.
So. We had to call IT guys. It gets involved. We want. None of us are like.
No.
Very
My
good.
IT guy is, I would say, off at the beach, but not on a day like today here.
Well, perfect. Well, great job. I appreciate it. That looks like.
Yeah.
That looks like the most of it. Trey says, I wanted to have an excuse to not play with my kids today. That's not true. They're still at the fun age. None of them have turned 13 yet.
Oh boy. Well, capitalize on that. I am showing it as 9, so I'm not quite sure where the disconnect is, but anyone, again, you can
Refresh.
go ahead and hit that contact me, and we'll have somebody get back to you. I apologize.
Okay. All right. No problem.
And then, I do see another question about short selling, and I work with hedge funds, and one of them in particular that is a long short. So that's a lot of the work, or some of the work I do is with short selling as well.
Perfect. Well, thank you for spending some time with us today, Mary.
Absolutely. Thank you for having me, and I hope you have a wonderful rest of your weekend.
You too. All right. Thank you.
Bye-bye.
All right. Very good, guys. Give me just a second. Okay. Very good. Let's go ahead and close this out as well. I hope you enjoyed that. I think she does a really, really good job in terms of talking about stuff, and I like kind of her sector-driven approach also, Lewis. So I did want to say thank you to you guys for coming, and very specifically, I do want to say thank you to Alejandro, William, Sam, Paul, Joy, Warwick, Matthew, Alina. I thought I had all these in one page, but I don't want to miss anybody. Give me just a second. Okay, we'll let that load. And everybody else that purchased today, it's not loading the second page. But thanks for welcome to Metastock. If you're brand new, if you just picked up an add-on, we appreciate it. I do, I do hope you enjoy Metastock about half as much as I do. At the minimum, you'll love it. So I know we've been busy on and off today. Our sales guys, we've got a couple of them here. They're going to stay until they stop getting phone calls and chats. So if you have questions that we didn't cover, you still want to get your Trader's Action Pack or your extended trial set up for Metastock, do it right away because they're going to go home and play with their kids too. So to cover the Summit Action Pack again, you can get Metastock Real Time, the new service, Knoxville Divergence, Big Trend Toolkit 2.0, Fulgent AI, setup and timing triggers, unleash the power of Metastock, unlimited lifetime technical support, a white glove installation appointment, 2 years of stocks and commodities, and access to the software that's been rated #1 in its price category for 25 years in a row. Normally, if you wait, it's going to cost you $17.44 for all of these really, really good products and add-ons. Here you can get it for $8.96. So you're going to want to give us a call at 800-882-3040. You can chat live with us at metastock.com/saleschat. I do want to thank all of the speakers that came today and kind of spent an hour with us. I want to thank all of you that have been here today. You know, these summits, we wouldn't be able to attract the audience, caliber of speakers we do without you being here, because nobody wants to come talk to nobody for an hour on a Saturday. So I appreciate you being here, and I hope you enjoyed it. Again, if you have suggestions for me for future summits, jeffrey.gibby@metastock.com, and I will say, I'll see you at our next webinar. And Michael says, great job by Metastock and Stocks and Commodities. Thanks, Michael. And one last shout out to Stocks and Commodities for sponsoring today's events. I hope you enjoyed it. I hope you have a good holiday, and I'll see you at the next one.